Hi, and once again, welcome to this course on algorithmic trading. Now, let me briefly explain what we will do in this course, and let me give you a short course overview. So, there's actually no single definition of algorithmic trading, and different people mean different things, but all use cases and applications have two things in common. So, there are two major aspects of algorithmic trading. And first of all, trades follow a clear strategy or plan. And either we have pre-programmed rules or algorithms, or we have learning algorithms like machine learning. And second, trades are automated and executed by computers, not humans. And this enables high-frequency trading and trading based on complex strategies that are too complex or too fast for the human brain. Next, let's have a look at some selected use cases and applications of algorithmic trading. And originally, algo trading was used for trade execution and transaction cost reduction. So in simple words, let's assume that a bank wants to sell 1 million shares of Apple. Then it might not be the best idea to sell all shares at once. So the bank should break down a large order into small orders to be placed over time to optimize the price and the transaction costs. Second, we have portfolio rebalancing, and algorithmic trading can be used to rebalance portfolio constituents to the target weights. Now let's come to number 3 and one of the newer applications, robo-investing or robo-advising. And asset allocation, portfolio optimization, management, and rebalancing is done with minimal human intervention. So this is typically for long-term investments. And finally, we have market timing or alpha generating strategies. And that's what this course is all about. So we time trades and take long and short positions in instruments like currencies to benefit from mispricing or market inefficiencies. And this should work independent from the general market trends. So it works in bull and also in bear markets. And actually, we will use technical indicators like moving averages and other techniques like machine learning. So that's the plan for this course, algorithmic day trading. So this course is organized in 5 parts. And in part 1, you will learn the basics of day trading from A to Z. Then in part 2, we will cover some Python workflows that we will need for the next parts, like managing and handling financial data with pandas and introduction to object-oriented programming. Then part 3 is the heart of this course, defining strategies based on technical indicators and also machine learning-based strategies. And you will learn how to backtest and forward test the strategies and identify those strategies that are profitable. So the main focus here is on trading costs because the strategies must be profitable after trading costs. Finally, we have part 4 where you will learn how to create trading bots to implement your strategies and to automate your trades. And then we have another part 5, and part 5 provides some really helpful expert tips and tricks and also has some comprehensive case studies. And finally, in the appendix, you can find a Python crash course to refresh your skills on basic Python coding, and also the appendixes for those students who haven't worked with Python before. Finally, to be fair and transparent to everyone, for some sections and lectures, you need a broker account either on Oanda or FXCM to get the full and the best learning experience. So it's the part on day trading and also the part on implementation and automation. However, in some countries, the CFD or Forex trading is prohibited, or the 2 brokers are not available in those countries. And for example, we have here Japan, Korea, Russia, and Turkey. But I do think that this course provides a lot of value and benefits, even if you don't have a broker account. So, but still, please keep in mind that the 2 brokers are not available in all countries. Alright, this was a brief overview. Thanks for watching and see you in the next lectures. Bye. In this video, I have some tips for you how to get the most out of this course and how to improve your Udemy experience. We are here in one of the videos, and it might be the case that something is not clear or you have a question or comment on that lecture, and therefore you can find here the Q&A button. And before writing a question, you should always browse old questions, as it might be the case that your question has already been answered. And if not, you can create here the new question, ask a new question, and it's actually best to describe your problem as detailed as possible. It is always helpful when students include a screenshot to give some helpful background information on their problem. And I'm actually best prepared to respond to your question quickly, so typically within 24 hours. If you are not a native speaker or if you are more the visual learner, it might be useful to enable captions. And you can do this here, and then you can go here to English. These are automated captions that are far away from being perfect, but they can be pretty helpful. And also you can customize the captions here, and for instance you can change the font size to maybe 100. And let's go back here, and you can also display the captions under the video, so there's some flexibility here. And finally you can also open the full lectures transcripts here. And here you can go through the full lecture and read what I'm saying here. So let's go back again here. Students are different, and for some students an instructor talked too fast or the pace of the course is too fast. And at the same time, for other students, the same course is too slow. And this shouldn't be an issue here on Udemy, as students can select their own speed. And you can do this here. And actually the speed of 1 is the normal speed, but you can even slow down the speed to 0.75 or 0.5. And of course you can also speed up to 1.5 or even 2. And of course you can also pause the course at any time here. So feel free to experiment and find out your optimal speed. Sometimes it might be the case that you experience poor video quality. For instance, this video here is completely blurred. And in 99% of all cases, there's one reason for poor video quality and a blurred screen. It's actually the student's internet connection. Keep in mind that also the best and fastest internet connection can have slowdowns. In any case, your connection must support the streaming of high-quality videos, as the entire course has been screencasted in high-definition video quality. So whenever you experience low video quality, it's either the internet connection or in very few cases problems on the Udemy server. In any case, please keep in mind that technical issues are typically beyond my control. So what can you do in these cases? Maybe you can manage to find a closer location to your Wi-Fi router. And you can also manually adjust the video quality, and you can do this here. So the reason why this video is blurred is that I selected the poorest video quality setting, 144. And actually the best setting is the auto setting that automatically adjusts quality depending on your internet connection. But sometimes it might be beneficial to turn off auto and select a lower quality setting manually. For instance, 480 should still deliver sufficient quality. So you can turn off here autoplay and select, for example, 480. So that's not perfect, but I think it's still sufficient here. And Udemy will ask you very early in the course for a review, maybe after this or the next lecture. And this might be appropriate for courses within a duration of 45 minutes or so, but in my view it's nonsense for courses like this one here with 10, 20 or even more hours of video content. And if I could, I would ask you for a review earliest after 2 hours or so, but this is not in my discretion and I cannot control this. So if you get asked for an early review, and if you think that you haven't seen enough to give a well-founded review, then please click here on Ask Me Later. Please do not click randomly on stars to get rid of this request here, as it might negatively affect the overall course rating. And as a direct consequence, it harms my ability to update the course and to create new content and also to answer your questions. So each review counts, and I'm thankful for each and every honest and well-founded review or feedback. So thanks in advance, and I hope to see you also in the next video. Bye. Hi and welcome back. This is a short preview of the way how we will think and work in this course. So all decisions are clearly data-driven and we leave nothing to chance. And now let me show you an analysis that sheds some more light on day trading and the real challenges in day trading. And I guess you didn't know that before. So let's consider the following example, and let's assume that we trade the instrument Euro US dollar. So this is a currency, of course. And we take long and short positions. So we buy and sell the instrument. And first of all, let's assume that on average, we change the position every 2 minutes. So let's assume that currently we are long, and then in 2 minutes we are going short, and then 2 minutes later we go long again, and so on. And first of all, we assume that there are no trading costs and there's no bid-ask spread. And the question is now, what's the required hit ratio to make sustainable profits? And actually the hit ratio is the percentage of successful trades where we took the correct position. So long when prices rise and short position when prices fall. Now, what do you think is the required hit ratio with 0 trading costs? Exactly, it's more than 50% on average in the long run. And this means that more than 50% of your decisions and your trades must be correct. And this is, so to say, a fair game. But of course, 0 trading costs is not a realistic assumption, and therefore let's remove the assumption here. And let's take a more realistic assumption, so a bid-ask spread of 1 to 2 pips. And actually 1 pip is the 4th decimal in an exchange rate, so a bid-ask spread of 1 or 2 pips seems to be very low, but it isn't. So what do you think is the required hit ratio in this case? And it's not 50%. So is it 51% or 55% or even 60%? And actually the truth is that it's more than 90%. So a hit ratio of more than 90% means that you can almost perfectly forecast financial markets. So a hit ratio of 90% in the long run is absolutely impossible unless you are David Copperfield or unless you have a time machine. Now let's slightly change the assumptions. And now let's assume that we change positions every 10 minutes. And again, what do you think is the required hit ratio here? So it's still more than 70%. And also this is pretty unrealistic. And let's further reduce the frequency of trades. And now we have every 20 minutes. And still we have a required hit ratio of 65% and more. And also this is really challenging. And let's further decrease the trading frequency to every 60 minutes. And now it's getting more realistic, so more than 58% is required here. And finally, we have every 4 hours. And here we need a hit ratio of more than 54%. So this might be realistic. And finally, if we change positions only once a day, so in the morning we take a long or short position, and then in the evening we close the position, then this requires on average in the long run a hit ratio of more than 51%. Now it's important to note that the analysis here assumes that we take no actions to control or limit trades, and frequent trading doesn't necessarily mean that you cannot make profits. So it still can be profitable as long as you follow a couple of rules to control and minimize trading costs. And we will cover those data-driven rules in this course. All right, let's jump right into the very first trade, and I'm here on the Wanda trading platform. So this course covers two brokers and two day trading platforms, Wanda and FXCM, and I have here the instrument the Euro US dollar, and I can click on buy, and then I can select 100,000 units. So I will buy 100,000 euro for 116,000 US dollar. So let's click on submit. And now I have here one open position, a long position in the instrument Euro US dollar. And actually in day trading, we should close that position later on, so we can see the current unrealized profit and loss. And let's close the position here. And let's have a look. So we realized a profit of $1. And of course, making profits is the desired outcome of any trade. Now, in fact, we haven't bought 100,000 euro and I haven't paid $116,000. So this is not a physical trade. And I just bought a derivative contract, a so-called contract for differences. And actually I receive the profit or just pay the loss of the trade once I've closed the position. So making trades on these platforms is simple and you just need 2 or 3 mouse clicks, but you should definitely understand what you are doing, and that's exactly the purpose of the next lectures and videos. So looking forward to seeing you there. Bye. Alright, this course is all about algorithmic day trading, and you shouldn't mix up day trading and long-term investing. So these are completely different things, and let me briefly explain the differences. So this is here a brief overview, and first of all, the purpose of day trading is generating current income. So you start in the morning, and in the best case, you end up with a profit of a couple of $100 in the evening. And that's ordinary current income. And the goal of long-term investing is to accumulate wealth for the future, to have income during retirement. And this leads to the time horizon. So the time horizon of day trading is 1 day or even intraday. So we start in the morning with no open positions, and then during the day we take long and short positions, and finally in the evening we close all positions for the night. And depending on the age of the investor, long-term investing has a time horizon of 10 or even 50 years. Now, coming to diversification, a long-term investment portfolio is highly diversified with stocks, bonds, commodities, and more. And here we clearly have a portfolio approach, and decisions are made on the portfolio level. Whereas day trading doesn't require diversification, and you can trade one or many instruments, but typically the goal is to make profits on an instrument level. Next, in day trading, we can take long or short positions to benefit from rising and falling prices. And the plan is actually to benefit from market inefficiencies. So day trading assumes that we can at least partly forecast whether prices will rise or fall in the next couple of minutes or hours. And therefore, the source of return is alpha. So the plan is to make profits no matter if we are in bull or bear markets. And in contrast to that, long-term investing is typically a long only, benefiting from a long-term market growth, dividends, and the price increases, and therefore the primary source of returns is beta. Next, let's have a look at the instruments. And in day trading, we typically invest into derivatives like CFDs, so contracts for differences, and this allows us to invest with leverage. And a leverage of 10 to 30 means that we only have to invest or deposit 3 to 10% of the actual investment amount. And you will see in the next lectures in detail how this works. And due to that leverage, day trading is a very risky business, and small price changes can lead to high losses. And in contrast to that, long-term investments are typically physical investments. So you buy physical stocks and have the stocks in your portfolio. And there's typically no leverage in long-term investments. So the risk is low to moderate because portfolios are highly diversified. So these are the major differences between day trading and long-term investing. And sometimes a picture or image tells more than 1,000 words. And now let's have a look at typical images or charts for day trading and also for long-term investing. So this is here a typical chart for day trading. It's a candlestick chart, and we have some simple moving averages and more. So this is a technical chart, and each and every bar or candle here is just 1 or 2 minutes or 5 minutes. So this is very short term. And one more time, in long-term investing, we have a portfolio approach. And it's all about finding the right portfolio in terms of risk and return that is appropriate for the investor's situation and for the investor's risk appetite. So this was a brief comparison of day trading versus long-term investing. And again, this course is all about day trading, so algorithmic day trading. Thanks for watching, and see you in the next lectures. Bye. We are coming now to an important topic: spot trading versus derivatives trading. And these are clearly two different things. And in this course, we will trade derivatives, and most of the time Forex derivatives. And this means we won't make any trades in the spot markets. Now, before we move on, you should definitely understand the difference between spot and derivatives trading and why it's for our purposes better to trade with derivatives. So let's start with the simple and more common case: spot trading or spot investing. And let's assume that somebody offers you an apple for $1, and you agree and you pay $1 to the seller. And then the seller gives you the apple and you eat the apple. So that's a spot market transaction in the real world. And that's pretty simple, right? Now, if we replace the fruit apple by the apple stock, then we have a spot transaction in the stock market. So you pay money and you become the owner of an apple stock, and you can do with it whatever you like. So in the financial industry, spot trading involves direct purchasing or selling financial instruments and assets like stocks, bonds, forex, or cryptocurrencies. And typically the delivery of the asset is immediate. So spot trading occurs in spot markets, which are either exchange-based or over the counter. So that's the definition that you can find on Binance. And let's have here an illustrative example. So we have the buyer, and he has some money, and then we have the owner and the seller of a financial instrument. So for example, an Apple stock, and the owner actually holds a certificate of ownership. So in the earlier days, this was a physical paper, but nowadays this is a digital paper, so to say. And then the buyer pays the full price, and he receives the certificate of ownership. So the buyer becomes the new owner, the new legal owner of the asset. And now let's have a look at some characteristics of this spot transaction. So we have a transfer of ownership. So the buyer becomes the new legal owner of the financial asset. And actually the buyer pays the full price, and that seems to be self-evident, but we will see that this is not necessarily the case when dealing with derivatives. Next, in spot markets, sellers can actually only sell what they actually own, and if the seller doesn't own the Apple stock, he or she can't sell it. And as a side note, there's the concept of short selling, which is actually not part of this course here. And finally, the major use case of a spot transaction is buy and hold. So you buy a security, an asset, and you hold it for a very long time period, and you hope for a long-term price appreciation. So this is spot trading, and now let's compare it with derivatives trading. And derivatives are financial contracts set between two or more parties that derive their value from an underlying asset. So, for example, the Apple stock or a cryptocurrency. And typical examples for derivative contracts are futures, forwards, and CFDs. So CFD stands for contract for differences, and these are not the same. And the details are different, but the overall mechanics are very similar. And actually, all these contracts have one thing in common. So it's actually a bet on the future price movement of an asset, and this is highly speculative. Now, this is a rather technical definition of derivatives trading, and now let me further explain it with an illustrative example. And the following is now a generalized explanation that applies to futures and CFDs, so even if there are minor differences. But here in this lecture, we don't address the specifics of futures or CFDs. So we start here with a trader, and then the counterparty is typically a professional broker or financial institution. And then we have the derivatives contract. And in this contract, we have a reference to an underlying asset. So, for example, the Apple stock or a cryptocurrency like the Bitcoin. And in this contract, the trader can either bet on rising prices or falling prices. So both alternatives are possible here. And then as time goes by and prices move, the contract either expires or one party, typically the trader, terminates the contract. And then depending on whether prices of the underlying went up or down, either the trader or the broker is obliged to compensate the other party. And this is also called cash settlement of the contract. So in the unfavorable case, if prices moved into the wrong direction for the trader, he has to compensate the broker. And otherwise, if prices moved into the right direction for the trader, then the trader receives cash compensation from the broker. So that's, of course, the desired outcome. And now let's have a look at some characteristics of a derivatives trade. So typically the trader will never become the owner of the underlying asset. So there's just a derivatives contract between the trader and the broker. And as a side note, in some contracts, there is indeed a physical delivery of the underlying asset. But this is beyond the scope here of this course. So typically in our transactions, the trader will never become the owner of the underlying asset. And therefore, the trader doesn't pay a price for the underlying asset, but he or she needs to post a margin to collateralize the potential cash settlement obligation. So we have seen before that if prices move into the wrong direction, the trader have to compensate the broker. And at the beginning of the deal, the broker requires some collateral. And typically the trader has to post a margin, so a cash collateral. And now comes probably the most important aspect here. So typically the margin requirement is much less than the price of the underlying. And this allows derivative traders to make high losses and of course also high profits with only few cash in the pockets. And this is also referred to trading with leverage trading. And we will see this in more detail in one of the next sections. And finally, there's another advantage of derivatives trading. So typically traders can benefit from rising and falling prices. So they can bet on rising and falling prices of the underlying asset. And this allows traders to increase potential profits, but of course also losses. So this was a short introduction and a short comparison, spot trading versus derivatives trading. And in the next lecture, I will give you a very simple and illustrative example. Thanks for watching and see you there. Bye. All right, here's a simple example that demonstrates how spot trading and derivatives trading can work in practice. So generally there are two possible cases. Either we can expect rising prices or we can expect falling prices. And first of all, let's have a look at rising prices. So we have the traders A and B, and they expect the price of Bitcoin to rise in the near future, so relative to the US dollar. And the current Bitcoin price is, for example, 40,000. Then to benefit from rising prices, Trader A does the following. So Trader A is a spot trader, and he buys, for example, one Bitcoin for 40,000 US dollars in the market. And then 5 days later, the Bitcoin price has increased to 45,000. And then Trader A decides to sell the Bitcoin and to realize the profit. So a profit of 5,000 US dollar. And to sum up, so he realizes a profit of 5,000 with an initial investment of 40,000. So that's pretty great, but let's compare this to the derivative trader. So trader B is a derivatives trader, and he bets also on rising Bitcoin prices with a long contract in the Bitcoin worth 1 Bitcoin. So if a trader expects rising Bitcoin prices, then he should go long the Bitcoin. And if he expects falling prices, then he should take a short contract, so long and short. And now let's assume that the margin requirement is 50%. And in our case, this means 50% of 40,000 is 20,000. And the trader has to post a margin of 20,000 to the broker. And if the price moves into the wrong direction, so in our case, if the price falls, then the margin of 20,000 serves as a collateral for the broker. So the broker requires a collateral. But in our case here, the price doesn't fall. So after 5 days, we are at 45,000. And trader B decides to terminate or to close the contract. And by doing so, he realizes a profit of approximately 5,000. So he gets a compensation from the broker, a cash compensation of 5,000 approximately. And I've written here approximately because depending on the derivative, it's not necessarily exactly the price difference between 40,000 and 45,000. So approximately 5,000. And he actually realizes 5,000, the profit 5,000, with an initial investment of only 20,000. And we can conclude here that the profitability or the return of trader B is twice as much as trader A. So trader A invested 40,000 and the trader B only 20,000 to generate a profit of 5,000. And this is the impact of leverage. So we have here a margin requirement of 50%, and this is equivalent to a leverage of 2, so 2 to 1. All right, this was the rising prices. And now let's move on with the expectation of falling prices. So now traders A and B expect the price of the Bitcoin to fall in the near future. And again, the current price is 40,000. And now let's have a look how the spot trader can benefit from falling prices. And typically spot traders can't directly benefit from falling prices. But yes, if a spot trader already owns the asset, he or she can sell the asset to avoid losses if the price goes down. But a spot trader can't generate direct profits with falling prices. And if the spot trader doesn't own the asset, then he or she can't benefit at all from falling prices. So now let's move on with the derivatives trader. And trader B bets on falling Bitcoin prices with a short contract worth 1 Bitcoin. So to say, he shorts the Bitcoin. And also here the margin requirement is 50%. So he posts a margin of 20,000 to the broker. And 5 days later, the Bitcoin price slipped to 35,000. And then trader B terminates or closes the contract, and he realizes a profit of approximately 5,000 with an initial investment of 20,000. So this was a simple example how spot trading and derivative trading works in practice. And now let's conclude. So we have spot trading and derivatives trading. And typically spot traders can only benefit from rising prices. And typical strategies are buy and hold and active long only strategies. So of course, spot traders can buy the asset when they expect rising prices, and they can sell the asset when they expect falling prices. And typically, spot trading is not really restricted by regulators. And now let's have a look at derivatives trading. So derivatives trader can bet on rising and falling prices because they can take long and short positions, and therefore they can actually follow active long-short trading strategies. So we will see some examples of active long-short trading strategies in this course. Now, most important, leverage increases the volatility and it amplifies the profits and losses. And therefore, high leverage also means high risk. And this is the reason why derivatives trading is restricted in many countries by the regulators. And the reason is that they want to protect retail traders. So that's a pro, actually. And in many countries, derivative trading is either completely prohibited or there exist different leverage rules and limits for different asset classes. So for example, you can take more leverage for traditional currencies like euro, US dollar than for cryptocurrencies. But this depends on the country. And finally, the question is the leverage equally desirable or useful for all asset classes? And the general rule is that the more volatile the underlying asset itself, then the less desirable or useful is additional leverage. And for example, this means that if the volatility of the underlying asset is low, then a high leverage of 30 to 50 can be beneficial and also manageable for experienced traders. And let me just highlight here the two words experienced traders. And one example of an underlying with low volatility is the currency pair euro US dollar. And in contrast to that, if the volatility of the underlying asset is high and cryptos are typically highly volatile, so like Bitcoin, then no or moderate leverage, for example 2 to 5, is better than high leverage. So to sum up, in this course on algo day trading, we will select derivatives trading as it allows us to benefit from rising and falling prices, so we can take long and short positions. And second, we can trade with leverage, and this means we can generate high profits, but of course also high losses with only a small investment amount. So we don't need a lot cash in our account to start trading. So this was a short overview of spot trading versus derivatives trading. Thanks for watching and see you in the next lectures. Bye. Now, part 1 of this course is all about day trading, forex, indices, commodities, stocks and more. And as this is a very practical course, our goal is to trade with real brokers. And the good news is that this course covers 3 different brokers. So I've added interactive brokers most recently, and no matter in which country you are, at least one broker should work for you. So let's have a quick look where we are, and we are in the prerequisites part, and in the next couple of sections and lectures I will explain the mechanics of day trading in detail. So we need to understand how it works before we can define, test and implement trading strategies. And as I said, we will cover 3 different brokers, so Wanda, interactive brokers, and FXCM. And the question is now, so why do we cover those 3? And they are probably the leading CFD and Forex brokers with a high reputation, so that's always important. And also they provide a powerful API. So API stands for Application Programming Interface. And this allows us to not only manually trade, but also to connect with Python and let Python do the job for us. So automated and algorithmic trading with Python and the broker APIs. Now, the interesting question is which broker should you prefer? And there's actually no clear answer because on the one hand side, so the products slightly differ and not all products are available in all countries. So for example, on interactive brokers, you can't trade CFD contracts if you are located in the US. And even more important, so these brokers are not available in all countries. So at least this holds true for Rwanda and FXCM. So interactive brokers is more or less available in all possible countries. So there's hardly any country that is not on the interactive brokers list. And now let me give you some recommendations. So which broker should you use? And if you are located in India, Japan, and South Korea, then you have no choice anyway. So you only can create an account on interactive brokers. And with regard to United States and Canada, so you can create accounts on Rwanda and also on interactive brokers. However, on interactive brokers, you won't have access to leveraged Forex trading with margin. So you won't have access to CFD trading. So if you are located in the United States and Canada, and if you want to trade Forex with leverage, then Rwanda might be the right choice here. Now, for many other countries, there's no clear recommendation. So typically, you can create accounts on 2 or all 3. And in my opinion, you should either select Rwanda or interactive brokers because the API of FXCM is at least most recently a bit unstable, but of course this can change. So this is the fallback solution if you don't want or you can't work with Rwanda and interactive brokers. And now let's compare and let's have a look at some more pros of these 3 brokers. So probably the API stability is highest for interactive brokers, and also the available country list, so more than 200 countries, and also the number of tradable assets is highest for interactive brokers. So only interactive brokers allows stock trading, for example. And finally, coming to an important aspect, so trading costs. And we can say that interactive brokers is very cost efficient, in particular for very large trading sizes. And on the other hand side, Rwanda and FXCM are cost efficient also for very small trading sizes. And this is due to the fact that on interactive brokers, we have a minimum fee or commission that we have to pay for each and every order. And this is not the case on Rwanda and FXCM. So the trading costs on Rwanda and FXCM are variable trading costs depending on the trade size. And this makes trading of very small trading sizes also cost efficient on Rwanda and FXCM. So these are some tips for you, but I recommend that you just have a look at all 3 brokers and check which one is the best choice for you. And now finally, let's have a quick look what we will cover here in part 1 of the course. So we will continue with section 3, day trading with Rwanda from A to Z, a deep dive. And this section is mandatory for everyone. So no matter if you have an Rwanda account or not, because there I will explain the basics of day trading from A to Z in detail based on examples taken from Rwanda. And then in section 4, I will introduce interactive brokers and highlight some differences between Rwanda and interactive brokers. And the same we will also do here in section 5 with FXCM. And once again, there's no need to create accounts for all 3 brokers, so one account is totally fine and sufficient. And then in section 6, we will start with Python and the installation of the Anaconda distribution, followed by probably the most important coding section of this course, so section 7, how to avoid and debug coding errors, very important. And then finally in section 8, I will introduce API trading with Oanda, interactive brokers, and FXCM. So this is part 1 of the course, and I'm looking forward to seeing you there. Bye. Alright, this is an introduction to the Oanda website, and I will give you a short overview of the content and information that can be found on that website. So it's oanda.com. And depending on your location in your country, you might see a slightly different website. And in particular, if you are located in the United States, then available products and also some terms and conditions are slightly different. So we will see that in a minute or two. And now let's have a look here. So we have different products, and we are actually interested in the trading. But there are also products and services for foreign exchange data services and also for FX payments. So let's click on CFD trading. And first of all, we can see here a very important risk disclaimer. So CFDs, which stands for Contract for Differences, are complex instruments and have a high risk. So almost 75% of all retail investors lose money when trading here with Oanda. So you should definitely know and understand what you are doing here. And that's exactly the purpose of this and also the next videos. And let's start with the products. And first we have Forex, and that's trading with foreign exchange or currencies. And also I can trade with indices like the Dow Jones Industrial Average Index or metals and other commodities and also bonds. And for all of these products, we can get some more information, so an overview and information on spreads and margins. And we will go more into detail here further down the road, and hours of operations and more, pricing, charges. So we will cover most of the things here later on. And actually CFDs on stock indices and commodities are not permitted in the US, and therefore US residents have only access to Forex trading, which is no problem because our focus in this course is clearly on Forex trading anyway. But we can also go here to the US website. So currently we are here in the rest of the world website. And now if we go to the United States, so if you are located in the United States, then you can see the following here. So we only have here Forex, but again, this is no problem. And now let's go back to my website, actually. So rest of the world, for instance, here Germany. Next, we have different platforms, and we will see this in 1 or 2 minutes in more detail. And we have some more tools here. And now probably the most important category is Learn. So getting started, and if you haven't worked with Oanda before, and if you are completely new to day trading, then you can get here a lot of information. So let's click here on New to Oanda. And as I said, there are different platforms, so we can either use the browser-based trading platform, or we can also use mobile apps. And we also have the option to download a software and create our desktop platform, which provides some more options and flexibilities. But here in this course, we will create and use our own platform with the Oanda API and Python. But in the next videos, we will also work here with the browser-based platform for some example trades to get familiar with day trading. And actually, the browser-based platform is totally sufficient for that purpose. So we don't need to download here anything. And once you are ready for live trading with real money, you can also create a live account and fund your account here with a credit card or PayPal. Now here we can find some more information on margin and leverage, and I will explain margin and leverage in some more detail in one of the next lectures. Then next here we can see trading hours, and typically trading is available from Sunday 5 p.m. to Friday 5 p.m. New York time, but this also depends on the instrument. Then here you can see some help and support. And also we can find some more information on the Uanda API. So we will heavily use the API to actually automate our trades with Python. And there are also some learning videos here from Uanda, and it's worth actually to have a look at them. And actually it's highly recommended to start with a demo account and trade only with virtual money, so not real money. And in one of the next videos, I will show you how to create a demo account. So please do not create a live account at this point in time here. So it's too early actually. And finally, here we can get some more information and the basics of trading and some tools and strategies, and also capital and risk management. And actually it's worth spending some more time here on the website and going through the content here to get familiar with the basics of day trading. However, I will explain most of the things here in the next videos in a very practical and hands-on way. So I will execute a few example trades and explain the full mechanism and the terms like spread, margin, bid and ask prices, pip and more based on these example trades. And I think that this is the best way to really understand how it works. But of course, feel free to have a look here at tools and strategies and more. Next, you can find here a news feed, Market Pulse, and here you can find updated news on financial markets and also some technical analysis. So feel free to have a look also here at this. And let's go down here. And finally, we have here some legal documents with some more information, depending on your location. So in one of the later videos, we will also cover margin rules and margin rates. And it's definitely worth to have a look here into the trading documentation and also add some key information for the products. So for CFD Forex or CFD indices, let's have a look here. So this is the key information document with many more information. And also here you can find a risk indicator, and we are actually in the highest risk category. So there are many more things that you can discover here, but the most essential and the most important things we will cover in the next lectures and videos. Alright, here's a little update as of May 2023. So the Uanda website slightly changed in some regions, for example here in Europe. And that's here the new design, and also the content slightly changed and was actually reduced. So the European website is less informative now, but there's a little trick how you can still go to the old website. So this is here the localized website for the EU in English. And now you can change the region in the URL. So for example, from EU to UK or also Australia. So you can either use EU or Australia. And then you can check here the Australian menu and go to trading, Forex and CFD trading. And this now looks pretty much like the old version. So you can check here products, which can slightly differ in Australia, of course, than the platforms, than tools, and maybe most important, the learning section. So this is how you can get the old website So with the old design and the old content, so the more informative content actually. Thanks for watching, and see you in the next lecture. Bye. In this video, I will show you how to open an Oanda demo account and how to navigate through that account. So let's go to trading. And here you can either create a live account, start trading, which isn't recommended at this stage, or a demo account, try demo. And actually, demo account isn't the right word for it. So a demo account is typically an account with a limited functionality or an account that expires after a while. And this is not the case here. So the Oanda demo account offers pretty much all options and functions of a real live account, but in a safe environment with just virtual funds. So there's no risk of losing real money. So the demo account is also called FX Trade Practice Account, and that's actually more appropriate. So the practice account is an essential tool for algorithmic trading, not only for day trading beginners, but also for experienced traders with a live trading track record. So complete day trading beginners should always start here with a practice account. And a practice account allows you to just play around and make example trades to understand how it works without the risk of losing any money. But also experienced algorithmic traders frequently use the practice account. And whenever you have created a new and promising algorithm that seems to perform well in in-sample and also out-sample tests, or to say backtesting and forward testing, it is nevertheless highly recommended to further test your new algorithms for a couple of days or even weeks in a real-time environment. And to avoid any losses in that testing period, you should use the practice account. And again, the live account works pretty much in the same way as the practice account, so we don't miss anything here, and we just don't have any risk to lose real money at this stage. So here we can sign up to the practice account in minutes, and we have unlimited virtual funds, and the account never expires. So it pretty much offers the same trading experience as the live account. So first of all, you have to insert here your name, your email address, and also determine a username and a password. And most important, you have to insert your country or region. So for example, United States. And this works. But as I said before, Oanda is not available in all countries. So if you try to insert here India, then you get the following message: sorry, Oanda cannot accept new clients from India. So you will be unable to open an account here. And that's actually the reason why I also added a second broker, FXCM. But of course, the mechanisms here are the same. So there are only a few differences between Oanda and FXCM that I'm going to highlight in the section covering the FXCM platform. And as I will explain the basics and mechanisms of day trading with Oanda, please watch this and the next videos, even if you are not able to create an account here on Oanda. So it's no problem at all to follow and understand the videos in case you don't have an account here. And finally, once you have inserted all information, you have to click on sign up. And then you can go here to sign in. And here we have the choice between FX trade. So this is the live account with real money, or the practice account. And of course, we select here the practice account. And we have to insert here our username and the password. And finally, let's click on submit. Here we are in our practice account. And first of all, let's have a look at the manage funds. And typically you are starting with one account, the primary account, with 100,000 euros or dollars. So that's of course just the virtual money, so no real money. And you can create new sub-accounts by clicking here. So I have a secondary euro account with 0 euros. And also I have a US dollar account with $100,000. So this is here my primary account, and I have the T20 account number, which we need later when working with the Oanda API. Then the balance is 50,000 euros, and we have some more information, and we will have a closer look here further down the road. And actually we are flexible to deposit or withdraw money. So let's assume that we want to withdraw 25,000 euros. Then we can click here and just type in 25,000. Continue. And by doing so, we have successfully withdrawn 25,000 euros. And then we can also deposit, say, 50,000 euros to our secondary account. So let's click on deposit. So this would be great if it's real money, but of course it's just virtual money. And now we have 50,000 euros here in the secondary account. So let's go back here to the overview. And we have some more options here. And also here we can create a sub-account. We can have a look at the trading history. And we can actually download the desktop trading platform, or also the MetaTrader 4. So that's 2 platforms, but we don't use them. And finally, here we can find the link to the browser-based trading platform. And we will use this in one of the next videos. And then we can find here some more services. So later we need to create an API token to use the Oanda API. And for instance, we can also change the password here. Alright, this is a little update as of May 2023. So there are some countries and regions where Oanda isn't available at all. And there are other countries and regions where there's no fully functional demo account available, so including API support. But what I'm going to do now is I will show you a little trick that allows every one of you, so really everyone, to create a fully functional Oanda demo account, no matter in which country or region you live. So let's go back to the previous lecture, so creating a fully functional demo account in all countries and regions. And as I said before, so Oanda recently changed the demo account in certain regions like Europe and Latin America with less functionality. So for example, without API support, which is important for trading with Python. However, there's a little trick that allows you to still create the original and fully functional demo account. And this is here now explained. So there are 4 easy steps. And first of all, you have to click here on the link to apply on a demo account. And first of all here, you have to select the country. And now it's important to select here Australia as country. So you can simply search for Australia. And then you can leave here your account details and create a password. And then you have to type in some personal details. And finally, you have to leave your mobile phone number. And this is important now. So you can insert and use a random Australian telephone number of the following format. So you have +61 and then followed by a 4 for Australia. And then there are 8 X's, so 8 places left. And you simply should fill in here the 8 X's with the random numbers. So you have to create here a valid random Australian phone number. And then with this, you are able to create an Australian demo account. And once you have created the demo account, you shouldn't forget to always use here the following link. So the link to the Australian Oanda website to log in. And otherwise it won't work because you will be redirected automatically to your local website. So whenever you want to log in to your demo account, you have to use here the Australian Oanda website. So that's here the little trick that allows every one of you to create an Oanda demo account. Thanks for watching and see you in the next lectures. Bye. In this and the next lectures, we are going to trade the currency pair Euro US dollar, and we will deeply analyze the results of our trade to really understand the mechanics of day trading. And I will also explain terms like bid and ask prices, margins, pips, and more. And I'm here on my practice account, and we can go to the browser-based the trading platform by clicking here. And here on the right hand side, we can see the price chart for Euro US dollar, but we can also select other currency pairs. And here on the left hand side, we have an overview on the other currency pairs, for instance, Australian dollar and Canadian dollar. But before we trade currencies, we should understand the very basics of exchange rates. And there's actually a great learning resource on the Oanda webpage. So let's have a look here. Let's go to trading and to learn getting started, new to Oanda. And let's scroll down. And here we can find the trading essentials. And here we have the exchange rates and the quote panel for the currency pair Euro US dollar. And this looks actually familiar, so we can have this here, or we could also find this here on the left hand side. So here we have Euro US dollar. And actually currency pairs on Oanda are always listed in the same order. So there's only the pair Euro US dollar and not the pair US dollar Euro. But of course you can trade in both directions. And actually the convention is that the first currency is the base currency, it's the euro. And the second currency is the quote currency, so the US dollar. And then the exchange rate indicates how much of the quote currency, so how much US dollar we have to pay to actually get 1 euro. Or if we sell euro, how many US dollars we get for 1 euro. So now example here, if we buy 1 euro, then we have to pay $1.05772. And if you want to sell 1 euro, then we get here 1.05761 US dollar. So in total, we have here 2 different prices. And depending on whether we want to buy euro or sell euro, then one of those 2 prices apply. And the rule is actually pretty simple. We always get the less favorable price. So if we want to buy euro, then the higher price applies. So we have to pay more for 1 euro. And whenever we want to sell euro, then we get the lower price. So again, in our example here, if we want to buy 1 euro, we have to pay 1.0577. And if we sell 1 euro, then we only get 1.0576. And actually the buy price is also called the ask price, and the sell price is the bid price. Now, as you can see, there's a difference between ask price and bid price, and that's also called here the spread. And the spread is actually the profit that the broker, so Oanda, makes here in a trade. And Oanda actually contracts with both parties, so parties who sell the euro and buy the euro, and the profit is the spread here. And typically the spread is displayed in so-called pips. In our example, the difference is here 1.1 pip. And as a general rule, the fourth decimal place is 1 pip. So we have here the first decimal place, the second, the third, and the fourth. And Oanda provides also a fifth decimal place, but the fourth is actually 1 pip. And actually price changes or price moves and also differences between exchange rates is measured in pips. And in our example, it's here 1.1 pip. So the bid-ask spread in our example is 1.1 pip, and that's actually the profit of the broker. And from our perspective as investor, this is actually costs or trading costs. And the higher the spread, the higher the costs of the transaction, and the lower the efficiency of our transaction. So in day trading, it's more likely to make profits when the spreads are low. All right, let's scroll further down here. So we have here a description of currency pairs and base and quote currency. Then we have the spread here. We have bid prices and ask prices. And also here we can see what is a pip. Now the question is, why are Forex trades so popular? And first of all, the Forex market is the largest and the most liquid market. And as a direct consequence, whenever liquidity is high, then spreads and transaction costs are low, which is good for us. And finally, currency exchange rates are typically more volatile than stock indices. And to make some profit, then it's good if we have some volatility in the prices. So let's go further down, and also you can watch a video here. Now, the most important question is, how can we make money with Forex trades? And the basic idea is that a currency appreciates either or depreciates in relation to another currency. And appreciation means increase in value, and depreciation decrease in value. So let's have a look at an example. We have our currency pair Euro US dollar, and there are two scenarios. So either we expect that the euro appreciates relative to US dollar, so it increases in value, and so to say the US dollar decreases in value. And in this case, we should actually buy euro and click here on the ask price or the ask side. And in contrast to that, we have scenario 2. So we expect that the euro will depreciate relatively to the US dollar. And in this case, we should sell euro. Finally, let's have a look at some more vocabulary. And in Forex trading, there are a couple of terms that actually mean the very same thing. And also we will use those terms interchangeably. So if we expect the euro to appreciate in value relatively to the US dollar, we should buy euro. And interchangeably, we can also say that we should take a long position in the euro, or that we should sell US dollar, or take a short position in the US dollar. And if we expect the euro to depreciate against the US dollar, then we should sell euro or take a short position in the euro, or buy US dollar or take a long position in the US dollar. Finally, no matter which position we have, we shouldn't forget to close position at some point in time, and we can do this with the reverse transaction. So initially, if we buy 1,000 euro here, then at some point in time we should close the position by selling 1,000 euro. Alright, this was a short introduction to currency exchange rates, and in the next lecture we are going to buy euro or take a long position in the euro. So hope to see you there. Bye. Alright, we are back again here in the browser-based trading platform, and now it's time for a trade. So let's assume we expect the euro to appreciate relatively to the US dollar in the next couple of minutes. Then we should actually buy euro. So to say, we take a long position in the euro. And first of all, here we can select the account from which we want to trade. And I select here my US dollar account, where I have a balance of $100,000. And here on the right hand side, we can see that I have no open trades, no open orders, and no open positions, and some past activities that we can ignore. So let's go here to buy. And first of all, we have to select the order type. So we have the choice between market order, limit order, and stop order. And the default setting is the market order. And we will have a closer look into order types later on, But for our purposes, we select the market order that executes the order immediately at the current price, which is here. That's the current buy price. So execution is guaranteed with a market order. And next we have to determine the units that we want to trade. And the default setting is 1000 units. And in this case, this stands for 1000 euro that we can buy. And here on the right hand side, we see the trade value. It's 1177 US dollar. So actually we would buy 1000 euro and pay 1177.5 US dollar. So let's increase units to 100,000. And here we can see units available. So 2.5 million. So now in this trade, we buy 100,000 euros and we pay $117,000. So let's click on submit. And now we have here an open trade. And we can see that the market is euro US dollar. We have 100,000 units and we have a long position. And the most important column is probably the profit column. So here we can see our current profit. And currently we are negative. But actually, let's wait until we reached a positive profit. So we have here an open trade. But we don't have an open order. But we have also an open position, so the 100,000 units in the euro. And also here we can see the most recent activity. So actually we have bought euro here. And still we are negative. And actually there are several ways to close a position, and the simplest way is by just clicking here on the X. So close the position. And now we are positive, but of course we want to increase our profit. So let's wait some further seconds or minutes. And now let's click here on submit and let's have a look here. So we closed the position and our profit of this transaction was $16, which isn't too bad actually. Now here in my activity sheet I can see 4 additional entries. So we actually had the market order, and immediately after that, or at the very same time, then we actually purchased euro, and then a couple of minutes later we had the sell order and we closed the trade. And the total profit of our transaction is $16. So in the very next video, we are going to analyze the trade here with Excel. Thanks for watching and see you there. Bye. In this and the next lectures, we are going to analyze our transactions step by step to understand the mechanics of Forex day trading. And I have here a screenshot taken from the trading platform with the most recent activity. So in total, we have here 4 entries. And first of all, we have the market order to buy 100,000 units of the instrument euro US dollar. So to say, to buy 100,000 euros. And the market order is at 15:46 and 10 seconds. Now, a market order gets executed immediately. And therefore, we have at the very same time our first transaction or our first trade. So we buy 100,000 units of euro US dollar at a price of $1.1775. Then next we have here half spread cost, and we will have a deeper look here in the next lecture on this column here. Then next, by definition, when we open a position, so in this trade we open a long position in the euro. So the trade where we open a position has a profit of 0 by definition. Then we don't pay any commissions, and our initial balance is $100,000. Then 2.5 minutes later at 15:48 and 49 seconds, we send another market order to sell 100,000 units of euro US dollar, so to say, to close our trade. And then as also this is a market order, it gets executed immediately. And here we have the close trade at the very same time. So we sell 100,000 euros at a price of $1.17791 per euro. And here we can see the profit of our total trade here. So typically a complete trade consists of 2 trades. So the trade where we open a position and the close trade. And the total profit is $16. And then consequently our ending balance is 100,016. Now in the next couple of minutes I will explain in more detail how the profit of $16 is derived, and I will also explain and calculate the trade value and the profit in US dollar and also the profit in terms of pips and the pip value of the transaction. So we are starting here with our first trade and we buy 100,000 units at a price of 1.17775, and this is actually here the ask price. And then we can actually calculate the US dollar trade value, and this is simply units times the price. So we buy 100,000 euros and we pay $117,775. And actually when executing the trade on the platform, there we can also see the trade value. So let's go to the platform here. And now if we try to buy, again, for instance, 100,000 euros, then here we can see the trade value in US dollar. And now 2 minutes later, we actually closed our position by selling 100,000 euros. And we receive actually the following trade value in US dollar. And again, we just multiply units by the prevailing price. So we receive $117,791. And with this, it's pretty simple to calculate the profit. So by definition, the profit of the initial trade is 0. And then the profit of the total trade is this here minus the initial trade value. And we get here $16. So we could say that we earned $16 on our trade, but it's actually also very common to say that we earned 1.6 pips. And irrespective of the number of units, the profit in terms of pip is 1.6. And actually calculating the pip profit is pretty simple. So we know that we can find pips in the 4th decimal. So here we have 5 decimals. And we can see an increase in exchange rate from 7.5 pips to 9.1 pips. So this is an increase of 1.6 pips. And we can simply calculate this by taking here the increase in brackets times 10,000. So it's the 4th decimal. And here we get 1.6 pips profit. Another very common metric is the pip value in US dollar. So the value per pip. And actually, if we only have 1 unit, then the pip value in US dollar is $0.0001. So to get the pip value, we simply have to do the following calculation. So 0.0001 times the number of units. And this gives a pip value of $10. And once we have the pip value of the transaction and the profit in pips, then we can also calculate the profit in US dollar. And this is actually the profit in pips, 1.6 times the pip value. It's 16. Last but not least, we can also calculate the final balance. And this is a no-brainer. So it's the initial balance plus the profit or the loss. And this gives a final balance of 100,016. Alright, this was the profit calculation, and in the next lecture we will have a closer look into costs and spreads. So hope to see you there. Bye. Alright, in this lecture we analyzed trading costs that we had to incur in our trade, and also we try to split up our performance into gross profit, trading costs, and net profit. So our profit of $16 actually the net profit after costs, and it does reflect the price move during our trade and also the transaction costs. Now, trading costs are typically underestimated by most retail traders, so trading costs seem to be low, but as we will see in the next couple of minutes, the trading costs are actually pretty high, even for cost-efficient pairs like euro and US dollar. And one of the major reasons why almost 75% of our retail traders lose money with day trading is that excessive trading typically eats up the complete profit and more. So successful trading requires full cost awareness, and only those strategies will be successful that take into account trading costs. Now let's have a short recap, and we have already learned that we can buy euro for the ask price, which is higher than the bid price, so we can sell euro for the bid price. And actually the difference between bid and ask price is the spread, and in this case it's 1.4 pips, so the spread is typically measured in pips, price interest points. Now, having the bid price and the ask price, we can also determine and calculate the hypothetical mid price, and this is simply the price that is between the bid and the ask price. So let's focus here on the pips. We have 6.0 and 7.4, and the middle is actually 6.7, so that's here the mid price. So we should keep in mind that the mid price is only a hypothetical price, so we cannot trade at the mid price. However, the mid price helps us for performance attribution, so we will see this in a minute. And now let's assume that we can buy and sell euro at the very same point in time. So first of all, we buy euro at the ask price, and then we sell it at the bid price, and we end up with a loss that is equal to the spread. So as we execute both trades at the very same point in time, there is actually no change or no move in the exchange rate itself, but we lose actually the spread. But of course we don't open and close positions at the very same point in time, so we wait some time to get profits by price moves. But this example is pretty intuitive and shows that in a full transaction, so we open a position and we close a position, we lose the spread as the transaction cost. Now typically the spread also changes over time, and we have typically different spreads for both transactions, and therefore in a full transaction, including an open trade and a closed trade, traders lose the average spread. So let's assume that we buy euro at a spread of 1.4, and then after 2 minutes we sell it at a spread of 2.0, then the average spread is 1.7. And it's really important to understand that the spread is the profit for the broker and the loss or the trading costs for the trader. So this is just lost money. So in a full transaction, traders lose the average spread, and that means that in each and every trade, traders lose the half spread. And this is also called half spread costs. And this is here the theory, and let's have a look here into our example. And first of all, let's determine the spread that we had during both trades. And actually we can derive the spreads from the half spread cost, but the other way around makes actually more sense. So actually the spread in our first trade was 1.6, and the spread in the second trade was 1.9. Now, having the spreads in pips and the pip value of our transaction, we can also calculate half spread costs of both trades. And this is simply 0.5 times the spread. times the pip value. And this gives half spread costs of $8 for the very first trade. And we can find this here. And actually costs are negative, so let's change the sign here. And the same we can also do for the second trade. So half spread is actually 0.95 pips. And then times the pip value. And this gives transaction costs for the second trade of $9.5. And also here let's change the sign to minus. So in the full transaction, we actually incurred transaction costs of in total $17.5, which is actually pretty high. And a spread of 1.6 or 1.9 pips seems to be pretty low. So 1 pip is here actually the fourth decimal. But if we have a considerable trade value or volume like here, then we incur substantial transaction costs. Now in the next step, let's calculate the hypothetical mid prices. And first of all, let's focus on the first trade. So here we have the ask price, and we have to deduct from the ask price the half spread. And then times 0.0001. And this is the hypothetical mid price. Next, let's also calculate the mid price for the second transaction. And we simply have to add the half spread to the bid price here. So this is the hypothetical mid price for the second transaction. And now finally, let's come to the performance attribution. So we want to calculate gross profit before costs and also trading costs. And actually, we want to calculate profits and costs in US dollar terms, but also in terms of pips and also in percentage changes, so to say, returns. Now, the question is, how high would be our profit without any trading costs? And we can calculate this with the mid price. So the mid price does not include the spread and trading costs. And therefore, we can calculate the increase in the mid price based on the number of units. So we have here the difference times the number of units. And this gives a gross profit of 33.5 US dollars. And this is simply the price change or the price move in the exchange rate, US dollar euro, in that 2 minutes here. And we can also display the gross profit in pips. And again, we can calculate here the increase and then in pips, so times 10,000. And we could also say that we realized the gross profits of 3.35 pips. Finally, we can also calculate the return, so the percentage change. And the initial trade value was 117,775. So this is our investment. And we realized $33.5. And therefore, the return is the profit divided by the investment. And here we have a return of 0.0284%. So this is the gross return before trading costs. And now let's go here to trading costs. So the total costs are simply the sum of the half spreads. And in total we have $17, 17.5. And therefore the net profit is 16. So as you can see, more than 50% of our gross profit was eaten up by the trading costs. Next, let's calculate the trading costs also in terms of pips. And this is simply the average of the single spreads. So we have here the spreads in each transaction divided by 2 is 1.75. And again, let's change here the sign. So our gross profit in terms of pip was 3.35, and we lose 1.75 pips and end up with a net profit of 1.6 pips. And finally, let's also calculate the impact of trading costs on our return. So it's simply the costs divided by the initial investment. Now you might say that costs of $17 for a trade value of over $100,000 isn't too high, but typically in day trading we trade back and forth many times. And let's assume that we have 100 full trades per day, then this means daily trading costs of almost $2,000. So our strategy must be good enough to cover the trading costs of $2,000, and on top of that it should generate a profit. And that means that our strategy must generate daily returns of 2% and more. And with simple or conventional strategies that are human digestible, it's almost impossible to make daily returns of 2% and more before costs over a longer time period. And again, that's the major reason why most day traders lose money. So transaction costs are really important. And with this, we have reached the end of this topic here. Thanks for watching, and see you also in the next lecture. Bye. All right, we have successfully traded 100,000 euros and made an after-cost profit of $16. And now the question is, why can we make a trade worth more than $117,000, even though we only have 100,000 US dollars sitting on our account? And the answer is that Wander supports trading with leverage, meaning that you can enter into positions larger than your account balance. So 117,000 is larger than our account balance here. And Wander allows us to trade without depositing the full value. And one of the benefits of trading with leverage is that you can potentially generate large profits relative to your amount invested. So that means high returns. But on the other hand side, the trading with leverage could also result in significant rapid losses. And potentially you can lose your complete funds. So leverage increases not only positive but also negative returns. And it increases the risk of trading. So we do not have to fund the full investment or the full trading value of 117,000. And instead, Wander requires a form of security or deposit against losses that we might occur in our trades. And this collateral is typically referred to as margin. And actually, the margin required to open a trade or position depends on the instrument. And it also depends on whether you are a retail investor or professional investor. And finally, it depends on your country of residence. So the margins can differ. And of course, on the Wander website, you can find an overview on the applicable margin rates. So let's go to the website. And let's scroll down to legal documents. And here we have the margin rules and a more detailed description here. What is margin? And here I can find the Wander Europe margin rates. So depending on your location, you might find here the applicable US margin rates and so on. So these are the retail clients' margin rates. So here in this overview, we can find the minimum margins or maximum leverages for the instruments. So for instance, for the pair Australian dollar, Canadian dollar, the minimum margin is 5% of the trade value. And let's have a look for the euro US dollar. It's here. And here we have a margin requirement of 3.3%. And actually margin rates and leverage are two sides of the very same medal. So a margin rate of 3.3% is equivalent to a leverage of 30-1. And let's have a look here into our example. So here for the instrument euro US dollar, the leverage is 30. to 1, and the margin rate can be calculated by 1 divided by 30. So that's 3.33%. Now the question is, what is the required margin in terms of US dollar? And we simply have to multiply here the margin rate with the trade value, the initial trade value. And this gives a required margin of almost 4,000 US dollar. And this means that before we can execute our trade here and before we can open our position, we need to have at least $4,000 sitting on our account. And as we have actually 100,000, then this is no problem. So as long as the margin available is higher than the margin required, then we can execute trades and open positions. Now let's see this live in action in our trading platform. And I go to my practice account and launch the trading platform. And let's simply click here on buy. And again, 100,000 units. And the trade value is $117,000. And also you can see here the pip value, it's $10 if we have 100,000 units. And also we can see here the margin required, it's almost 4,000 and the margin available. So in this case, we can now execute the trade here. Finally, let's have a look at the difference between unlevered returns and levered returns. So in the last video, we actually calculated unlevered returns, but now let's also calculate levered returns. So we actually calculated the unlevered return by dividing the profit by the trade value, but this time here, the levered return, we divide the profit only by the margin required. So that's actually the amount that we really invest. And here we end up with a gross return of almost 1%. And the same we can also do for the trading costs. So we almost lose 0.5% of our margin only with trading costs. And now if we divide the levered returns by the unlevered returns, then we get here a factor of 30. So trading with leverage increases positive but also negative returns by the factor of 30 in this case, because we have a leverage of 30 to 1 that is equivalent to a margin rate of 3.3%. Now there's one last thing that I want to show you. You can reduce risk and increase the minimum margin rates by setting a maximum leverage in your account settings. So let's have a look how it works. And let's go to the practice account, manage funds. And for instance, to my dollar account. And here's the leverage. And the default setting is typically 50 or even 100. And we can change this here, for instance, to 10 or 20. And if we do that, then also here the margin rates change. And let's assume that we reduce the maximum leverage to 20. Then we have the minimum margin rate of 5% everywhere. All right, thanks for watching and see you also in the next lecture. Bye. In this lecture, I will explain some more terms like unrealized profit and loss, net asset value, margin available, and more. And I will also demonstrate the important concept of margin closeout. So let's assume that initially we have $5,000 on our account. So that's the balance here. And then we buy 100,000 euros for a trade value of $117,000. And as the required margin rate for this trade is 3.3%, we need approximately $4,000 as deposit to execute the trade. So we can open the position, and the margin used is then approximately $4,000. So this is here our open position. And actually the total margin used is the sum over all positions. So here we only have one open position, but of course we can have many open positions. And the total margin used is simply the sum over all positions here. Now, immediately after the trade, the current bid price should be slightly lower than the price that we paid due to the bid-ask spread. And let's assume we have a bid-ask spread of 1.7 pips. Then immediately after our trade, the current bid price should be around about this here. And the current bid price is the price at which we can close our position here and sell 100,000 euros. And of course, the current bid will dynamically move up and down. And at any point in time, we can calculate the unrealized profit and loss of our open position. And the unrealized profit and loss is simply the difference between the current bid price and the price that we paid times the number of units. So immediately after the trade, our unrealized profit and loss is minus $17. So that's actually the trading costs. And it's actually called unrealized because our position is still open. And once we close the position, then the unrealized profit and loss gets realized. Next, we can calculate the net asset value. And the net asset value is simply the amount sitting on our balance plus the sum of all unrealized profit and losses of all positions. So in our case, it's the balance of 5,000 minus the unrealized loss of minus 17 gives a net asset value of $4,983. So here we have one open position, but of course we can also open more positions. And at this point in time, the margin available is 1,057. So we can open more positions, and the maximum margin that we can use is this here. And this is simply the greater of 0 and the difference between the net asset value and the margin used. So in this case, it's 4,900 minus 3,900. Now, what happens if things move in the wrong direction? So actually, we expect that the exchange rate increases, but of course, it could also be the case that it decreases to, for example, 1.17. And in this case, now our unrealized loss is $775, and the net asset value is still 4,200. And still we have a margin available of 299. So that's 4,200 minus the margin used. Now let's assume that things are getting even worse, and the exchange rate moves to 1.148. And now we have an unrealized loss of almost 3,000. And still our net asset value is 2,000. But at this point in time, we cannot open an additional position because the margin available is 0. So the margin used is higher than the net asset value. Now, with a leverage of 30, in a way, the trader funds 3% of the open position, and the broker, so Wanda, the remaining 97%. But of course, the broker is not permitted to take any risk or any losses if the trade moves into the wrong direction. And therefore, before the losses of our trade completely eat up the margin or our net asset value, the broker will close the position. And this is called margin closeout. And the rule is as follows. So if our margin closeout value and the margin closeout value is more or less identical to the net asset value. There are minor differences, but for simplicity, let's assume they are identical. So if the margin closeout value falls to less than half of the margin used, then all open positions will be automatically closed. And actually, Wanda uses the current exchange rates at the time of closing. So in our case here, the margin closeout value is still higher than 50% of the margin used. But let's assume that the exchange rate further slips to 1.147. And in this case, the margin closeout value falls to less than half of the margin used. And the vendor will close the position here. And we will realize a loss of more than $3,000. So the key message here is that the vendor will close our position before all of the $5,000 are eaten up by losses. So that's actually a buffer for Wanda. And if you want to know more, you can have a look at the Wanda website. Under legal documents, you can go to margin rules. And also here you can find a detailed description of what is margin closeout and also how to avoid margin closeout. So if you want to open that position here, it might be a good idea to have a balance higher than 5,000 to have more buffer, say 8 or 10,000. And of course, it's also a good idea to monitor the status of your account and check whether you are close to a margin closeout. So feel free to have a closer look here. Thanks for watching and see you also in the next lecture. Bye. I'm here on the Wanda trading platform, and here the large window is all about charting. So price charts are an important tool for day trading, and there are many options and different charts. However, the most commonly used type is the candlestick chart. And here we have the candlestick chart for October 2020. And each of the bars here is one candle. For example, here we have the candle for the 13th of October. Then next we have the candle for the 14th of October and so on. So each candle here is for 1 day. And we could also say that the granularity is here 1 day. And we can see this here. So let's have a closer look into candlesticks. Now, candles can be either green or red. And it's no surprise that green candles signal a price increase for that day, and the red candles a price decrease. And actually, a candle shows 4 different prices: the open price, then the close price. And here with the green candle, the open price is the lower price, and the close price, the higher price. So the price increases over the day. And here with the red candle, we have the open price here above, and the close price is below the open price. So these are the 2 most important prices, and together they form the body of the candle. And then we also have the upper shadow and the lower shadow. And actually here in the upper shadow, we see the daily high price, and in the lower shadow, the daily low price. So there's a lot of information in a candlestick chart, intuitively presented for the human eye. And for example, let's have a look here at the candle for the 15th of October 2020. So in the morning, the price starts here. So this is the open price. And then over the day, the price decreases to the closing price or close price. And here we have actually the high price, the daily high price, and here the low price. And then in the next day, it's the 16th of October, the candle starts here at the open price, and then we have here the close price and so on. And actually you can go with your mouse cursor here on a candle, and then you can have a look here at open, high, low, and close prices, so the numbers. So to sum up, a candlestick chart is made for the human eye to track and identify trends and patterns in the price. And we can also change here the granularity. So here we have 1 day candles or bars, but we can also change this to 5 minutes, 15 minutes, 1 hour or whatsoever. And then we can also change the chart type by clicking here, and the default setting is candles, but we can also switch to bars. And actually bars are pretty similar to candles. And for example, here we can see the open price and the close price. Here's the low price and here the high price. And then we start here with the open price, the close price, the high price and the low price. And we can also create a line chart, and here we can define whether we want to have the line chart for the closing price or the open price or whatever. And we can also create an area chart and some more options here. And actually you can find some more information on the Wanda website. And you can go here to learn, getting started, price charts and patterns. And again, traders use price charts to track and identify real-time pricing trends. And here we have the different charts, so candlestick or line graph. Then here you can find an explanation how to interpret candlestick charts and some formations. So we have the shooting star, hammer and hanging man, spinning tops and so on. So feel free to have a closer look here. So this was a short introduction to charting. Thanks for watching and see you also in the next lecture. Bye. Alright, in this video we are going to wrap up what we have learned so far, and this time our expectation is that the euro depreciates in value relative to the US dollar. In other words, we expect that the value of the euro declines, and whenever we expect an instrument to decline, no matter if it's euro, stocks, indices, crude oil or whatever, we should sell the instrument, or in other words, take a short position in the instrument. So in our example, we should take a short position in the euro. But first of all, let's have a look here again at our dashboard. So we have no open positions and no trades. And again, I have here my US dollar account, and I have $100,016 as a balance. And as there's no open position, the unrealized profit and loss is 0. And the realized profit and loss from earlier transactions is over $600. And also we can see that the current position value is 0, so we have no open positions. But now let's open a position, so we go short the euro and we sell the euro. And again we select 100,000 units. And here we can see the current and applicable sell price or bid price and the corresponding trade value in US dollar. And when we select 100,000 units, the pip value is $10. And currently the margin required is again around about $4,000. And we have a margin available of more than 100,000. And finally, here we can see the current spread. And the spread changes over time. Now it's 1.4, then 1.3. So let's create a market order and let's immediately execute our trade. And here we can see now we have an open position. So we have a short position in the euro and at a price of 1.18344. And here we can see the current ask price to close the position and the current profit in US dollar and in pips and also in percent. Now let's have a look here on the left hand side, and here we can see the unrealized profit and loss of all positions. So we only have one position here. Then the balance remains unchanged, and here we can see the position value of all positions. So $118,000 and the margin used. And then we can also see the margin available for further trades. It's 96,000. And here we can also see the leverage setting in our account. So we accept a maximum leverage of 50 to 1, but here with the Euro US dollar instrument, the maximum leverage is 30. And finally, here we can see the margin closeout percent field. And the closer this field is to 100%, the closer we are to a margin closeout. So our position still shows unrealized losses. And there are actually a couple of ways how to close a position. So here we are in positions, and we can just click here on X. Also, we can click here in trades on X. And also here in the chart, we can close our position. So the red line is here the price where we sold the euro, so 100,000, and the current profit and loss is minus 28. And also here we can close the position by clicking here on X. And there's also another way how to close a position. So we can actually execute the reverse transaction. So before we sold 100,000 euros, and then now we can also buy 100,000 euros. And by doing so, we close the position. And let's do this here. And let's have a look. And actually our total loss is $3. So this was our short trade, and let's further analyze our trade in our Excel sheet. So I've already pasted the screenshot here and also the numbers into our Excel workbook and made some adjustments to the calculation. So first of all, our first trade is a sell trade. So we sell euro at the bid price. In this example, 1.18344. And the close trade is a buy trade at the ask price. And to calculate the profit, we have to change the sign here. So still we have the difference in the trade values, but as we have a short position, we have to use here a minus sign in addition. And also for the pip profit, we have to add here a minus sign. Then having the half spread costs and the number of units, we can calculate the prevailing spreads. And in each and every trade, we had a spread of 1.4. Now, finally, let's have a closer look into the performance attribution. And we can see here a very typical outcome of day trading. So the gross profit is positive, and our forecast was correct that the price of the euro declines. And we can see this here in the mid price. So the mid price declined by 1.1 pips from 5.1 to 4.0. And also here, when calculating the mid prices, we had to change the sign. So here we have to deduct half spread from the ask price. And here we have to add half spread to the bid price. So we have here a positive gross profit of $11 or 1.1 pip, but trading costs completely eat up our profit, and we end up at a slightly negative profit, or to say loss of minus $3 or minus 0.3 pips. Alright, these were the very basics of day trading and forex trading, and in my view it's really important to understand the basics here before we can move on with some more advanced topics. So thanks for watching, and see you also in the next lectures. Bye. In this video I will explain the difference between netting and hedging. So whenever we make buy and sell trades for the very same instrument, then either netting or hedging applies, and we will see in a minute how it works. But at a first glance, this seems to be only a minor technical issue, but it has an impact on profit and loss. So there's a real monetary impact. Now let me demonstrate this in an example, and let's assume that we expect the euro to appreciate. Then we should take a long position in the euro, and as we are very confident, we take a large position over 100,000 units. So still I've selected here my US dollar account, and I have no open positions. And now let's go long for 100,000 units. And here's the open position. Now let's assume that after a couple of seconds or minutes, we are getting less confident and we decide to reduce our long position to 50,000. And therefore, in this case, we should sell 50,000 units. And what happens now is that our two positions, so the long position over 100,000 units and the short position over 50,000 units, are getting netted. So we are left with one long position over 50,000 units. And also here we can see only one trade. And that's actually the default behavior here on Oanda. And now let's assume that we want to close our position. And we have learned that here on Oanda we have two options. So either we can close the position by clicking here on X, or we can take the reverse position and sell another 50,000 units. And also here we can observe netting, and we are left with no open positions. And let's have a look here at the result of our trade. So initially we bought 100,000 units, and then we sold 50,000 units and again 50,000 units. And in total we paid the spread once. So the total trading cost is around about 12 or 13. And that's exactly the spread once over 100,000 units. And we could say that with regard to trading costs, our three transactions here are equivalent to just going long 100,000 and closing the position. So we have the spread cost once. And this is how netting works. But there's also a second option. And we can also create hedging accounts. And I have created here the US dollar hedging account. And already here you can see that this is marked with hedging. So let's activate this account. And we have, of course, no open positions here. And let's do the very same trades here with our hedging account. So we buy 100,000 units of the instrument Euro US dollar. And now we have here one open position, so 100,000 units long. And then we decide to reduce our position to 50,000, so we sell 50,000. And as you can see here with hedging, so our positions are not netted. We have two separate positions, one long position over 100,000 units and one short position over 50,000 units. And now let's sell another 50,000 units. And still we can see here that we have two positions. So we have one long position over 100K and one short position over 100,000. And this is also called hedging here. So we have two positions, but we have no risk actually that we can lose money here. So whenever we make a profit in one position, then we make the equivalent negative profit or loss in the other position. And we can see this here in the unrealized profit and loss. And it doesn't really change here, so it stays at minus 37 or 38. So this is just rounding here. So we are fully hedged and there's no risk of losing money here. But still we have two open positions and we have to close the positions, and let's do this now. And let's have a look at the activity or summary sheet. And from an economic point of view, we did the very same thing as before. So first, we took a long position over 100,000 units, then we reduced it to 50,000 units, and then actually we closed the position. On this case, we fully hedged the position. And now the difference between netting and hedging is simply the trading costs. So essentially here with hedging, we paid the spread twice. So let's have a look here. And here we paid $6.5 for buying 100,000 units. Then we have another $6 or $7 for selling 2 times 50,000. And finally, we had to close both positions. So essentially, we paid the spread twice. And actually, there are pros and cons and also use cases for netting and hedging. However, for our purposes, it's better to have a netting account to minimize trading costs. And finally, let me show you how to create a hedging account. So this is not recommended, but for the sake of completeness. So you can create here an additional sub-account. And here you can check the box, enable hedging on this account. But again, this is not recommended for our purposes. So thanks for watching and see you also in the next lecture. Bye. In this lecture, we will cover some more trading terms and functionalities that are actually important for trading, but play a minor role here for our course. And therefore, I'll keep it short here. And so far, we have created market orders. And market orders are getting executed immediately at the best price possible. So execution is guaranteed. However, the price is not guaranteed. So again, let's assume that we want to buy 100,000 euros. Then by default, we have here a market order. And when creating a market order, the trade gets executed immediately at the best possible price. Now we have 2 more order types. We have limit orders and stop orders. And first of all, let's have a look at limit orders. And we can place a limit order when we want to trade an instrument at a better or more favorable price than the current price. So the trade only gets executed if the price moves into the right direction. And therefore, execution isn't guaranteed. So now let's have an example and let's place a buy limit order. So we want to buy euro, but only at a maximum price of, for example, 1.17. So we want to buy euro at a cheaper price than the current price or more favorable price. So we have to set the limit price and also the expiry. And let's set it here to 1 hour. So if the price slips to 1.17 or below, then our trade gets executed at a price of 1.17 or better. And if this is not the case in the next hour, then our limit order expires. So this is how it works. And now let's click here on Submit. And as you can see, we have no trade, so it's just an order. We have an order. It's a buy limit order over 100,000 units at a price of 1.17, and the current price is 1.18, so the distance is still 111, I think it's pips, and the expiry is in 1 hour. And also it's important to understand that we have no open position, so we have no trade and no open position, but we have a buy limit order. And we can also close the order here, so we don't have to wait until the expiry. So this was the buy limit order, but we can also use a sell limit order. Let's assume that we want to sell euro, and then we can determine a maximum price. So we only want to sell euro at a higher price than we currently have at 1.19. And also here we can set an expiry, let's say 1 hour. And let's submit here the sell limit order. So here we have the sell limit order at a price of 1.19. And still we have a distance of 93 pips. And also here we can close the order. So these were limit orders, and now let's come to stop orders. And we can place a stop order when we want to trade an instrument once the price reaches a certain less favorable price. That's the so-called stop price. So the trade only gets executed if the price moves into the wrong direction. And also here, execution isn't guaranteed. So let's have an example here, a stop sell order. Let's assume that we want to sell an instrument. And we want to sell it once the price slips below a certain price. Let's say 1.17. So in case the price moves into the wrong direction, so we can sell an instrument only for 1.17, then our trade should be executed. And also here we can set an expiry. And here we have now the sell stop order. And finally, we also have a buy stop order. So if the price moves into the wrong direction, and this means if the price increases to, for example, 1.19, then we should buy the instrument. So the current price is here 1.18, and in case it moves into the wrong direction to 1.19, then we will buy the instrument. So this was a short overview on limit orders and stop orders. Thanks for watching, and see you also in the next lecture. Bye. Alright, in this lecture I will cover take profit and stop loss orders. So at the time when we execute a trade and take a position, so either long or short, we have the option to define when and how the position will be closed. And again, let's assume that we want to buy 100,000 euro. So we have here a market order over 100,000 units. Then we can combine the order here with a take profit order. And in case the price moves into the right direction and increases, we can say that once the price moves to, let's say, 1.19, so in this case, we want to close our position and take the profit. And actually here, in this case, the take profit order is equivalent to a limit sell order. And here on the right-hand side, we can see the current distance from the take profit price to the current price. So let's click on submit. And here we have one long position and a trade. And we have one open order, so it's the take profit order at a price of 1.19, and here's the current price and the distance. Now also here we have the option to manually cancel or close the take profit order. And it's also important to understand that the take profit order is attached to our position, so to this position here. And once we close the position, then the take profit order gets automatically cancelled as well. Here we can see that we closed the position at 11 AM, 33 minutes and 41 seconds, and at the very same time also our take profit order gets cancelled. Finally, let's also have an example on stop loss orders. And again, we want to buy 100,000 euros, and then we can define here a stop loss price. So we can combine our buy order with a stop loss order, and in case the price moves into the wrong direction and decreases to, for instance, a stop price of 1.17, then at this point we can close our position and limit our loss. And in this example here, the stop loss order is equivalent to a stop sell order. So let's submit here. And we have one open position, a long position. and an open order, a stop loss order. So the current price is 1.18, but if the price slips to 1.17, then our position is automatically getting closed, and we can limit our loss. And we have quite a high distance right now. And also here we can separately cancel the stop loss order. And again, it's important to understand that the stop loss order is attached to our position here. So once we close the position, then we automatically also cancel the stop loss order. Alright, thanks for watching and see you also in the next lecture. Bye. Let me show you another trading example, a more general trade. So my account is denominated in US dollar. However, this does of course not mean that I can only trade pairs where the quote currency is US dollar. So let's trade another currency pair without US dollar. For example, Australian dollar, New Zealand dollar. And now let's buy Australian dollar with New Zealand dollar. So let's go long the Australian dollar. And that means we go short the New Zealand dollar. And actually also here we want to buy 100,000 units. So 100,000 Australian dollar. And we can still see here the trade value in the account currency, US dollar, and also the pip value in US dollar and the margin required and the margin available. So let's click here on submit and let's buy Australian dollar with New Zealand dollar. And this works. So here we have a long position in the instrument Australian dollar, New Zealand dollar. And currently the unrealized profit and loss is minus 17. So let's wait a couple of seconds. Now we are still at minus 23 and now let's close the position. And let's have a look at the final result. So we end up at a loss of 18.77 and this already is in US dollar. And now let me show you how to calculate these numbers here. Now this is here the screenshot extracted from the trading station, and this is the slightly adjusted calculation. So first of all we buy Australian dollar and then we sell Australian dollar. And actually we have 100,000 units and the buy or the ask price was 1.066 and the sell price was 1.06572. So these are the prices of one Australian dollar in New Zealand dollar. And with this information we can actually calculate the trade value in New Zealand dollar. So when we open the position we have the following trade value. And then we close the position at this trade value here. And also here the profit and loss of our position is the difference in trade values. And therefore we have here the profit or the loss in New Zealand dollar. It's minus 28 New Zealand dollar. So this is here not US dollar, but New Zealand dollar. And of course, we can also calculate the loss in pips and the pip value in New Zealand dollar. Now, the trading platform gives us the profit in US dollar. So that's the account currency. And we have here a loss of 18.77. And we can simply calculate this by taking into account the exchange rate New Zealand dollar, US dollar at the time when we close the position. So the exchange rate was 0.67036 and then we actually can convert the profit in New Zealand dollar into US dollar. So the loss of 28 New Zealand dollar converts into 18.77 US dollar. And with this we can calculate the new balance, and it's simply the old balance plus the US dollar profit. And I can see here that there's an error. So now it's correct. So these are the mechanics in all cases where the quote currency is not equal to the account currency. Pretty simple actually. Thanks for watching and see you in the next lecture. Bye. Now let me introduce interactive brokers, or short IBKR, and I'm here on the Interactive Brokers website for the European market, so IE for Ireland. But depending on your region or your country, you should go to the right affiliate website. So if you scroll here down, then you will find information on other Interactive Brokers affiliates. And there you will find the websites, for example, for the US market or for the Canadian market, for the UK market, then for Central Europe, for Australia, then India, Hong Kong, Japan, and also Singapore. Now, Interactive Brokers is probably one of the largest and most reliable online brokers in the market, and there are definitely some good reasons why you should select Interactive Brokers. So first of all, Interactive Brokers is available in over 200 countries. So there's hardly any country where you can't create an account, and you can also check here the country list, so the available country list, and you can actually have a look for your country. But again, there's hardly any country where you can't create an account here. And also in terms of available trading instruments and products, there's hardly any broker that offers the same full range of instruments. So from stocks to options, futures, currencies, CFDs, bonds, funds, and more. And you can check here the available instruments under trading and products. And for example, here for the European market, these are the available instruments. So stocks, ETFs, options, futures, then spot or cash currencies, CFDs, cryptos, metals, bonds, and also mutual funds. However, please keep in mind that the products differ from region to region or from country to country. And for example, CFD trading is prohibited in the US market. Next, Interactive Brokers offers low costs, so low spreads and low commissions, depending on the trade size, of course. And you can check this here under pricing. So here you will find commissions, margin rates, and more. And once again, Interactive Brokers is one of the leading and most reliable brokers in terms of size and financial stability, and also for our purposes. So there's a pretty great API, so application programming interface, that allows us to execute orders and to make trades with and from Python. Now, for beginners, the website and all its information seems to be overwhelming, but we will cover many, but of course not all topics. And in case you want to know more, then feel free to go here to the education section. And here you will find the Traders Academy with very interesting and helpful blogs, videos, and more. So this was the first introduction to Interactive Brokers, and we will continue in the next lectures. Thanks for watching and see you there. Bye. Now, Interactive Brokers offers two different accounts, a paper trading account and a live account. And as the name says, the live account allows you to trade with real money, while the paper trading account is a trial or a demo account where you can test and learn with paper money, so no real money, and therefore there's zero risk of losses. And as the paper trading account offers pretty much all features and functions of a live trading account, we will start here with the paper trading account. And actually creating a paper trading account is really simple and straightforward, so it won't take more than 5 minutes. While creating a live account takes longer, so probably a couple of days, as you have to go through the application and identification process. So I'm still here on Interactive Brokers, and then you can click on the free trial. And as I said, so the free trial includes most of the features. So you have access to all platforms, and you can get market data for probably all products. But typically the data is delayed by 10 to 15 minutes. And then once you have gained enough experience and practice, then you can simply convert the free trial into a live account. And actually, in case you already have a live account here on Interactive Brokers, then you automatically also have a paper trading account. So you will see this when logging in into the live account. And now let's simply click here on Start Your Free Trial. And once again, creating a free trial account is pretty simple and straightforward. So you only need your email address and a username and a password. And then you also have to select your country. And with this, you can create your free trial account. And in your account, you will find 1 million US dollar. So, of course, this is just virtual or paper money. And you can play around with it, so there's no risk of losing real money. And once you have created the paper trading account, you can click here on Login, Portal Login. And then you have to fill in here your username and your password. And then you can select between the live account and the paper trading account. So if you have both, you can select it here. But otherwise, so for now, we should select the paper trading account. And then it says here that this is not a brokerage account, so this is a paper trading account for simulated trading. And currently I have here 976,000 cash sitting on my account. And you can also check your portfolio. So I have 976,000 cash, and then I have 100 Apple stocks and 100 Amazon stocks. And actually changing the settings of a paper trading account is rather limited. So you can click here on account settings, but there are actually no real options here. What you can actually do is you can reset your paper trading account. So you can reset it back to, for example, 1 million or any other amount. So for example, 240,000 or whatever. And we will continue here in the very next lecture. Thanks for watching and see you there. Bye. I am still here on my paper trading account, and this is actually the client portal web app. But there do exist various different trading platforms, and the client portal is here one of them. But if we check here why Interactive Brokers, then we can see that there are various platforms here. So depending on your experience, and the client portal is one of them. So it's an easy to use web application for beginners and also intermediate traders. And in my experience, the client portal for the paper trading account, so at least for the paper trading account, is a bit buggy. So if I go here back, then let's recall that in the last video, we have seen that I should have more than 900,000 cash here, but I can't see it now in this session. And I also can't check here my portfolio with Apple and Microsoft. And therefore we should use another platform, and it's actually the Trader Workstation, so TWS. So that's the flagship desktop platform. And as you can see, it's more for the intermediate and more advanced traders. And there's also a second and even more important reason why we should work here with the Trader Workstation. So the Trader Workstation is a bit more reliable, at least for the paper trading account. And also it provides some more functionalities and options, but the downturn is here that it's a bit more complex and it can be a bit overwhelming for beginners, so we will see this. And last but not least, and that's the most important reason, so for API trading with Python, we need to download and install the Trader workstation anyway. And that's the plan here for this video. So if you go down here, then you can find here below software downloads. And let's click here on the Trader workstation. And here's the online version and the offline version. And I do recommend the online version. And either you select here the most current stable production version or the time-tested version. So it doesn't really matter. So one of these two here. And actually, if you click here on one of these two, then you will download an installer. And I have the installer here on my desktop. And then you can simply double click on the installer. And then after having successfully installed the Trader workstation, then you should have the icon on your desktop. So now I do have the Trader workstation here, the icon on my desktop. And then with a double click, you can actually start the Trader workstation. And that's the plan for the next lecture. Thanks for watching and see you there. Bye. Now let's open here the Trader workstation with a double click. And then you have to insert here your username and your password. And you can either select the live trading account or the paper trading account. So let's move on. So let's copy paste here the username and the password. And let's click on paper login. So this is here the Trader workstation. And as I said before, so beginners can be a bit overwhelmed here. And I won't go through everything here. So I will only explain what we really need step by step. And actually, once again, you can see here the message that this is not a brokerage account. So this is a paper trading account for simulated trading. And the market data that you actually see here is delayed data, so by 15 minutes. And actually what you see here is actually the mosaic view, and there's also the classic view and also a learn section where you can find lessons and also videos like on the website. So let's go back. And I do prefer here the mosaic view, and there are various sections here. And the first and most important, you can see here your current portfolio. So currently I have on my account close to 100,000 euro cash and close to 15,000 US dollar cash, and 0 positions here in Apple and Amazon. So I recently sold my positions here and I reset my account. So now I've set the cash here to 100,000 euro. And now currently I have close to 100,000 and close to 15,000 US dollar. And actually here on the right you can see the net liquidity. So that's the sum here of all values. So in simple words, but it's a bit more complicated. So this is the portfolio. And then on the left hand side you can select here instruments for trading. So for example, here I have Lufthansa, or you could also select Apple, and then you can buy and sell here Apple, and here you can see bid and ask prices. So we will go through the details in the next lectures, and then here below you can get some more information on the Apple stock. So the latest price, bid and ask prices, and high and low prices and more. So earnings per share, price earnings, the market capitalization, and also the price chart. And actually the setting is here 1 minute candles. So this is here a candlestick chart, but you can also change here the candle size. So for example, to hourly candles. And then below here you can find your most recent orders and your most recent trades. And finally here On the lower right corner, you can see some market news. So this is the trader working station at a first glance. And in the next lecture, we will make a very first trade. Thanks for watching and see you there. Bye. All right, I'm still here on the trader workstation. And now let's, for example, buy 10 Microsoft stocks immediately at the best possible price. And buying immediately at the best price means we need to submit a market order. But first of all, let's select here and let's search here for Microsoft. So we can type here the ticker symbol MSFT, and then by pressing the Enter key, we can get a selection of Microsoft related instruments. And here we have first of all the stock, so the equity, and that's actually the plan here. But there are also other options, and for example, we can buy Microsoft options, warrants, structured products, CFDs, and also bonds, for example. But now let's click here on the stock. And then we have to define the order type here. And essentially we have the choice between a limit order and a market order. And whenever we want to buy immediately at the best price, then we have to submit a market order. So a market order is an order designed to fill quickly at the current market bid or ask price. And we will cover the limit order later on. But now let's select here the market order. And then we have to define the quantity. And we can define this here. So we said before that we want to buy 10 Microsoft shares. And here we can see the corresponding US dollar price. So around about 2,500 US dollar. So the current price is 250 times 10 is 2,500. And then here above we can see two different prices. So we have the bid price and the ask price, and the mid price, which is between the bid and the ask price. And you can also see bid and ask price here. And if you hover here over, then you can see a more detailed description. So the bid price is the highest priced bid for the contract, or in other words, it's the highest price that you can sell the stock for. And the ask price is the lowest price that you can buy the stock for. And as you want to buy the Microsoft stock, then for us the ask price is the prevailing price. And actually the ask price is always a bit higher than the bid price. So whenever you buy, you have to pay slightly more than if you sell the stock. And the difference between the bid price and the ask price is also called the bid-ask spread. And as you can see, prices change continuously, so a couple of times per second. And once again, so the ask price is the important price if you want to buy. And finally, we can click here on buy, and then we can submit the buy order over 10 stocks by clicking here. And then you can see the order overview, so the instrument, then the prices, and actually also the amount. So we want to buy 10, and the amount is 2,516. And also we can see here the commission that we have to pay. So it's $1, and we will cover commissions and trading costs in one of the next lectures. And then if we are ready to buy, we can click on transmit. And then here you can see now our new position. So it's 10 Microsoft stocks. And then we can see here the current market value, so 2,518. But this can change here, of course. And we can see here the price, so the average price that we had to pay. And then in comparison, the last price. And here on the right, the change between the price that we paid for and the last price. And currently we are minus here. So we have now 3 positions here in our portfolio. So 10 Microsoft stocks and still 10,000 euro. And the cash balance was reduced here by the purchase price. And finally here below on the trades, you can find the order for Microsoft. So the quantity and the filled price, and also the trade So the order was filled immediately at this price here. And here you can see the paid commission, so $1. And then selling works in the very same way. So we can select sell and set the quantity to 10 again and select a market order. And alternatively, we can also close the position here with a right click, and then we can go to trade, and then we can close the position by 100%. So we can sell the 10 stocks. So here we have set the trade automatically. So 10 stocks for sale, and then we can click on submit again and transmit. And now we have 0 Microsoft here, and we have converted the 10 Microsoft shares into some more US dollar cash. So these were our very first trades, and we will continue in the next lecture. Thanks for watching and see you there. Bye. Alright, we have to talk about trading hours, and most important, you should keep in mind that you cannot trade the stocks 24 hours a day and 7 days a week. So you can't trade on weekends, Saturday and Sunday, and you can't trade on other bank holidays like New Year. And for all other trading days, so typically from Monday to Friday, there do exist regular trading hours. So for example, for New York Stock Exchange listed stocks, the regular trading session is from 9:30 a.m. to 4 p.m. and that's US Eastern or New York time. And actually regular trading hours may be a subset of the instrument's total trading hours. So for some instruments and exchanges, there do exist pre-trading periods. And for example, so the total available hours on the New York Stock Exchange is from 4 a.m. in the morning until 8 p.m. However, I do recommend that you trade only during the regular trading hours, as liquidity is highest and the prices are most efficient during the regular trading hours, so with the lowest bid-ask spreads. And actually, depending on the instrument and the exchange, the trading hours can differ, and on the trader workstation, you can actually get the regular trading hours for your instrument or your exchange. So for example, let's go here to Apple and right click, and then you can get here the description under financial instrument info. And then here you can see the trading schedule. So for today, it's between 9:30 a.m. and 4 p.m. So that's the local time, so New York time. And in my time zone, so Middle European time, it's from 15:30 until 22 o'clock in the evening. So, and also here below you can see the total available hours. But once again, you should stick here to the regular trading session. And then you can get even more information by clicking here on calendar. So here you can see for the next days the trading sessions and the trading hours. And it's no surprise that here for Saturday and Sunday, so the exchange is closed, so you can't trade there. So these are the trading hours for the Apple stock. And as I said before, so it depends on the exchange and the country. So for example, let's go now to a European or German stock, Lufthansa. And also here we can get the description. And here the exchange time zone is the Middle European time, and the regular trading session is from 9 a.m. to 5:45 o'clock in the evening. And also the total available hours deviate from the regular trading session, but also here on weekends the exchange is closed. So the key message for you is that you should keep in mind the regular trading hours. So you shouldn't try to trade on weekends or outside the regular trading hours. Now, finally, you can change the settings with regard to the trading hours here in this drop-down menu. And by default, the setting is day, so the order will be active during the regular trading hours only. So in case of Lufthansa, it's between 9 and 17:45. And if you go here, then you could actually enable fill outside the regular trading hours, and then you are also able to fill your orders in the extended period. But again, I do not recommend this, so you should stick here today. And with this, we have reached the end of this lecture. Thanks for watching and see you in the next one. Bye. We are coming now to an important topic. On interactive brokers, you have the choice between a cash account and a margin account. And to be more precise, for the live account, you have the choice between cash and margin account. And you can change that in your account settings. And in the paper trading account, by default, is a margin account. And you can't change it to a cash account. Now, the important question is, what's the difference between a cash account and a margin account? And in a cash account, as the name says, you can only buy stocks as long as your cash balance is sufficient. So you can't buy more than you have. And also you can only sell a stock at a quantity that you actually own. So if you own 200 shares of Apple, then you can sell 200 shares, but not more. And if you don't own any Microsoft shares, then you can't sell Microsoft. And in contrast to that, a margin account allows you to buy stocks on margin. And that means you can borrow money from the broker and buy stocks for a value higher than your actual cash account. And also you can short sell stocks. And that means you can sell stocks that you actually don't own. So you can borrow a stock from another trader and short sell the stock. And the main motivation for short selling is that it allows you to benefit from falling prices. Now, the key message is that short selling and margin trading is more risky, and it's actually limited to more experienced traders. And depending on your country, the margin account is either prohibited or you need to deposit and maintain a minimum cash amount. So typically $2,000 or more. And in this section, I won't go through the details of margin trading or short selling. So there are many more things that you have to keep in mind, like margin rates, the cost of borrowing and more. And you can find a lot of information on margin trading. So for example, here, so what's margin trading and so on. And you can also find the prices for margin trading, so the borrowing rates or the margin rates. And also on the Trader Working Station, you will find a couple of items related to margin trading. So here on the right, you have information on your margin, so net liquidity, excess liquidity. And if you click here on account, then you can see some more definitions. So for example, we have the net liquidation value, and when you hover here over the items, you can get a definition. And most important here is your current cash balance. And obviously my cash balance is here 100,000 euro, but the buying power is much higher, so 665,000 euro, and this is related to margin trading. So I could buy stocks on margin here in my paper trading account. So feel free to check here the definitions and to go into the education section or learn section. And here you will find further information and also videos on margin trading and short selling. And we might cover some of those topics later in the course when it's more appropriate. But for now, let's assume that we work with an ordinary cash account. Thanks for watching and see you in the next lecture. Bye. All right, we need to talk about trading costs, and those who have attended any of my other trading courses know it's all about trading costs, and therefore trading costs is one of the most important topics in trading and investing, because active trading and investing strategies trigger many trades, and even if strategies seem to be profitable before trading costs, many of them are unprofitable if we take into account trading costs. Now, there do exist visible trading costs like trading commissions and hidden trading costs like the bid-ask spread, and we have to take into account both, so visible costs and hidden costs, and therefore zero trading commissions doesn't mean anything. So typically you have to pay zero trading commissions with higher or wider bid-ask spreads, and typically hidden costs are higher than visible costs. So we definitely need to analyze trading costs in more detail. And now let's start with the trading commissions here on interactive brokers, and we can go to pricing and to commissions. And then we select here stocks and ETFs. So depending on the asset class or the instrument, costs are different, and this course is all about stocks and ETFs. Next, depending on whether we trade US exchange listed stocks or European stocks or Asian stocks, then commissions differ so significantly. And now let's focus here on US listed stocks, United States here. And typically commissions for US exchange listed stocks are the lowest compared to European or Asian stocks. And once again, with a light account, you pay zero commissions for US stocks, but this is only eligible for US residents only. And even if you are a US resident, so it does not necessarily mean that this is the best choice for you. So you should read also here the terms and conditions. And for all other traders outside the US, you have the choice between fixed fees and tiered fees. And while tiered fees seem to be lower, they are not necessarily lower, as some third-party fees are not included here, and they need to be paid separately. And actually in your account setting, you can change the fee structure from tiered to fixed, and the default setting is here fixed. So for retail investors, it's fixed. And now let's analyze the fixed trading commissions with an example. And therefore I've created a little integrated Excel model to actually simulate trading costs. So once again, here we have the fees for US exchange listed stocks, and here we have the fixed fees. And actually the general rule is that you have to pay $0.005 per share, so irrespective of the trading volume here. So the commission per share is $0.005. Then next, the minimum commission per order is $1. So even if you only buy one share, so in this case, you have to pay $1 and not $0.005. So that's the minimum commission per order. And then there's also a maximum commission per order, and this is 1% of the trade value. And then we have additional fees for selling transactions. So let's check again here the third party fees. So we have here the regulatory fees, and we can check them here. So we have for sell transactions, we have the SEC transaction fee and the FINRA trading activity fee. So we shouldn't forget this here, but only for sell transaction and not for buy transactions. So these are the terms and conditions for the fixed fee structure. And now let's have a look at an example. And I've created a little screenshot from Microsoft. And here we have the following ask price, so 252.48, and the bid price 252.44, and therefore the mid price is here at 4 6. So we can see here the mid price and then the ask price and the bid price, and the mid price is exactly in the middle between the bid price and the ask price. And actually here below you can once again see the bid and the ask price and the size. And 200 times 200 here means that currently, so at the time here, you could buy 200, so maximum 200 shares for the cheapest price of 252.48, and you can sell maximum 200 shares for the best selling price of 252.44. And actually this is the so-called top part of the order book. So the most favorable prices for you and the corresponding sizes. And in case you want to buy more than 200 or sell more than 200, then you get a less favorable price, because then you slip actually in the order book. But for now, let's assume that the maximum order size here for us is 200, so 200 shares, and then we can actually differentiate between the buy transaction and the sell transaction. And first of all, we can calculate the trade value, which is for the buy transaction simply the number of shares times the ask price, and for the sell transaction the number of shares times the bid price. And then we can calculate trading commissions with the following rules here. So we have 0.005 per share, but the minimum is $1 and the maximum is 1% of the trade value. And here's the little formula. And this leads to a commission of $1 for the buy transaction. And then if we consider the sell transaction, so we have to add here the SEC fee and the FINRA fee. And then this leads to 2.18, so a total commission of 2.18 for the sell transaction. So we can see here that the sell is more expensive than the buy transaction in terms of commissions. So these are the absolute numbers, but for us it's even more important to have the proportional trading costs, which is nothing else than the absolute numbers divided by the trade value. So for the buy transaction, it's only 0.002%, and it's twice as much for the sell transaction. And if we stop here, we could conclude that the trading costs are really low, so the proportional trading costs. But so far, we have only analyzed the visible trading costs. And also the proportional trading costs here depend on the size of the order. So if we trade 200 shares with a trade value of 50,000, then we have rather low proportional trading costs. But now, for example, if we reduce to only 10 shares, then still for the buy transaction, we have $1. So this is the absolute commission. But in relative terms, then here with a lower trade size, the proportional trading costs are higher. So 0.04%. And then if we further reduce the order size to 1 share, then the proportional trading costs increase even more. And for example here, 0.4% proportional trading costs is a significant cost actually. So maybe not if you just consider one trade, but if you consider 50 or 100 trades, then this is getting really expensive. But again, this is only here the trading commission, so the visible cost. And in the next lecture, we will also analyze the hidden trading costs. Thanks for watching and see you there. Bye. Alright, you can also download here this little Excel sheet, and you can find the download attached to the previous lecture. So this allows you to play around, but you should be careful here. So the model is only based here on US exchange listed stocks. So for other countries, you actually have to change the formulas. So if we check here Europe, for example, then Austria has completely different rules. And these are not modeled here in the Excel sheet, so only in the United States. Now, in the last lecture, we have analyzed the visible trading costs, so the trading commissions. And now let's focus on hidden costs. And hidden costs and visible costs together form the total trading costs. And there's the analogy of an iceberg where the visible part is the smaller part and the hidden part below the waterline is the larger part of the iceberg, and here also of the total cost. And you will see this in a couple of minutes. Now, the bid-ask spread that we can observe here is directly related to the hidden costs. So we have learned before that we can buy stocks at the ask price and sell stocks at the bid price, and the ask price is always higher than the bid price, and the difference is the so-called bid-ask spread. So here in this example, the bid-ask spread is rather low. So we have $0.04 dollar difference. That's pretty low. Now it's important to understand that the bid-ask spread is nothing else than the profit for the broker or the market maker. So typically traders don't trade directly, but via an intermediary that sells the shares to buyers for a slightly higher price than he buys the shares from sellers. And therefore the bid-ask spread is the profit for the broker, and therefore it should be viewed as the trading cost for the trader. And now let me illustrate this with a little and maybe extreme example. So let's assume that we buy 200 Microsoft shares and then immediately sell 200 Microsoft shares at the very same point in time. Then we have the following situation. So we buy at the ask price and sell at the bid price. And then we have here the trading values. And after those two transactions, we are actually left with a loss of in total $8. So that's simply the difference between the trade values here. So we lose $8. And this is the total hidden cost for the full trade. So buying and selling or selling and buying. And then we can narrow it down per trade. So per trade, it's still $4. So 8 divided by 2. And actually the $8 are also called spread cost, and the $4 are typically called half spread cost. And we can also calculate here the half spread cost with the following formula. So we can take the bid-ask spread divided by 2 times the number of shares gives actually the half spread cost, $4. And then we can also calculate the proportional trading costs of the hidden costs. So it's simply the absolute cost divided by the mid price. So in this case, it's 0.0079%. And as you can see here, so the hidden cost, $4, are higher than the visible cost, so $1 or 2.18 for the sell transaction. And then with this, we can actually calculate total costs per trade. So on average, in total, we have the hidden costs $4 plus the weighted average of buy and sell. So sometimes we buy and sometimes we sell. And therefore, the expected or the average cost per trade is $5.59. And in relative or percentage terms, it's 0.01%. Now, 0.01% proportional trading costs is still very low, but this is here, so to say, the optimal case that kind of minimizes trading costs. So we have a high trade value, and also we have a really low bid-ask spread. So I think this was at a time when the trading volume and the liquidity was high. But if there's lower liquidity in the market, then typically the spreads are higher. And for example, if we reduce here the shares to maybe only 10, and if we increase the bid-ask spread, so it can be $1, so why not? Then we have completely different proportional trading costs. So now we have 0.24%, which is significantly higher than the previous example. So there are various factors that influence the proportional trading costs. So the trading size, then the bid-ask spread, and also the exchange where you trade. So as I said, so typically trading on US exchanges is cheaper than trading European or Asian stocks, but this can differ. And depending on your specific example, you should definitely analyze and calculate your proportional trading costs. And throughout the course, we will see some examples where trading costs do matter and where we should really care about and take into account trading costs. Thanks for watching and see you in the next lecture. Bye. All right, now let's come to Forex trading, and we've already learned that we can trade Forex with two different instruments. So we have spot or cash trading, where we really and physically convert euro into US dollar or vice versa. And on the other hand side, we have derivatives trading, and the standard Forex derivative is CFD, so contract for differences. Now here on Interactive Brokers, the general rule is that the spot or cash trading is for currency conversion only, so it's not meant to be used for algorithmic trading or speculation purposes, at least in some countries and regions like Europe. So currently I have round about 10,000 euro here in my demo account, so net liquidity at 10,100 euro. And I've selected the cash or the spot contract, the euro US dollar. And now if I try to actually buy 20,000 euro with US dollar that I actually don't have, then I get the following message. So this FX trade would expose my account to currency leverage, and this is not supported here, and we can get some more information here. So at least this holds true here in my region, so Europe, but maybe it can be different in other regions, so you have to check here. Now in my case here, I have to select the corresponding CFD contract, so I can type here euro.US dollar one more time, and then I can actually select between the cash contract and the CFD contract. So this is here the CFD contract. And one more time, CFD trading allows short selling and margin trading with leverage. And one more time, the reminder here that CFDs are prohibited in some regions and countries like the US. And I'm not 100% sure if cash trading with leverage is allowed in these countries. So you need to check here. So depending on your country or region. And actually we can also get some more details on the contract. So under favorites, I have here the Euro US CFD contract, and with a right click, we can go to financial instrument info. And for example, we can see the total available trading hours. So CFD trading is here from 5:15 to actually 5 every day. So from Sunday evening to Friday evening. That's the trading hours in US Eastern time. And this is here my time. So from 11:15 p.m. to 11 next day. Finally, let's check and analyze trading costs for CFD contracts, but also for cash contracts. So they are more or less the same. And I have copied here the overview from the Interactive Brokers website. And also here for Forex and CFD, we have two different kind of costs. So we have direct costs, the commissions, and here's actually the plan for the commissions. And we have hidden costs, so the bid-ask spread. And actually here we have a tiered commission structure. So if the monthly trade value is below 1 billion US dollar, which is typically the case for retail traders, then the cost is actually 0.2 basis points times the trade value. So 0.2 basis point is actually here 0.00002 times the trade value. And now let's have an example here. So I've created here a little screenshot for Euro US dollar with a bid and ask spread. And we can see here that the spread is rather low. So it's only 0.2 pips. So here in the fifth decimal, there's a difference of 0.2 pips, which is really low. Because, and that's the good news here, so for Forex, the spreads are generally very low, and interactive brokers just uses here the market spread. So there's no extra spread, and the profit for interactive brokers is the commission and not the spread. So this is actually the market spread here. And now let's have a look at the following example. So let's assume that the trade size in euro is 10,000. So we buy and sell 10,000 euro. Then I have copied and pasted here the bid price and the ask price and the bid ask spread, which is here 0.2 pips, and the commission, which is 0.2 basis points times the trade value. And finally, and that's probably the most important point, so we do have a minimum commission per order of $2. And the typical retail trader will run into the commission floor here. So typically you have to pay $2 per order unless your trade size is really high. So in this example, around about 100,000 euro per trade. So let's have a look at an example. So let's assume the trade size is 10,000 euro. And if we buy 10,000 euro, then the trade value is 10,600 US dollar. And here we have to pay $2 commission because we are running here into the cap $2. And then we have here also the proportional trading cost. So the commission divided by the trade value. And for the sell transaction, the commission is also $2. So in total for the complete transaction, so buying and selling 10,000 euro, we will pay $4 commission. So this is the trading commission. And now let's have a look at the hidden costs. So the bid-ask spread. And in our case, the difference is here only 20 cents for the full trade. And per trade, it's 10 cents. So really low. And this leads to the final summary. So the total trading costs per trade is around about here $2.1. And in terms of proportional trading costs, it's around about 0.02%, which is really low. But due to the commission floor of $2 per trade, so the proportional trading costs really depend on the trade size. So if we reduce here the trade size to 1,000 euro, then the absolute cost is still $2.01, and therefore the proportional trading cost is much higher. And otherwise, if we increase here the trade size to 100,000 euro, then with this we can significantly reduce the proportional trading costs to only 0.0029%. So if we compare the trading costs of interactive brokers with the other two brokers, so Wanda and FXCM, we can conclude that costs are lower for high trade sizes like 100,000. But on the other hand side, proportional trading costs can be higher here if a trade size is low due to the minimum commission per order of $2. So this was the difference between spot or cash trading and CFD trading, and also a summary of the trading costs. And in the next lecture, we will see a full trade live in action. Thanks for watching and see you there. Bye. Now let me demonstrate a full CFD trade on interactive brokers. And let's assume that first we go long and buy 10,000 euro. And then after a couple of minutes, we close the position by selling a contract worth 10,000 euro. And for today, this will be my very first trade. So no trades yet and no unrealized or realized profits and losses. And currently I have 10,100 euro sitting here as cash or net liquidity in my account. So to go long 10,000 euro, we have to select here the CFD contract euro US dollar, and then we have to set the quantity, for example 10,000, and we submit a market order to execute the order immediately at the best available price. And we select here buy, and now let's click here on submit. And for example, here we can see the current bid and the current ask price, and under amount we can see the trade value of the transaction, so 10,600 US dollar, and also the commission in euro. So we are running here into the commission floor of $2 per trade or per order. And therefore, in total, we have to pay 10,634, including the commission. And now let's go here to the right. So changes in the balances. And actually, my equity that consists of the net liquidity reduces by the commission -2. Then we have to post an initial margin of 333 euro. And this is exactly the trade size in euro. So 10,000 divided by the maximum leverage. And the maximum leverage for CFD trading, at least in my region and my country, is 30. So we have to post an initial margin of 333, which is just the trade value divided by 30. Or in other words, we can actually enter the position by only having a cash of 333 due to the leverage. And then we can also see the maintenance margin. So this is 3% of the initial trade value. And whenever our equity gets lower than the maintenance margin, so lower than 300, then interactive brokers will close our position automatically. And just as a repetition, so this is also called margin closeout. And finally, we also have the position for the contract. So the current position is 0. And then after the trade, it's 10,000. And now let's transmit the order. And now we have here in our portfolio a contract worth 10,000 euro, so a long contract. And then above, we can also see the current unrealized profit and loss. So currently it's minus 1.4. And now let's wait a couple of minutes. Now, after a couple of minutes, the unrealized profit and loss is minus 0.5. So there are no big changes here in the price euro US dollar today in the morning. And now let me close the position. And for example, we could do this with a right click, 100%. And then we have to select a sell order over 10,000 units, market order. And then let's execute the order here. So we sell 10,000 units, and also here the commission is 1.88. And the margin and the maintenance margin will be reduced to 0 actually. So for this contract. So now let's transmit. And now I've successfully closed here the position. And as you can see here, so now the realized profit and loss is 0.9. So there's a small loss here. And now we can check the trades and the trades overview. So here we have the buy transaction, and then 9 minutes later the sell transaction for 10,000 units. And here we can see the executed price. And actually we can see that the price increased over time, which is actually positive if we hold a long position, but still we have realized a loss because we had to pay commissions as well. So 2 times $2 US, and we will further analyze this in the next lecture. Thanks for watching and see you there. Bye. Alright, this is a short and maybe simplified trade analysis for our full CFD trade euro US dollar, and you can find a more detailed analysis in the Oanda section. So I've copied and pasted here the trade reporting from the trading workstation. And so we have here two trades. First, we go long and we buy 10,000 units at a price of 1.06295. And then after, or 9 minutes later, we actually closed the position. So we sold 10,000 units at a higher price of 1.06325. So the price increases. And this is always positive when we have a long position. But still we end up with a total loss because the trading costs are higher than the actual gain. And this is a very common outcome of algorithmic trading. So trading costs are higher than the actual profits and eat up all of the profits. So we have here the commission twice. So for both transactions, we have to pay $2. And now let's simply analyze this. So having the units and the price, we can calculate the trade values. So first we buy 10,000 units at a price of 10,629. And then we sold the contract at a higher price. And this gives here a profit before commissions of $3. But now we have to pay $4 commissions, and then we are left with a small loss of -$1. Now, for the sake of completeness, the profit before commissions already includes the hidden cost, so the spread cost. And if we assume a spread of 0.2 pips, then we can say that for the full transaction, we have total spread costs of 21 cents. And therefore, we could also conclude that the profit before spread costs and before commissions is $3.21. Then we have to pay spread costs 21 cents, which leaves us then with a profit before commissions of $3. Then we pay $4 commission, and then the final loss is -$1. So this was here the trade analysis, and let's also recall that we only need around about 333 euros sitting on our account to actually make the trades here due to leverage, and therefore the leveraged return is more negative. So we lost $1 with an initial margin investment of 333 euro. Thanks for watching and see you in the next lecture. Bye. Alright, this is an introduction to the FXCM website, and I'll give you a short overview of the content and information that can be found on that website. So the URL is fxcm.com. And by default, we are directed to the UK website, which is okay here. But there's also the option to go to a localized website optimized for your country. And here you can choose the country. For instance, for Australia, Canada, China, and more. But let's stay here on the UK website. And first of all, we can find here a risk disclaimer. So CFDs are complex instruments, and there's a high risk of losing money. And very similar to Oanda, approximately 75% of all retail investors lose money when trading CFDs with FXCM. So again, you should definitely know and understand what you are doing. And let's have a first look here. So with one single account, there are multiple markets, and we have quite a lot of Forex pairs here. For instance, Euro, US dollar, and more. And we can also trade single shares like Netflix, Tesla, Google, Apple, and commodities like gold, oil, copper, and more. And also stock indices like the German DAX, or the Dow Jones Index, or the S&P 500 Index. And finally, there are also cryptocurrencies like Bitcoin and Ethereum. So essentially, FXCM provides more instruments than Oanda. So we have cryptocurrencies and actually also some baskets, and we will see this in a few minutes. So let's go here to trading, and here we have some more information. So some more information on CFD trading, for instance. And here you can find some reasons why you should trade CFDs with FXCM. And also FXCM provides several solutions or platforms. So we have the browser-based trading station and some more. But also here in this case, we will, so to say, create our own platform with Python. Then we have here some more trading details. So spread costs are always important, and also leverage and margin. And similar to Oanda, available instruments and also terms like leverage and margin can differ from country to country. And at this point, again, I want to highlight that FXCM accounts are not available in all countries. For instance, in case you are located in the US, then you can have a look here at the website, but you can't create an account, so no demo account and also no live account, since FXCM is not permitted in the US. And instead, of course, you can use Oanda. So we have here some basic information and also information on algo trading with Python. And of course, this is the major topic and the focus of this course. And let's go here to markets. And here we can see different products. So we have Forex, then we have single shares. There are quite a few. So typically, of course, these are large shares. And commodities, US oil, then we have copper, gold, corn, and more. And also we can trade the baskets, for instance, Forex baskets. So instead of trading only a pair like US dollar, euro, we can trade the US dollar versus a basket that consists of Australian dollar, euro, British pound, and Japanese yen. And the same is also available for Japanese yen and for a emerging market currency index. And we can also find here stock baskets. So we have here, so to say, a US technology basket or a biotech basket and more. Finally, we also have a basket with major cryptocurrencies like Bitcoin, Ethereum, and more. Then you can find additional information on popular instruments like Euro, US dollar. And now let's go to knowledge. So for instance, you can find here a news feed and also education. So this is pretty important. So what is Forex? And here you can read and repeat some details on Forex. And also how to become a better trader. So you can sign up here to webinars. Next, we can find here some more details. So trading guides, learn Forex trading. And here is even more information. So why we should trade Forex. Then Forex explained here. And also terms like pip and how leverage works. And in my view, FXCM provides even more information and insight than Oanda. And in combination, both websites cover all of the basics that you need to know. Now let's go here to insights, and here we can find even more insight, for instance, on global economies or trading strategies and technical indicators. So it's definitely worth spending some more time here on the website and going through the contents. However, the basics of day trading and Forex trading I also have covered in the section on day trading with Oanda, so feel free to go back here. So this was a short introduction to FXCM, and in the next lecture we are going to create a demo or practice account. Thanks for watching and see you there. Bye. In this video I will show you how to open an FXCM demo account and how to navigate through that account. And also here on FXCM, demo account isn't the right word for it. So demo account is typically an account with a limited functionality, and this is not the case here. So the FXCM demo account offers pretty much all options and functions of a real life account, but in a safe environment with just the virtual funds. And there's no risk of losing real money. So here we have the options to open a live account or a demo account. And you should always start with a demo account. And also with the demo account, we can trade Forex, indices, commodities, and more in a risk-free environment. And we have live buy and sell prices. And actually, our demo account starts with a balance of 50,000. Depending on your location, it's a pound or dollar or euro. And of course, it's available 24 hours a day and 5 days a week. So the practice account is an essential tool for algorithmic trading, not only for day trading beginners, but also for experienced traders with a live trading track record. So complete trading beginners should always start here with a practice account. And a practice account allows you to just play around and make example trades to understand how it works. But also experienced algorithmic traders frequently use the practice account. So whenever you have created a new and promising algorithm that seems to perform well in in-sample and also out-sample tests, it is nevertheless highly recommended to further test your new algorithms for a couple of days or even weeks in a real-time environment. And to avoid any losses in the testing period, you should use the practice account. And again, the live account works pretty much in the same way as the practice account, so we don't miss anything here. We just don't have any risk to lose real money at this stage. So you can register here for your free trading station demo, and you require your name and your email address and also your country. And here you can already see the available countries in dark letters and the unavailable in lighter letters. So for instance, Ecuador isn't available. And let's scroll down here and you can see that also United States isn't available. So like Rwanda, FXCM is not available in all countries. And for example, US residents cannot create an account here. And that's the reason why I also added the second broker, Rwanda. And there are actually only few differences between Rwanda and FXCM. So you have to select your country here and also your currency. And you have actually the choice between pound, the euro, and US dollar. And I think for some countries you don't have any choice. So you just have to take euro or British pound, but that doesn't actually matter. So once you have inserted your personal information, you can click on Trade Now, and then you get an email with your login credentials. And once you have the credentials, you can click on Launch Platform. And then you can select here between the demo account and the real account. And we select here the demo account, and we have to insert our username and also our password. And once we have inserted our login credentials, we can click on Sign In. So this is our demo account, and we are directly in the trading platform. So we have here few options. We can get the API token that we will require later for the FXCM API. And as you can see, the demo account on FXCM provides fewer options and settings compared to Rwanda, but this is no problem actually. So here we have the account number, then the current balance, and in my example, it's in euros. So I have 49,955 euros on my account, and I have no open position. And currently the chart shows here the instrument, the euro US dollar, but we can select here another instrument. And here on the right hand side, we can see our favorites, but we can also change our favorites here. And we can add more instruments to our subscribed symbols. for example, a basket, so the US dollar basket. So that's pretty easy actually. And also buying and selling instruments works in the very same way as on Randa. So we can click here on buy and sell. And also here on the right hand side, we can click on buy and sell. And here we have the bid prices and the ask prices and the current spread. So for Euro US dollar, it's currently 1.3 pips. And we can see the change. And we have some more information here. So high prices, low prices, and more. And also we can change the layout, and I've selected the beginner layout, but we can also change this to the default layout or any other layout. And finally here at the bottom we can see a summary of our accounts. So I only have one account here, and I can see the balance and the equity and current orders, current open positions, closed positions, and more. So to sum up, there are only minor differences between Randa and FXCM, and both are pretty intuitive. So thanks for watching, and see you also in the next lecture. Bye. All right, we are back again here in the browser-based training platform, and now it's time for a trade. So let's assume we expect the euro to appreciate relative to the US dollar in the next couple of minutes. Then we should buy euro and sell US dollar. So we take a long position in the euro. And there are actually two options how to buy euro. So here in the chart, we have already selected the instrument euro US dollar, and we can click here on buy. And here we can see the current spread. And also we can click here on buy. And actually we could select the account, and also we can change the symbol here. And also we can decide whether we want to sell or buy euro. Then next, and most important, we can determine the number of units or the amount. And the amount is already in 1000 units. So if you want to buy 100,000 units, then we have to select here 100. And the per pip value is 8.38. And as my account is in euro, this is already the per pip value in euro. So the per pip value in dollar is 10. And the used margin or the required margin is also in euro. So these are essentially the settings that we need to create a market order. And once we are happy, then we can click here on OK. And immediately we can see that we have an open position in the symbol euro US dollar for 100 units. And actually here we can see that we buy the instrument at a price of 1.19298. And here we can see the current close price, so to say the current bid price. And here we have the current unrealized profit and loss. So currently it's minus 10. And this is also in euro currency because my account is in euro. And here's the profit and loss in pips. Now let's wait until we realize a profit. And actually to close the position, we have to click here on close and click on OK. And let's have a look. So let's go to closed positions. And indeed, we have realized a small profit of 5.07. So this is a profit in euro, and the pip profit is 0.7. And for the sake of completeness, let's check whether we have open orders or open positions. And this is not the case. So this is the summary of our trade, and in the next lecture, we will further analyze our trade. Thanks for watching, and see you there. Bye. We are here in our Excel sheet, and now let's analyze our previous trade. So this is here the screenshot. And we have in total 2 trades. And first of all, at 3 p.m. and 31 minutes, we opened a position, and we actually bought the instrument euro US dollar And in total, we have 100,000 units. So we have to be careful here because 1 unit already contains 1,000 euro. So 100 times 1,000 is 100,000 units. And we have bought 100,000 units at an open price, or to say ask price, of 1.19298. And then 2 minutes later, we closed the position at the prevailing bid price, 1.19305. And then again, we can calculate the trade value in US dollar by simply multiplying units times the price. And the change in the trade value is actually the profit in US dollar. So we have an increase in the trade value, and this results in a profit because we have a long position, so $7. And now in the next step, we can also calculate the profit in euro. So we can only see here the profit in euro. And the euro profit is calculated by having the dollar profit divided by the current exchange rate. So as applicable exchange rate, I used here the bid price. And I think that's not 100% correct, but this is a very good approximation. And indeed, we end up with a euro profit. So this is actually euro here. And let's select here euro. So we end up with a euro profit of 5.87 euro. And the profit in pips is 0.7, which is simply the difference in the exchange rate or the price times 10,000, because we have 1 pip in the fourth decimal actually. And we can see the profit in pips here. So we have the euro profit, we have the pip profit. And as we have 0 commissions, we also have a net profit in euros of 5.87. So this is the analysis, and unfortunately regarding to costs, FXCM isn't as transparent as Oanda. So we don't have any information on half spread costs or the prevailing spreads at the time when we execute our trades. So we can just estimate trading costs based on estimated spreads. And at the time when we actually executed the trades, the spread was around about between 1.1, 1.2, 1.3 pips. And therefore, as a rough estimation, trading costs were around about 11, 12, or 30 in US dollars. And therefore, we can also calculate the cross profit. And the cross profit was around about $20. So this was our example trade, and there isn't really any difference between FXCM and Oanda. Thanks for watching, and see you also in the next lecture. Bye. I am here on the FXCM trading platform, and here the large window is all about charting. And again, price charts are an important tool for day trading, and there are many options and different charts. However, the most commonly used type is the candlestick chart. And here we have the candlestick chart for the period from August till October 2020. And we have here daily granularity. So each candle stands for 1 day with open, high, low, and close prices. But of course, we can also change the granularity, for example, to 1 minute, 1 hour, 1 week, or whatsoever. And also we can change the chart type or the chart mode. However, FXCM provides less options than Oanda. So we can click here and change from candlestick chart to a chart line or a bar chart. And also we can get just the table with the prices. So this was a short introduction to charting here on the FXCM trading platform. Thanks for watching, and see you in the next lecture. Bye. In the Oanda section, we learned the difference between netting and hedging, and we learned that we should prefer netting as this minimizes trading costs. Now, by default, an account on Oanda is a netting account, and in contrast to that, here on FXCM, the practice account is a hedging account. So we can change the settings for FXCM live accounts But as far as I know, we cannot turn the practice account into a netting account. And we have to be aware of that fact. So let me demonstrate this one more time. And let's assume that you want to buy 100,000 euros. So let's simply click here on OK. And then we have here one open position, so one long or buy position in the euro. And now if we want to close that position, we have to click here. And actually, it's not a good idea to just take the reverse position. So just to sell 100,000 units. And by doing so, we create a second position. And from an economic point of view, we have actually closed the position, or we have fully hedged the position. But the problem here is now that we have two open positions and we have to close both positions. And therefore, actually, we have to pay the trading costs twice. Now, to close both positions, we can have here a right click. And then we have some options here. So we can close one position, we can close all positions, or we can close all positions for a symbol. So here we only have two positions for the same symbol. And we can either click on close all positions or close all for symbol. And then let's click on OK. And we have closed both positions. But of course, the problem here is that we have to pay the trading costs twice. So it's better to just close a position and not open a reverse position here on FXCM. So thanks for watching, and see you also in the next lecture. Bye. In the UNA section, we learned the difference between market, limit, and stop orders. And I also explained take profit and stop loss orders. And actually the same options and order types are available on the FXCM trading station as well. So we can create a market order by clicking here or here. So that's here a market order. But we can also open a position with a limit or stop order. And that are also called entry orders. So we can enter into a position based on a predefined price. And we can go here to trading, create entry order. So here we can determine the symbol and also if it's a buy or sell order and the amount. And then we can define the rate. So let's assume that we want to buy euro if the price slips below 1.7. So we don't have any open positions, but we have an open order. And we will buy 1,000 euros if the price slips below 1.17. And actually we can also remove the order here. And by default, the order expires at the end of the trading day. So let's again have a look here to the entry order. And we can also determine that we want to sell the euro once it reaches a certain price. So we can go here to a higher price or also a lower price like 1.16. Now typically we combine stop and limit orders with a trade to actually take profits or stop losses. And now let's buy here 100,000 units of euro US dollar. And if we click here on advanced, then here we can define a stop loss rate or also a take profit rate. So the stop loss rate must be below the current price. And the current price is 1.17. And we could say that we want to limit our loss once the price slips to 1.17. And here below we can see then the maximum loss, so 625 euro. And we can also set a take profit order here. And this must be at a price higher than the current price. So let's assume that we want to take the profit when the price reaches 1.19. And the maximum profit is here currently 1037. So let's open our position here with a take profit order. So here we can see our open position. It's a long position for 100,000 units. And also here we can see our take profit or limit order at 1.119. And here we can also change the price. So let's click here. And we can also delete or cancel our take profit order. And again, also here, if we close the position, then the limit order or stop orders are getting automatically cancelled as well. All right, thanks for watching and see you also in the next lecture. Bye. We are now able to make trades on the trading platforms. However, the plan is to trade with Python and to create Python algorithms to run our strategies. And therefore, in a very first step, we have to install Python. So in this section, I will show you how to install Python and all required packages and libraries and how to work with Jupyter Notebooks. And actually, I highly recommend to work with the full Anaconda installation. So Anaconda is a package manager that helps us to install all required packages and libraries in the right versions. Now, in case you already have a full Anaconda installation, you can skip the next lecture. However, please make sure that you have an updated installation. So you can update your Anaconda installation with the command conda update anaconda. And in case you are working on a Windows machine, you have to enter this command in the Anaconda prompt. And on Mac, it's a terminal window. Now, in case you have a Python installation other than the Anaconda installation, I highly recommend that you fully remove the other installation. So 2 parallel installations can cause many problems, in particular on Macs. So please remove the other installation. And of course, for those who haven't installed Python yet, the next 3 lectures will guide you through the installation steps. So thanks for watching and see you there. Bye. Alright, in this video I'm going to show you how to install Python and the Python data science ecosystem to your local device. And for many of you this should be a repetition, but the complete beginners among you will install Python now for the very first time. And no matter if you are a complete beginner or an experienced Python coder, whenever you want to primarily use Python for data science, machine learning, or algo trading purposes, then I highly recommend installing Anaconda. So let's go here to anaconda.com. And the Anaconda distribution not only installs Python, but also a complete and specialized environment for data science and machine learning with pre-installed packages that make it easier to manage dependencies and to resolve conflicts between packages. And that's why Anaconda is also called a package manager. And this is really important because incompatibility issues between packages can be a real pain. Now, unless you are already an expert, you should prefer the Anaconda installation over a Python default installation. And some students actually believe that installing Anaconda means working with Jupyter Notebooks. This is clearly a misbelief. So yes, Anaconda supports Jupyter Notebooks, and for some good reasons, we will heavily work with Jupyter Notebooks in this course, but Anaconda also supports other integrated development environment softwares, short IDEs, such as PyCharm or Spider. Now let's move on with the download and the installation. And actually you have the choice between start coding now here in the Anaconda cloud, or you can download and install Anaconda on your local device. And that's the plan for now here. So you could click here on get additional installers. And here you have the choice between Windows, Mac and Linux. So depending on which system you actually work. So if you are working on a Windows machine, then you should select here the 64-bit graphic installer. And for the Mac, I would recommend also the graphic installer. And for Linux, here the first choice, the first option. Now, here's an important message for Mac users and Linux users. So if you already have installed a Python default installation, then a second and parallel installation of Anaconda can cause a lot of problems later when installing additional packages and libraries. And therefore, my clear recommendation is please delete your Python default installation before installing Anaconda if you are working on Mac or Linux. So this is a clear recommendation unless you are an expert and can handle that additional complexity. But otherwise, please follow my recommendations and instructions. And as I'm working on a Windows machine, I click now on the Windows installer. And currently, so the current Python version is Python 3.10. But at any future point in time, so when you install Anaconda, then it could be a later version, so 3.11 or whatever. So in my case, it's 3.10. And let's click here on Save As. And for example, let's install here on the desktop, on my desktop. And then let's click here on Save. And this takes a couple of seconds. And now I'm going to my desktop, and here is the installer. And now let's double click. And then we actually start the installation. So welcome to the Anaconda 3 setup, and let's click on Next. And we agree on the user license agreement. And here we just install for us, so just me. And then by default, Anaconda 3 will be installed on your users or home folder, so in users. So, and I recommend that you don't change that. So just install Anaconda 3 in your users folder or home folder. And then you should check the boxes for create start menu shortcuts and register Anaconda 3 as my default Python 3.10 installation. So this is the recommended setting. And now let's click on install. And this should take a couple of seconds or minutes. All right, after a couple of minutes, we have successfully completed the installation and the setup. And let's click here on next. And here the reminder that you can also use the cloud. So let's click on next. And then of course you can find on Anaconda a lot of helpful tips and resources to get started. But of course in the next few lectures we will also cover the most important things and aspects. So let's click here on finish. And then we are coming to the starting page. So here is a short tutorial. And feel free to go through the tutorial here. But of course, we will cover the most important points also in the next lectures. Thanks for watching and see you there. Bye. In the last lecture, we have successfully downloaded and installed Anaconda. And now it's time to further explore our Anaconda installation. And most important, to code our very first coding lines. And first of all, let's go to the Anaconda Navigator, and we can search for the Anaconda Navigator simply here by typing Anaconda, and then you will simply find the Anaconda Navigator. And you could also pin this to the start or to your taskbar, so whatever you like. And now let's click on it and let's start the Anaconda Navigator. And loading takes a couple of seconds here. So this is here the Anaconda Navigator with all the apps and features that you can use. So we have here Jupyter Lab, Jupyter Notebook, and also some other apps here. And typically if you want to use them for the very first time, you have to click on install. And otherwise, if you have already installed them, you can simply launch them. But first of all, let me highlight that by default you have one environment installed, so the base environment. And actually a coding environment is a set of installed packages and libraries that you can use for your coding sessions. And we can check all installed packages and libraries of our base environment by going here to environment. And then we have the base environment, and here on the right, we can check all packages and libraries and their versions. So there are really many things that we have installed here. So let's go down, and for example, we have installed NumPy for numerical operations, and this is version 1.23.5. Then we have our actual Python installation, version 3.10.9. And another example would be the pandas library. So for handling and managing tabular data, version 1.53. Now, depending on your coding portfolio, it could make sense to create several environments for different tasks. So for example, it could be the case that one project is more stable with Python version 3.10 and another project is more stable with Python 3.9. So depending on the packages and libraries that you need, it could make sense to have different versions to make sure that your environment is compatible and that it works without any issues. But creating more environments is beyond the scope here. So by default, we are using the base environment. And let's go back here to the overview. And as you can see here, we have different development tools. So we can use Jupyter notebooks, but also other IDEs like Spider or PyCharm. And you can also download and install other IDEs. So you are completely flexible here. So one more time, let me highlight that Anaconda does not necessarily mean coding in Jupyter notebooks. But for now, let's go to the Jupyter dashboard. So we can click here on Jupyter Notebook. And it could be the case that for the very first time, you have to install it first. So this is the Jupyter dashboard, so kind of an overview where you can find all notebooks and all folders. And the Jupyter dashboard is actually a view on the folders of your local device. And by default, this is a view on your home or users folder. So if I check here, so this is my users folder, then you might see here that these are exactly the same folders. So by default, this is a view on your home folder. And for example, you can go then to a different folder. So for example, your desktop. So this is a view on my current desktop. Now, one important remark for those of you using Microsoft OneDrive. So typically the desktop is included in your OneDrive. So if you want to go here to your desktop, then you can't click here on desktop, but first you have to go to OneDrive. And in OneDrive, you will find the desktop folder. So this could be the case if you use Microsoft OneDrive. But now let's stay here in the users or home folder. And finally, it's time to create and open our very first Jupyter notebook. And either we can actually upload here a Jupyter notebook, or we can create a brand new Jupyter notebook. So Python 3. And by default, the name is untitled. And if you check here the Jupyter dashboard, then you can find here below the new Jupyter notebook untitled. And the suffix is here interactive Python notebook. And actually what you can see here is our very first coding line. And what we could do now, we could use Python simply as a calculator. So we could calculate 1 plus 2 or whatever. So we can simply type here 1 plus 2. And now, first of all, we have to run the cell. So we have to ask Python to interpret here our code. And to run a cell, we could go to run. We can click here on run. So this means run the cell. And then we get here an output. So the output is 3. And output actually means the result of the coding line. And here on the left, you can see that this is coding line number 1. And this is the output for coding line number 1. Now let's have a second calculation. And this time let's calculate 3 times 4. And there's also a second way how we can actually run a coding cell. So either we can click here on this button, or there's also a keyboard shortcut. So we can use Shift Enter. And let me demonstrate this. So now I will press Shift Enter. So I tap and hold the Shift key and then I press Enter. And then Python runs here the second coding line. So this is coding line number 2 and output number 2. So here on the left, you can see the running number of the cells. So this was the first one, and this is the second one. And the output is 12. So for the second coding line, we have used Shift Enter to run the cell. And additionally, we create a new cell below. So this is what Shift Enter actually does. So it runs the current coding line and it then creates a new coding line below. And there's also a third way how we can run a cell. So let's calculate 5 minus 2. And this time we can use the keyboard shortcut Alt-Enter. And if we press and hold Alt and then press the Enter key, then also here we get the result of the calculation. And then we are in a new coding cell below. So this is our very first Jupyter notebook and our very first coding lines. And we can also change the name of the Jupyter notebook from untitled to, for example, test 1. So let's click on rename. And then we have here test 1. And we can also check this here in the Jupyter dashboard. So it's now test 1. And actually, if you check your home or users folder, then you will also find here test 1. So once again, by default, this is a view on your users or home folder. And then we can also save the notebook and we can close the notebook. And finally, you can see here a green book. And to really close a Jupyter notebook, you have to check here the box and then click on shutdown. And then it is really closed. So this was the Anaconda Navigator, the Jupyter dashboard, and our very first Jupyter notebook. And for the sake of completeness, there's also a second option how you can open the Jupyter dashboard and how you can check your installed packages and libraries. So you can also do this via a command prompt or terminal window. So let's close here the Jupyter dashboard and also the Anaconda Navigator. And depending on your system, this works slightly different. So on Windows, you have to open the Anaconda prompt. So you can search here for Anaconda prompt. So this is how it works on a Windows machine, and on Mac, on Linux, you need to open a terminal window. So if you don't know how to open a terminal window, then also here you can go to search and type terminal, and then you will find the terminal window. And now, as I said, there's a second way how you can open the Jupyter dashboard by typing here the command Jupyter notebook. And finally, you have to press the Enter key. And also here now you are in the Jupyter dashboard, and for example, you can one more time open test 1. And let's close again here test 1 and the Jupyter dashboard. And let's reopen here Anaconda prompt. And also here in the command prompt, you can get a full list with all installed packages and libraries. And the right command is conda list. So you have to type conda list and then press the enter key. And then here you will find all installed packages and libraries and their corresponding versions. So this was an introduction to the Anaconda Navigator, the Jupyter Dashboard, Jupyter Notebook, and also the Anaconda prompt or the terminal window. And we will continue here in the next lecture. Thanks for watching and see you there. Bye. I'm back again here on my Jupyter dashboard, and now let's create another notebook. So for example, with the name calculator. So let's click here on rename. Now in this video I will explain major features and functionalities of a Jupyter Notebook and also some drawbacks. So coding with Jupyter Notebooks is really simple and intuitive, but still there are some pitfalls and potential error sources for beginners. But these errors can easily be avoided with a short tutorial, and that's one of the major goals of this lecture here. But first of all, let's start with the reasons why we should use Jupyter Notebooks. So the advantages of using Jupyter Notebooks. And these notebooks are so popular among Python coders and in particular among data scientists because a Jupyter Notebook is an interactive coding environment where you can not only create Python code, but also you can add other things such as texts, images, web links, and more. And in the research and science community, more and more research papers are exclusively written and shared in Jupyter Notebooks. And also for our course here, so for teaching and learning Python coding, Jupyter is, in my opinion, by far the best tool. And in the last lecture, we have seen that this is here a coding line or coding cell. And once again, we can just calculate 5 plus 2. And I've run here the cell with Shift Enter. Now a cell can have two different modes, the edit mode and the command mode. And if you go inside the cell with the mouse cursor, then you can see here the cell in green. And this is the edit mode, which means that now you can write code or text or whatever. So this is the edit mode. And if you click outside, then the color turns blue. And this is the command mode. And actually you can get more information on the command mode and the edit mode here under help and keyboard shortcuts. And here it says that a notebook has two different input modes. So the edit mode allows us to type code or text, and the command mode allows us to actually submit level commands. So here we can see some shortcuts of the command mode and the edit mode. So for example, in the command mode, we can actually insert cells, add cells, copy cells, and more. So currently we are here in cell 1 in the command mode, and with the keyboard shortcut B, so if we press the B key, then we can add a new cell below. And let's go again here into the first line, and with the keyboard shortcut A, we can add a cell above. And then we can also copy and paste cells. So let's go back here into this line. And let's press the C key to copy the cell. And then we can actually paste the copy with the V key. So now we kind of created a twin of the coding line number 1. And then we can also delete a coding cell in command mode by pressing 2 times the D key, so D. And actually there are also keyboard shortcuts to change from edit mode to command mode. So now we are in command mode. And by pressing the enter key, we can change to the edit mode. And then if we press escape, we go back to the command mode. So this is the difference between edit mode and command mode. And now let's continue. And before I have said that we can either write code or just text, and this depends here on the cell mode. And you can see here that by default the mode is code, so we write Python code, but we can also change this to markdown, and markdown simply means kind of text. So now if we run the cell, then we have the text 5 plus 2 and not the Python code 5 plus 2. And there also does exist a keyboard shortcut, so we can change from code to markdown by pressing M in the command mode. And then we can go back to code by pressing the Y key. And with this knowledge now, we can also create a title or a header for our notebook. So let's go in the next cell. Let's press the escape. And then we can change to markdown mode by pressing the M key. And for example, the title could be calculator. And we can also create specific headers. So with the hash key white space, then you can see that we were able to increase the letters. So this is a header 1, and by adding more hash keys, we can go to header 2, header 3, and so on. And with this, we can create a hierarchical structure here. So this is header number 1. And now we could also move the cell up, so to be the very first cell. And we can simply do this by clicking here on move selected cells up. So this is our first header, calculator. And then in the next step, we could also add an image. So I do have here an image of a calculator, and with a right mouse click, we can actually copy the image, and then we have to go into the cell and make sure that this is a markdown mode, and then we can simply paste the image and run the cell, and then we have now included here the image in our notebook, so the calculator. And now, for example, we can add a second hierarchy level. So let's add another cell here above with the A key. And then let's, for example, first of all start with addition. And here we could select a header with hierarchy 2. And we shouldn't forget to convert this into a markdown mode. So now we have here the subheader addition. And then we could also write plain text. So for example, please read the following. So an L is missing here. And then we could also add a web link. So for example, the Wikipedia article on additions. So let's copy. And let's paste here. And also here, we should make sure that we are in markdown mode. And then we can run the cell. So now we have included a web link here. And with this, we can actually start our coding session. So adding, for example, 5 plus 2 is 7. And now let's add some more cells with the B key. And here the result 7 is just an output, so the result of the calculation that we can't reuse here for further calculations. But very often in coding we need to reuse the results, and in these cases we have to save intermediate results in memory. And in Python we can save numbers, text, and more complex objects in variables. And for example, we could do the following. So we can save 5 in the variable a, and then we can also check the value of a, 5, and then we can save 2, for example, in the variable b, and we can also output here b in the very same coding cell. So this is totally fine. So we can have hundreds of coding lines in one cell, so this is no problem. So here we have 2, and then we can add a and b, so a plus b, and we can assign here the variable c. So we save the result of a plus b in the variable c, and then we can check and output the variable c, and here we have 7. And now what we can do, we can change the values of a and or b. So for example, let's assume that a should be 4. Then we can run here line 4 again. And now it's line 9. So a is equal to 4. And now it's important to understand that we do not automatically update here the result of c. So c is still 7. And if we want to update the calculation here with the new value for a, then we have to run here the coding line 7 again. And that's what I will do now. So we run it again, and then c is 6. And that's why the running numbers here on the left-hand side are very important, because they show us the sequence of our code. And if we know and understand the sequence of our code, then we also know and understand which coding steps we actually have in which sequence and what Python actually does. So if you follow the sequence of the coding lines, then you can understand what actually happens in your coding project or in your notebook. And actually another advantage of Jupyter Notebooks is that you can run each cell separately from other cells. So if you make a mistake in one cell, so for example, if you have a typo here, so you want to assign 4 to a, but you have kind of a typo here, so a equals b4 or whatever, then you will get here an error message. So Python does not know how to handle this. So syntax error, invalid syntax. But this error doesn't touch or influence other coding lines, and therefore we can simply adjust here the code and remove the error, and then we can move on. Now, as I said before, sequence matters, and you can move cells up and down by first of all marking the cell and then clicking here on move up or move down. And you can run the cells from the top to the bottom or in any sequence you like. But generally, you should make sure that your code follows the logical sequence from the top to the bottom. And after having developed a project, it definitely makes sense to restart the kernel and remove all outputs. So you can go to kernel and restart and clear the outputs. So now we are at the start again. And for example, now we haven't saved A, B, or C. So if we try to get A, then we get here an error. So name error, name A is not defined. So we haven't defined the variable A. And this is a typical beginner's error. So you simply forget to run previous coding cells. And then if you run a cell that actually requires the previous cells, then very likely you will get an error here. And you can identify the reason for this error at a very first glance. So you can see here the empty brackets. So you haven't run these cells. So this is the first coding line that you have run. And somewhere above, first of all, you have to create and define A. So before running this coding line, you need to run this one here. So this is a typical beginner's error. And now you can rerun all cells in the right sequence. And either you do this manually, so from the top to the bottom, or you can also go to cell and say I want to run all cells from the top to the bottom. And here we are. And actually this is also a very good error fixing tool. So if you get an error and if you don't know why you get that error, then very often it helps if you just restart the kernel and run all cells again from the top to the bottom. All right, so in the last lecture, we have seen that there are different ways how we can run a cell. And just for the sake of completeness, let me show you one more time the 3 different shortcuts, keyboard shortcuts. So if you go here to keyboard shortcuts and edit mode, and then we have here 3 options. So first, Shift Enter, so running the cell and selecting the cell below. Then we have Control Enter, so it runs the cell and stays in the very same cell. And finally, we also have Alt Enter, so it runs a cell and inserts a cell below. So let me just demonstrate this one more time. And first of all, let's restart the kernel and let's clear the outputs. And then I will run the very first coding line with Shift Enter. So we will run the cell and then we will automatically go to the next cell. And this is typically the first choice, so Shift Enter. But alternatively, you can also press Control Enter. And here you will stay in the very same cell. So again and again, you can run here the cell with Control Enter. And finally, we also have Alt Enter. And here you will create a new cell below. And finally, let me highlight one important thing that is a bit error prone. So once we have reached the end of our coding session, then we should save the Jupyter Notebook. And then we can leave the Jupyter Notebook and close it. And now, if we check here on the Jupyter dashboard, then still we can see that the notebook calculator is active. So here we have the notebook in green. And then if we reopen the notebook, then the code is still active and the variables are still saved in memory. So we can again get the value for A, which is still 4. But now, and this is very important, now if we save and close again, and now if we really shut down the notebook, then we will remove all variables from memory. And now if we open the notebook again, then still we can see here the results, so the outputs and the coding lines, but nothing is saved in memory. So now if we try to get A, then we get an error. And many beginners wonder why this happens. And the reason is simply that if you really shut down a notebook and open it again, then no variables are saved in memory anymore. And whenever you open a notebook, then first of all, you should restart and clear the output and code from scratch. And that's actually here the best solution. So this was a rather deep dive into Jupyter Notebooks and some of the most important functionalities. So I hope this will help you for your journey. Thanks for watching and see you in the next lectures and sections. Bye. All right, we have successfully installed Anaconda and I introduced Jupyter Notebooks. And I guess most of you are already familiar with the basics of Python coding. Now, if this is not the case and if you are a complete Python beginner, then at this point I highly recommend that you continue with the Python crash course. And you can find the crash course in the appendix. So here Appendix 1, Python, and also some finance basics. And it's best to go here through the complete section. And if you like, you can also go here through Appendix 2 and Appendix 3. So later on, you will also need some Pandas skills and Matplotlib skills and so on. So the appendix here and the crash course is for those students who haven't worked with Python before, or for those who want to refresh the skills. And otherwise, you can continue with the course. So trading with Python and Wanda and FXCM an introduction. So thanks for watching and see you in the next lectures. Bye. Alright, in this video you will have the chance to test and assess your debugging skills. So in the following few minutes I will create a couple of errors, and it's your job to identify and understand the error cause, and then you should also find a way to debug the error. And all questions are actually based on the following simple data set organized in a Python dictionary. So here we have the 5 most successful athletes in some Olympic Games of all times in terms of medals. And we have number 1, Michael Phelps, with 22 medals, followed by Larissa Latinina, 18 medals. And now let's start with the first error. So make yourself ready and feel free to pause the video if you need more time. Now here we have the first error, and we try to answer the following question. So how many medals did Michael Phelps win in his career? And we get here an error, and you should be able now to find the problem and to fix it. Now, what you see here is probably the most frequently made error, a simple typo, and not only complete beginners, but also very experienced coders accidentally make typos, so you can't avoid typos, but you should be able to see and fix these errors in no time. And in this example, the spelling for Michael Phelps is simply wrong. So here we have the following structure. So we have the last name, and then the first name separated by a comma white space, and obviously we forgot here the empty or the white space, and then there's also a second typo, so we mixed up E and A. So first is A and then we have E, and then our code is correct and we get 22. Now let's go back to the error. And most important, the error message gives you many helpful information about the error. So first of all, you should know that a dictionary consists of key value pairs. So here are the keys, and these are the values. And to get a value in the dictionary, we have to pass the corresponding key. So for example, Michael Phelps to the index operator, so square brackets. And Python marks here the line that causes the error. So here in this example, we only have one line, so my dict, and then we have here Michael Phelps within the index operator. So we can find the cause of the error here in this coding line. And then it says key error Michael Phelps, and this means that the key Michael Phelps in that spelling doesn't exist in the dictionary, which is true here. And you simply know now that you have to check the correct key here and compare it, and then you will see that the spelling is not correct. So you need an empty space here to get the right key. And that's it. So it's really simple if you know where to look at. So this was the first error, and now let's move on with the second error. And we have here question 2. How many medals did Michael Phelps and Takashi Ono win together? So we should simply add the values for those 2 athletes. And we get here a type error, and now you should identify and fix the problem. Now, the error message tells us that we have a problem here in this line. Of course, in this example, we only have this line, and it says we have a type error, and we try to add 2 numbers. So we have here an addition, and we have an unsupported operand type for addition. So we try to add an integer and a string. So it seems that this returns an integer, and this returns a string, and that's a problem here. So if you try to get the value for Takashi Ono, we get a string, and the reason for it is pretty simple if we have a look here above. So here we have the key value pair for Takashi Ono, and it seems that 13 is not an integer, but it's a string, and that's the reason why we can't make that addition here. So we can't add an integer and a string. This simply drops a type error. Now, debugging the error here is pretty simple and straightforward. So you simply have to remove the quotes from 13, and then you have to rerun it. And then you get here the right result, so it's 35. And now let's move on with the third example. And we should answer the following question here. So how many medals did Michael Phelps win more than Larissa Latinina? So in other words, the difference between Michael Phelps and Larissa Latinina. And this is here a subtraction, and we get here an error that you should be able to identify and fix now. All right, mixing up parentheses and square brackets is a very common issue, and it's no problem if it's just an accidental mix-up, so it happens to everyone. But in case you don't know and you don't understand the difference between these two, so square brackets and parentheses, then you should really improve your basic Python coding skills. So that's definitely a must-know. And it's typically covered in the first 1 or 2 hours of any Python for Beginners course. Now, square brackets are indexing operators that allow you to index and slice values in data containers like lists and dictionaries. And that's exactly the plan here. So we want to get the number of medals for Michael Phelps and Larissa Latinina and subtract those values. And we do it right for Michael Phelps, but for Larissa Latinina, we use parentheses instead of square brackets. And typically in Python, we use parentheses to call callables like functions and methods. And these are two completely different things. And since myDict is not a function, so it's a dictionary object, we can't call the dictionary object, and therefore the dictionary object is not a callable, and that's exactly what you can see here. So a dictionary object is not a callable, so you can index and slice a dictionary, but you can't call a dictionary, so a dictionary is not a method and not a function. So this was error number 3, and now let's move on with the last error. Now, the plan is here to convert the dictionary into a Panda series and to store the dataset in a Panda series. But obviously, we get here an error, and it's up to you to actually debug the error now. Now, omitting cells or not running cells is another very frequently made mistake. And it says here name error. So the name PD is not defined. And you try to create a Panda series with pd.series. But Python doesn't know PD. And therefore you should go up and see where you actually create PD. So here you try to import pandas as PD, but obviously, as you can see here on the left-hand side, you didn't run the cell import pandas as PD, and therefore you don't import the pandas library. And then if you try to convert the dictionary into a panda series, it simply doesn't work. So PD is simply not defined here, and therefore you should first of all import pandas, and then you can successfully create the panda series, my series. So that's all here. And with this we have reached the end of this little self-assessment quiz. And I would say that these errors are among the most commonly made errors by students, but I guess most of you will agree that these are rather simple errors. And just as a benchmark, so experienced coders will debug these kind of errors in less than 10 seconds. So in case you had some problems with the test, then this is a clear signal that you have to improve your debugging skills and maybe also your basic Python coding skills. And the good news is that you have the chance to improve your debugging skills in the next lectures. So thanks for watching and see you there. Bye. Alright, before you can debug your error, you should understand first why you get that error. And I've listed here 3 major categories. And first, and that's the most relevant category, there's simply a problem in the code itself. Then second, we have issues with your Python installation. And third, we have external factors. And the relevance is clearly in descending order. So most likely the code is just incorrect. And external factors is least likely. So we will cover these 2 categories later in this section. But now let's start with the code. And either the code itself is corrupted. So examples are typos, wrong indents, and inappropriate inputs. So for example, if you try to add a number and a string. And second, you just omit running coding lines or running cells in the wrong sequence. And I will demonstrate a couple of examples for this here in the next lectures. Thanks for watching and see you there. Bye. Now let's start with the most frequently made errors and mistakes. And maybe these errors are the hardest to debug because they are so simple and nuts that you don't even expect to make such an error. But good for you to know. Every coder does simple errors. That's a part of the game, and that's not the problem. But it is a problem if you can't easily fix them. And if you ever need to ask somebody else to debug one of the following simple errors, you owe him or her a drink if you ever meet him or her in person. And in my case, as I am from Bavaria, it won't be a small drink, it will be a very large drink like this one here. Just kidding, but now let's get serious and let's start with the first example. And here we have a dictionary with 2 European countries and their capitals. So we have Spain, Madrid, and France, Paris. And once again, here we are faced with a typo. And this time, the actual cause of the error is not in the line that drops the error. So it's in the previous line. So technically the error is in this line here because we try to get a value for a key that doesn't exist in the dictionary. But again, the real reason or the real cause is here above in the previous cell here in the data set. So I and A are simply reversed and we should fix that and then it works. Next, creating typos in variable names is also very common. So we have here the variable name mydict and we have here an underscore, and it can happen that we just forget the underscore and then we get here a name error. So the variable name mydict is not defined, and this should actually help you to find and identify the problem. So it's my underscore dict and not mydict. And then we have here a similar problem. So now instead of having an underscore, we have here a point. And coding-wise, these are 2 completely different things. So now Python assumes that we have an object my stored in the variable my, and then we try to call a method dict on the object my. And also here it says name error, so the variable name my is not defined. Now we have already seen the next error in our little quiz, so mixing up parentheses and square brackets. So our plan is here to actually get the value for the key Spain, and if we mix up square brackets and parentheses, then of course we get here an error. So the dict object myDict is a dictionary and it's not a callable. Now here in the next example, we forgot to close the quotes. So we open here the quotes, but we don't close quotes. And then we get here a syntax error. So Python expects us to close the quote here until the end of the line, but we just don't do it. And therefore we get here a syntax error. And then we can also get a typo when calling a method or when trying to get an attribute. So we have here the dictionary myDict, and we can get all keys with the method keys. And then we get here Spain and France. And it may easily happen that we forget here the S. So we try to call the method key, and this doesn't exist for dictionaries. So we have here a typo in a method or function name, and then we get here an attribute error. So a dictionary has no attribute or no method key. Finally, coming to the last example. So the following happens quite often when students transcribe the entire code from the videos. And just as a side note here, this is not necessary because you can download all notebooks with the complete code. But of course, it can be a good practice. But this is also very error prone. And obviously here, so let's run the cells. And we get here an error, so name error, my series is not defined. And obviously we simply forget to assign the panda series to a variable. So in other words, we forgot to save the series here in memory. And in this case here, the correct and full code includes here my series. So we assign the panda series to the variable my series, and then it works. And so thus we have reached the end of this lecture. So we have covered quite a lot of very simple errors, but these are very common and frequently made errors, and you should be aware of them. Thanks for watching, and see you in the next lecture. Bye. Now let's come to the next block of coding related errors, omitting cells, changing the sequence of cells, and similar problems. And let's see the following example here. So we import pandas, and then we create a dictionary with information on 5 football players. And then we convert the dictionary into a pandas data frame. And then here initially we have a range index, but we can set a column here of the data frame as the index. And for example, we can select the name column with the name of the football players. And we can set the index with the setIndex method. So let's first of all do it right. And then we have a data frame with an index here. So we have here the football players. And then we can easily select one row and one player with the log indexing operator. And for example, we can get the row with Lionel Messi. So we simply pass here the row label Lionel Messi to log. And then we get here the complete row with the nationality, club, world champion, height, and goals in the year 2018. So this is how it works if you don't omit a cell. And now let's restart here the kernel, and let's run the cells. And this time we just omit here the setIndex cell. So we don't set the name column as the new index. And therefore, if we try to select the row with the row label Lionel Messi, then of course we get here a key error. So, and this error message is rather long, but here we can see that this line is causing the error. And then here below we have more information on the error. So it's a key error, and the key Lionel Messi doesn't exist. Now, as you can see in this example, the most important part and the most important information in an error message you can actually find here at the very bottom here below. So it's a key error, and the key Lionel Messi doesn't exist. And now for those who haven't worked with Jupyter Notebooks before, let me show you another error source. So let's close here the Jupyter Notebook, and let's also shut the notebook down. And by shutting it down, we actually delete variables and so on. So now if we open the notebook again, then we can still see the sequence of the previous coding session, but this is meaningless. So now we haven't imported pandas, and now if we start here with this line, then you can see that actually this is the first line that we have actually run. And now if we move on, then we get here a name error, so we haven't imported pandas, so we need to run here the cell again. And now let's move on with the next example, and let's create a list with 3 elements: cat, dog, and elephant. And then we can append another element at the end of the list, so for example mouse, and then we can reverse the order with the reverse method, and then animals looks like this. So we have mouse, elephant, dog, and cat. And now let's assume that we accidentally change the sequence of the cells. So let's again create animals one more time. And then first of all, we reverse the order, and then we append mouse. Then the final outcome or the final output is different. So in this case, we don't get an error, but the data is simply different. So now animal looks different. Elephant, dog, cat, and mouse, and also this can cause many problems. And finally, let's head to another example. So we had omitting a cell, we had changing the sequence, and finally, let's consider an example where we run a cell multiple times. And first of all, let's create animals one more time with cat, dog, elephant, and mouse. And now with the pop, we can actually remove one element. So for example, the last element, and we can return or output the element. So if we run pop only once, then we remove mouse from animals. And therefore we have still 3 elements here: cat, dog, and elephant. And then if we try to get the third element at index position 2, then we get elephant. So this works fine, but now it could happen that we run here a cell twice. So let's run it here for the first time, and we remove mouse. And then if we run it a second time, then we also remove elephant. And now we are left with 2 elements, cat and dog. And if we try now to get the third element, then we get here an index error, so list index is out of range. So there's no element at index position 2 because we only have 2 elements here. Now in all these cases, debugging and fixing the problem with code is rather complex, as we corrupted the data structure. And I don't want to say that we corrupted the data irreversibly, but it takes a couple of steps to reverse and fix the problem with code. And therefore, in these cases, it's just best to restart the kernel and clear the output. And then we can run the code in the right sequence again. And then we get the right output. And it's like with a mobile phone or a computer. So if you have a coding problem, and if you don't know why you have that problem, then shutting it down and restarting it very often helps and fixes the problem. So thanks for watching, and see you in the next lecture. Bye. We have already seen 1 or 2 index errors, and now let's see some more examples. And in most of my courses, I work a lot with pandas data frames, and also with pandas you can create index errors. So let's have an example. And let's again create a data frame with 5 football players. So essentially we have here 6 columns and 5 rows. And then we can perform position-based indexing on a data frame with the ilog operator. And for example, we can get the 7th column at index position 6. And as we only have 6 columns, we get here an index error, and it says that the single positional index is out of bounds. So we don't have 7 columns. And likewise, we can also try to get the 6th row with ilog 5, so at index position 5. And as we only have 5 rows, we get another index error here. So these are data frames. And the same we can also do with lists. So again, we have the list animals with 4 elements. And if we try to get the 5th element at index position 4, then also here we get an index error. So the list index 4 is out of range. And we can also perform here negative indexing. So we could try to get the 5th last element with -5. And also here, as we only have 4 elements, we get here an index error. And finally, let me shed some more light on typical index error causes. So very often you will find the actual reason for the error not in the line that actually drops the error, but in one of the previous cells. And let's have a look at an example here. So we have the list names with 4 names, John, Paul, Mary, and Anne. And then we try to get all names starting with an A, so in capital A with a for loop here. So we create an empty list, my list, and we try to save all names starting with an A here in my list. So we iterate over names, and if the first element in the name is equal to capital A, then we append the name to my list. And now if we run the cell here, we have updated my list. And now if you want to get the very first name starting with an A, then we get here an index error. And the reason is pretty simple. So my list is still empty. And the reason is pretty simple. So none of the names here start with a capital A. So we have Anne here, but we have a lowercase a. And there are actually 2 ways how we can fix the problem. So either we capitalize the names, or we use here a lowercase a. And now if we rerun here the code, then we get Anne. And once again, please note that very often you need to inspect previous cells to identify and debug the error. So let's again create the error here. And now if you only inspect the line that drops the error, then there's no chance to actually see the cause or the reason for the error. So we have my list and 0, and this looks okay. And the students tend to focus only on the very last line that drops the error. And if they create a screenshot only here with the very last line and ask why they get an error here, then there's actually no chance to help here. So what we can say here, that obviously my list is an empty list, but we can't say anything about the reason for it. And there's no chance to fix the problem here and to debug the error without inspecting the previous cells. So please keep in mind, you should also inspect the previous cells to identify and debug the error. Thanks for watching, and see you in the next lecture. Bye. Setting the right indents and debugging indentation errors can be a challenging task. So imagine a very complex code with nested for loops and if-elif statements. Indentation can be a real pain, but the general mechanics are always the same. And essentially 2 things can go wrong here. So either you create an unexpected indent where there shouldn't be any, or you forget to set a required indent. And now let's have a look at 2 examples here. So here we create the dictionary with 2 key value pairs. And then we have here a second line in this coding cell. So we simply return my dict. And actually, when working in Jupyter Notebooks, whenever you have multiple lines in one coding cell, so here we have 2 lines, then you have to care about indentation. And for example, if you create a simple white space or empty space here in the second line, then you get here an indentation error. So Python views this here as an indent, and there shouldn't be any indent here. And also if you create a kind of a real indent with the tab key, then you get here the indentation error. So both lines here in our coding cell should start at the very beginning here, and then it works. And just as a side note, so if you only have one line here in one cell, then it is less restrictive. So you can create here a white space, or you can create a full indent with the tab key, so it still works. But of course, creating here an indent that is not required is definitely a bad habit, so don't do it. So this was the example where we created an unexpected indent, and now let's move on to an example where we need an indent, and the best example is actually a for loop. So we can iterate over my dictionary, and we can print key value pairs with mydict.items. So there we create tuples with the key value pairs, and then we can simply print key value pairs. So let's run here the cell, and here we get Spain, Madrid, and France, Paris, and Python automatically creates here an indent if we press the enter key after the colon. And now if we accidentally remove the indent, then we get here another indentation error. So Python expected here an indented block, but we have no indent here, and therefore we should create one. So this was a brief overview on indentation errors, but again, it can be a lot more complex. But again, the general mechanics and the reasons for errors are always the same. So either you create an unexpected indent or you forget a required indent. So that's it. Thanks for watching, and see you in the next lectures. Bye. Alright, the misuse of Python keywords and built-in function names is another no-go in Python coding that can cause many problems. And let's see 2 simple examples here. So let's create a tuple, my tuple, with the elements 0, 1, 2, and 3. So here we have the tuple, my tuple, and then we can convert a tuple into a list with the Python built-in function list. And so we can simply pass here my tuple to list and create my list. So this works perfectly. And now the following is a very frequently made error, because it's always beneficial to use meaningful and self-explanatory variable names. So intuitively it makes a lot of sense to assign a list to the variable name list. So let's assume that we want to create a list with the elements 4, 5, 6, 7. Then intuitively you could assign this list here to the variable name list. And you can do that here and it works, but as a consequence, you actually override the list as a function. And now if you try to convert my tuple one more time to a list by using a list, then you get here an error, because the list is no longer a built-in function. So it's just the list object with the elements 4, 5, 6, 7, and a list object is not callable. So list is a Python built-in function, but the simple rule applies also for other Python functions. And now let's move on to Python keywords. And the good news is that typically you can't misuse Python keywords like for, break, continue, or whatever as a variable name. So if you try to do so, you get a syntax error. And as an example, if you try to save a list with 3 Formula 1 drivers in the variable name for, then it won't work here. So you get a syntax error. And actually you might have observed that here in Jupyter Notebooks, Python keywords and also function names are highlighted in green. So if you see something highlighted in green, then you shouldn't try to misuse that as a variable name. And that's all you have to know here. Thanks for watching, and see you in the next lecture. Bye. In this lecture, we will cover type errors and value errors. And at a first glance, these error types seem to be similar, but there's one major difference. So a type error is raised whenever an operation is performed on an incorrect or unsupported object type. And in contrast, a Python value error is raised when a function receives an argument of the correct type, but an inappropriate value. And now let's simply have a look at some examples here. And let's start with the type errors. So we save here 3 as an integer and 4 as a string in the variable names a and b. And now if we try to add a and b, then we get a type error. So we can't add an integer and a string. So this is simply not defined. And likewise, we could also create a string with 3 fractions. So let's assume that we want to create the message a present for you, and we have a present in A, then we have the integer 4 saved in B, and finally we have U in C. And then if we try to concatenate the strings into one message, then also here we get a type error. So we can't concatenate string and integers, so we can only concatenate string and string. And for example, we could turn here the integer into a string, and then it works, a present for you. So these were 2 examples for type errors. So we try to perform an operation with incorrect or unsupported object types. And now let's move on with value errors. And for example, we could turn a string into an integer. So for example, the string 5. And then we have here now the integer 5. So we can pass the strings to the function integer, but this only works if in the string Python can find a number. And for example, dog is an example that doesn't work. And in this example, we get here a value error. So we have here an invalid string, and we can't pass here dog to integer. Next, let's create the list mylist with 3 elements, cat, dog, and mouse. And then we can remove an element with the remove method. So generally, we can pass here a string to remove, but if we pass a value that is not in the list, for example, elephant, then we get here a value error. So X, elephant, is not in the list. And finally, let's conclude this video with a math example. So first of all, let's import math. And then with the method square root, we can calculate the square root for a number. So for example, 4. And the square root of 4 is, for example, 2. But now if we try to pass a negative number, so for example, -1, then we get here a value error. And the reason is pretty simple. So we can't calculate the square root for a negative number. This is mathematically not defined unless you are in the world of complex numbers, but that's a completely different story. Thanks for watching, and see you in the next lecture. Bye. In one of the first videos, I said that coders just need the ability, and even more important, the willingness to read carefully and to use common sense to fix most of their coding issues. And that's definitely true. So I guess you agree that the errors and the error messages which we have seen so far were pretty intuitive and simple to understand. But of course it can happen, and it will happen, that you don't understand an error. And in this case, Google and StackOverflow.com are pretty much your best friends. And if you haven't heard of it yet, so Stack Overflow is if not the community for coders. And there you can find the questions and answers to pretty much any coding problem that exists. So it's very likely that you will find an answer to your question there. And if not, you can create an account on Stack Overflow and raise your coding issues there. And typically you will get fast and multiple responses there. Now, good news is that you can read in the Stack Overflow community without an account. And now let's have an example here. So a pandas example. And this example is maybe less intuitive and less simple to fix, at least for beginners. So let's import pandas and let's create a dictionary with 5 football players. And let's turn the dictionary here into a data frame. And now the plan is to get the 3 tallest players. And we can do this with the pandas data frame method n largest. So we can go here inside with shift tab. And essentially we have here 2 major parameters, n and columns. And n largest actually returns the first n rows ordered by the column that you need. So in our example, n should be 3, and the column of interest should be the height. And now if we run the cell here, we get a syntax error, and it says positional argument follows keyword argument. Now, if you haven't heard of that before, and if you don't know the difference between a keyword argument and a positional argument, then it's pretty hard to understand this error here. But what you can do, you can simply copy and paste the error and paste it here into Google. And very likely you will get many results. And for example, here we have the statement, the error positional argument follows keyword arguments, means that if any keyword argument is used in the function call, then it should always be followed by keyword arguments. So still, this is not really useful if you don't know what a keyword argument and a positional argument is. And typically you find more results from Stack Overflow. So this question has been asked multiple times before on Stack Overflow. And let's simply go to one instance here. And obviously here's one coder that experienced the positional argument follows keyword argument problem. And then here we have a very good answer. So this user says that there are 2 types of arguments when we run a function or a method, positional and keyword. And for example, let's create here a user-defined function where we simply add 2 integers or 2 numbers, a and b, and then we can call the function only with positional arguments. So for example, 4 plus 4 gives 8, or we can use keyword arguments. And if we use keyword arguments, we explicitly use here the arguments. So a equals 4 and b equals 4. And before we had positional arguments. So Python knows and assumes here that this 4 is addressed to a and this 4 for b. And both alternatives work here. So you can either use only positional arguments or keyword arguments. But there are 2 more options, and very often it is the case that in a function or in a method, you know the very first parameter, and then you simply pass here the first argument to the first parameter as a positional argument, and then for the next arguments, you use keyword arguments, and this is totally fine, so also this option works. But now if you try to start with a keyword argument followed by a positional argument, so this doesn't work. So whenever you use your first keyword argument, then you can only continue with keyword arguments. So if a positional argument follows a keyword argument, then this drops an error here. And what we can simply do, we can now use here 2 keyword arguments. So we can add here columns, and then we get the 3 tallest players. Or alternatively, we can use a positional argument followed by a keyword argument. Or last but not least, we can only use the positional arguments. So in this case, this works. Now, to sum up here in this case, we didn't know and we didn't understand the problem, but for the vast majority of coding problems, you will find an answer on the Stack Overflow or with Google in general. And in our case, it took us 2 minutes or so. So Stack Overflow is a great tool and a must-have for any coder. And so thus we have reached the end of this lecture. Thanks for watching and see you in the next one. We have seen before that very often the reason for an error is not in the line that actually drops the error message. So it's somewhere in the previous code. And in more complex projects with more complex code, that is actually the normal case. But we don't have to go through hundreds or thousands of coding lines to find the problem, because Python helps us to trace back the error. So in one of the earlier videos, I said that the error message contains a lot of helpful information. And so far, we just scratched the surface here. And now let's consider a more complex example. And let me just use a trading strategy backtesting example. So we need a couple of packages and libraries like pandas, numpy, and matplotlib. And then we have here the class conBacktester, so that's a class for the vectorized backtesting of simple contrarian trading strategies. And we have here quite a lot of methods and many coding lines. And now let's define here the class. And probably you haven't seen this code before, and at a first glance you don't understand too much here. But the key message is it doesn't matter, because Python allows you to trace back an error in no time, and at least you can localize and narrow down the problem. And finally you can say, okay, this method or even this single line of code causes the problem. And that's actually pretty great. So let's go on here with our example. And first of all, we need some inputs for our backtest, and then we create an instance of the conBacktester class with the inputs saved in tester. And then we run here one method of the backtester class, the test strategy method. And we pass here the argument 51 to the Windows parameter. And now when calling the method here, Python drops an error message. So we have here an attribute error. And the error message or the traceback here is rather long. And actually Python prints this message here or this traceback when an error is raised in our code. And it can be overwhelming here for beginners, but the Python traceback has a wealth of information that can help you to identify the cause of the error. And understanding what information a Python traceback provides is vital to becoming a better Python coder. Now, we can always find the most important and the most helpful information here at the bottom. So here we can see the type of the error, an attribute error, and some more specific and helpful information for understanding the reason. So it says here that the conBacktester class object has no attribute TP here, so that's pretty helpful. And then here above we can actually trace back the error. So we can see here a sequence of calls from the oldest to the latest call, and you can either analyze the traceback from the top to the bottom, so from the oldest to the latest, or from the bottom to the top. And it depends on the case, and it is also a matter of taste. But here in this example, I would prefer to start here at the top. And before we start, we should go here to view and toggle line numbers. And Python creates here line numbers for each and every cell. And obviously we get here an error when we call the method test strategy. So in this Python module, which means here in this Jupyter notebook in line 5 or cell 5, when calling the method test strategy, and therefore to further understand what was going wrong, we have to go inside the test strategy method. and we actually call or define test strategy here in this Jupyter notebook in a line or in cell 2. So this is cell 2 where we define the class, and we have to go to line 92 where we call the method print performance in this test strategy method. So let's go here up to line 92. So here we have the test strategy method, and in line 92 we call the method print performance. And then we go further down the road inside the method print performance that we can also find here in cell 2. And then inside print performance, we have line number 200, where we actually try to calculate the annualized mean. And we do this by calling the method calculate annualized mean. And it seems that here's the problem actually. So let's go up again to line 200 here inside print performance. And here's the problem. So here we call calculate annualized mean, and there might be a problem in this method. So let's go down again. And then here in the next step, we are in the method calculate annualized mean. And also this we can find here in cell 2. And then we should go to line 239 to this coding line where we actually return and calculate the annualized mean. So now let's go to 239. And the problem is that we try to get here the attribute TP year, but this doesn't exist. Now here we have the method calculate annualized mean and line 239, and here's the problem. So we try to get the attribute TP year, and this doesn't exist. And if you look here around, then it seems that the attribute TP_year exists, and it seems to be a simple typo. And we can also go here up, and then we can see that we create the attribute TP_year already here in the dunder init method. So this was a simple typo. And just by using here the traceback, we can actually localize the error. So starting at test strategy, then we go down to print performance, then to calculate annualized mean. And finally, we find the line that actually causes the error. And in this case, it's a simple typo. So we have to add here or include the underslash, and that's all. So now let's rerun here the cells, and let's redefine the class. And let's again run the backtest. And this time we get here a nice printout with the performance measures of our strategy here. Finally, let's have another example where a package or library is included. So in our case now, the pandas library. So I've added an error in the code that actually touches the pandas library. And let's again run here the cells. And now let's run here the backtest, and we should get another error. So it's once again an attribute error. And we start here with the method test strategy. Then the traceback leads us to print performance, and then again to calculate annualized mean. And also here the problem is in line 239. And now in the next step, we go inside the pandas library. And there we find the problem in line 5465. So there's no need to go inside a package or library, for example, a pandas library. But it says here that a panda series object has no attribute or no method main, so it should be mean, but there's a spelling error, and we find that error here in line 239 here. in this row. And it seems that we have here just a simple typo. So let's go up. And then let's correct the error here. So series.mean. And then we can run here the code. And we have successfully debugged the error. Now, as you can see, you can debug or at least localize and narrow down the reason of an error, even if you don't know and understand the underlying code. So you can simply trace back the error and say that, okay, in this line of code or in this method, we actually have the reason for the error. And that's actually a pretty great finding here. Thanks for watching, and see you in the next lecture. Bye. Alright, corrupted code is the major reason for errors, but sometimes, while the code itself is correct, there could be a problem in the Python installation, and we can actually identify 3 different issues. So first of all, we have missing packages or libraries in the installation. Then second, we have old or outdated versions. And third, we have a corrupted installation. So for example, multiple conflicting installations or inconsistencies in the installation. And now let's move on with the simplest problem, so missing packages and libraries. And actually many packages and libraries are already pre-installed in the full Anaconda installation. So we have here the important data science libraries, pandas, numpy, matplotlib, scipy, and seaborn, and many more. And if you have a full Anaconda installation, then you shouldn't have any problems to import them. And if you have problems, then this is a clear signal that there's a severe issue with your Anaconda installation. So maybe you have installed Miniconda, which is only a minimum installation. And I do recommend to actually install the full Anaconda installation. Then you shouldn't have any issues to import these packages and libraries. And second, there are more packages and libraries in the Conda list, but not necessarily pre-installed. So for example, the pandas data reader, and you can install the pandas data reader with the command conda install pandas data reader. So you have to enter this command into Anaconda prompt or a terminal window if you are working on Mac. So this is here Anaconda prompt as I'm working on a Windows machine. And second, if you want to install packages and libraries that are not in the Anaconda list, then you have to install them with the command pip install and then the package name. So for example, fxcmpy. Now the Twitter package is another package that we have to install with pip install, and currently I haven't installed the Twitter, and now if I try to import it with import Twitter, then I should get an error here, and it's the module not found error. So no module or no package named Twitter, and this is a clear sign or indication that you simply haven't downloaded and installed that package or library. And in this case, I could install Twitter with the command pip install Twitter. So I don't run it now. Now, Mac users frequently contact me and say that they have installed a package with pip install, but they can't find it in Anaconda, and they get the module not found error. And all these Mac users have one thing in common. So they do have 2 or many separate and conflicting Python installations installed. And typically it's one full Anaconda installation and a default Python 3.x installation. And what's going wrong here? So if they try to enter the command pip install package name in the terminal, then by default it adds the package to the default Python 3.x installation and not to the full Anaconda installation. And there's a workaround for this, but it's rather complex and error prone. And therefore my clear message is here. So either you can handle multiple installations and fix those problems that are a direct consequence of it, or you can't handle it and then you should avoid multiple installations. Now, generally when talking about installation problems, avoiding is better and more simple than debugging. So you can avoid installation problems by carefully installing and maintaining and updating a sound installation. And this includes, among others, following the installation steps that you can find in the course. And for example, you should avoid parallel installations, in particular when working on Mac. And then in the next step, you should frequently update your installation with the commands conda update anaconda and conda update conda. And you can also upgrade or update packages and libraries that you have installed with pip with the command pip install the package upgrade. And alternatively, if it's just a missing or a outdated package, then you should try to install or update that package. But in case you get errors and problems in the prompt or in the terminal here, when you try to install or update a package, then this is a clear signal for a corrupted installation with inconsistencies and more. And at this point, it's getting really difficult to find the problem from the distance. And what you can actually do here, so you can try to check on Stack Overflow for these errors. But in my experience, it's typically the fastest solution to fully remove and reinstall your installation. So that's the ultimate solution that always works. And with this final word, we are here at the end of this lecture, and I'm looking forward to seeing you in the next one. Bye. We have already covered code issues and problems with the Python installation, and now the third category is external factors. And these external factors can lead to problems and coding errors. And typically, external factors can play a role when communicating with web APIs or when scraping data from websites and servers with Python, and loading financial data from the web or making orders and trades with an online broker or trading platform is a good example for this. And a couple of things can go wrong here. So there could be a weak and corrupted internet connectivity, and also on the other side, the server errors. So if you try to pull data from, for example, Twitter, and the Twitter server is down, then you can't do anything here. Next, we have authentication issues. And sometimes you need login credentials like an API key to connect, and errors could arise if the key is incorrect or expired. Then moving on to eligibility issues. So in some countries and locations, some API calls are prohibited. So for example, buying cryptocurrency futures. And in case you are located in such a country, then you simply get an error if you try to actually call or use these prohibited API calls. And finally, students who code with a company device from time to time report firewall issues or admin right issues. And this could lead to the situation that some API calls are getting blocked. Or it could also happen that students can't install certain Python packages and libraries due to admin right issues. So these are the major problems caused by external factors. And now let me just drop some more thoughts on this. So typically external factors and errors caused by these factors pop up when using web API related or more special libraries such as requests, YFinance, AlphaVantage, FXCMPy, TPQoA, V20, Python Binance, CCXC, Axelwings, and more. So this is just a small selection of special packages and libraries that I use in my courses here. And actually some problems and errors caused by external factors are beyond the coders and also beyond my control. So for example, server downs. So you and I, we can't do anything if the Twitter server breaks down. Now, the most important question is how to debug such errors, and typically there's no one-fits-all solution, but I do highlight the frequent problems in the course, and you should carefully watch those videos and check the previous and also the next lectures if you have a problem in one lecture. So typically I add special troubleshooting lectures from time to time that actually address student problems. And the title of these lectures actually contain the word troubleshooting, so you can't actually miss those lectures. And finally, you should search in the Q&A board for similar issues. So typically problems caused by external factors pop up from time to time, and it might be the case that your fellow students already asked this question or addressed this problem in the Q&A board. And last but not least, then I guess this is a no-brainer. But anyway, so for those who work with a company device and get restricted by firewall issues, admin rights or company guidelines or whatever, so there isn't anything I can do here for you. And in all these cases, you should talk to your company's IT or the legal department. So thanks a lot and see you in the next lecture. Bye. Now let me come to an important aspect, errors relating to the course content and to the code that you can find in the videos and in the notebooks. And first of all, I'm happy to highlight one more time that you can download all notebooks, exercises and coding lines. And if you closely follow the course, then you actually can't miss it. But you can also get that information in the student FAQ lecture. So that's one of the very first lectures of the entire course in the Getting Started section. Now, generally you should assume that the code is correct and up to date and free of errors. But from time to time, parts of the code can get outdated when new versions are available, and I do my best to keep the code updated and fix the problems as soon as possible. So if you get an error, then it's pretty unlikely that the code itself is incorrect, and sometimes I intentionally create errors for demonstration purposes, but I do explain and highlight that in the video. Now, that's a really good question here. So how is it then possible to get errors in the first place? And also here we have the three major categories. So incorrect code, for example, because you changed the code in the notebooks. Then second, we have a corrupted Python installation. And third, external factors. And by far the most important reason is the following. So most errors arise when students transcribe the full code, so line for line and word for word from the videos. And this typically leads to many simple errors, so simple transcription errors. And let me comment on this in more detail. So transcribing code from the videos. And after having taught many students, so more than 50,000 in coding, my clear message is that transcribing code line for line and word for word is not a successful learning method. And that holds true at least for the vast majority of students. And it's important to understand that the writing code, so copying code, and coding, so creating code, are two completely different things. And it's no surprise that creating code, so coding, is more useful than just transcribing or copying code. Because the simple reason is that the human brain is simply not good at copying things. So this is very error prone, and everyone does a lot of copy and transcription errors when copying thousands of lines of code. And as a direct consequence, the attention typically shifts away from understanding the code to avoiding and debugging simple transcription errors. And therefore, in the end, transcribing code is very time consuming and has only very little use. Now, even if you decide to transcribe large parts of the videos, then please keep in mind that now you should be able to debug your transcription errors. And even more important, you already have the correct code in your files, so you simply can download the correct code. But I definitely recommend the following more efficient and more effective learning method. So you should download and use the notebooks and carefully watch the videos, and then run the code in the notebooks and play around with it. And then, if available, do the exercises. And finally, then you should be able to use and adjust the code for your own projects. So real coding starts here when you create code on your own. So that's the key message here. Thanks for watching and see you in the next video. Bye. In this lecture, we will repeat and sum up what we have learned in this section, and I will provide a very helpful debugging flowchart. So if you follow the steps carefully, then it's very likely that you will be able to debug the error in just a few minutes or even seconds. And now let's start with the error. And the error could be a true error with an error message, or alternatively an unexpected output. So the flowchart works in both cases. And if your code drops an error, then first of all, you should read the error carefully. And we have seen before that the most informative part is at the bottom. So there you will find the error type and more details. And in many cases, this is sufficient to identify and fix the issue. And if not, in the next step, you should inspect your code, and it's important to also include previous cells. So typically the coding line that drops the error does not cause the error, and you can use the error message to trace back the error. Now, if that doesn't help, you should then restart the kernel and run all cells in the right sequence, and in many cases this fixes the problem. Finally, in case your error is related to the course content, then you should download and run the course notebook. And again, this is available for download, and if that works, then there is a coding error in your code, and you should then compare it to find the problem. And after this step here, if it still doesn't work, at least you can be pretty sure that the code itself is correct, so there's not a problem in the code itself. So there could be a problem with your installation, and of course if the error type is a module not found error, then already here at this step you know that it must be something with your installation. And in any case, you should keep your installation up to date, and sometimes a simple update with the command conda update anaconda fixes the problem. And if not, you should copy the error and make a Google search and also search on Stack Overflow. And if also this doesn't help, then you should rewatch the video, and maybe you have missed anything, and you should also check the previous and the next lectures. So sometimes you can find a troubleshooting lecture directly before or after a lecture. And finally, if all that doesn't work, you should go to the Q&A board, so the course Q&A board, and check the board for similar questions and problems. And in particular, you should check the questions attached to that lecture where you have the problems. And in case you don't find similar questions, then feel free to create a new one. And that's the debugging flowchart, and I guess you will be able to fix most of your errors within 1 or 5 minutes. And here the full process until and including these steps shouldn't take longer than 20 to 30 minutes. Now, with regard to Q&A board questions, my team and I, we do our best to answer questions within 2 to 4 business days. But in reality, in particular when dealing with errors, it can take longer, so a week or even more, because very often important information is missing, and then we have to turn loops and ask you for more information. So that's not only for you, but also for us a waste of time. And therefore, if you need our help, then you should provide the following information in your question. So your question must contain the following information. So first of all, the lecture number or the lecture title, and your question should be attached to the relevant lecture, and then a brief description, so maybe 1 or 2 sentences. And then most important, you should attach a screenshot with your code, and keep in mind that also the previous coding lines are important. And then even more important, we need the full error message. So don't cut the error message, because the most informative parts are at the very bottom. Then next, you should confirm that you get that error also when running the course notebook. So you should download the notebook and run the notebook. And then you should confirm that you still get the error with the correct code. And by doing so, we make sure that it's actually not the code that causes the problem here. Next, you should provide some more information on your installation. So for example, the Python 3.8 version, and also for other involved packages. So if you code with pandas and pandas drops an error, then you should provide the pandas version. And of course, you should make sure that you have an updated installation. And also the operating system can help. So there are minor differences between Windows, Mac, and Linux. And this is an optional point here. So if the error and the question is related to API calls, and in particular to algo trading activities, then it's important to know your location. So maybe you are trading, or you try to trade from a location that is actually a prohibited location. So that's an important information. And finally, you could also provide other measures that you have taken to fix it. So for example, relevant Google search results or Stack Overflow links. And with all that information, you will get a proper answer within 2 to 4 business days. And thanks for your cooperation in advance. And with this, we have reached the end of this section. And once again, if there's one thing where many students have insufficient skills, then it's the ability to handle and debug coding errors. And in reality, that is a must-have skill if you ever want to work on more advanced projects. So with this section here, I hope I contributed to make you a better coder. Thanks for watching, and see you in the next sections. Bye. Welcome to section 6. This is an introduction to trading with Python by using the Wanda API and the FXCM API. And actually, there's no need to trade directly on the web platforms. So we can also create a connection via the APIs and trade from and with Python. So API stands for Application Programming Interface, and we will see this in more detail in one of the next lectures here. So in this section, we will cover Wanda and FXCM, and this time you can either watch the Wanda part or the FXCM part. And if you only have an Wanda account, so you can just watch the Wanda part here. And you can skip the FXCM part. And in case you only have an FXCM account, you can skip the Wanda part and just watch the videos on FXCM. And of course, in case you have both accounts, feel free to watch both parts. So thanks for watching, and looking forward to seeing you in these lectures. Bye. Alright, we are here on the Wanda API website, and API stands for Application Programming Interface. So let's click on REST v20. And actually, the Wanda v20 REST API provides programmatic access to the Wanda trading engine. And that means that we can get market data like real-time rates, also historical pricing information dating back to 2005 from Wanda via the API. And also we can place orders and execute trades from our own web app or from our Python environment without the need to log in to the browser-based trading platform. Now, to get access to the API with Python, we need to download and install the v20 package. And in addition to that, we can also download and install the API wrapper package TPQOA provided by the Python quants that makes trading with the Uanda API really easy and straightforward. So with this wrapper package, there's no need to go here inside the details of the Uanda API. But of course, feel free to do that if you are interested in that. So now let's open the Anaconda prompt or a terminal window in case you are working on a Mac. So here's the Anaconda prompt. And also let's open the immediately preceding lecture. It's only an article. Here we are. And this article includes all required commands. And first of all, you should make sure that you have a stable Anaconda installation with the latest versions. And therefore, I highly recommend to start with the command conda update Anaconda. And you should do that as a regular housekeeping anyway. So I've recently done this and I skipped this here. Now, in case you have the latest Anaconda installation, the package UJSON should be included. However, I've seen a few cases where UJSON wasn't installed. And however, UJSON is required here. And therefore, let's check this and install. So let's press enter. And on my computer here, UJSON was already installed. Next, let's install v20 from Uanda with pip install v20. And let's press enter key. And here you can see successfully installed v20 version 3.0.25.0. And finally, we have to install the TPQOA wrapper package with the following command. It's also a pip command, pip install. And we have successfully installed TPQOA version 0.046. Now with this setting, we are best prepared to connect to the Uanda API with Python. Thanks for watching and see you also in the next lecture. Bye. All right, before we can connect to the Uanda API and start coding, there are a few more preparations. And first of all, you have to download the resources for this and the next lectures. And the download file is actually attached to this lecture here. So this is here the zip file Uanda first steps, and let's download this to our desktop. And let's have a look at our desktop. So here we have the zip file, and then with a right click we can unzip the file. And actually we can unzip this here also to our desktop. Now here we have the unzipped file, and let's have a look inside. And we have one Jupyter Notebook Uanda first steps with the full code that we will use and run in the next lectures. And also we have a so-called config file Uanda, and this helps us for authentication. So we need to authenticate. And we can actually open and manipulate a config file with an ordinary text editor. So we will see this in 1 or 2 minutes. Now, to connect to the Uanda API with Python, we need to authenticate ourselves. And for authentication, we need 3 things. And first of all, we need to have an Uanda account. And again, at this stage, it's recommended to have a practice account. Then second, we need the account ID. And third, we require a personal access token. And we have to copy and paste the account ID and the access token into the config file. So let's have a look here inside the config file. And actually, you can open this with a notepad. And if this doesn't work at the very first time, you can have a right click, go to open with, and select the notepad, or if you can't see the notepad here, choose another app. So it shouldn't be a problem here to open the config file with a text editor. So this is the Oanda config file, and it starts with Oanda in squared brackets, and please don't change this here. Then next we have 3 entries. So we have the account ID, the access token, and the account type. And as long as we are working with a practice account, then we have to have here practice. Now let's search for the account ID and the access token, and we have to go to the Oanda website. And we have to sign in, so we need an account. And I select here my practice account. And actually to get the account ID, we have to go to Manage Funds. And for the API token, we have to go here to Manage API Access. So first of all, let's get the account ID. And as you can see here, I have 3 sub-accounts, the primary, the secondary, and my US dollar account. And each and every account has a different account number. So this is the account number for my primary account. Then here for the secondary, and for my US dollar account. So at this stage, it doesn't really matter which account number and which account we use. But later when we actually trade, then we should know from which account we want to trade. So let's copy here the account number for my US dollar account. And let's go back to the config file. And here we can paste now the account ID. So this is the account ID, and next let's get the access token. And we can find the token here, Manage API Access. And here it says that I've already generated a personal token, but I could also create a new token by clicking on Revoke. So you can get your personal API token here, and I guess you can click on Get the API token or something similar to that. And you might get an email with your token. So once you have created your token and copied it, you can now paste it here into the config file. And finally, you shouldn't forget to save the file. And close the file. And with this, we have successfully completed the preparations. And in the next lecture, we start coding in our Jupyter Notebook. So hope to see you there. Bye. In this lecture, I will show you how to create a connection to the Oanda API and to the Oanda server with Python and the wrapper package tpqoa. And we will create and run our very first lines of code. And still we have on our desktop the download file Oanda first steps. And we have actually here the config file for authentication and one Jupyter Notebook. And let's go here to the Jupyter Notebook. And therefore I open here the Anaconda navigator. And I go to Jupyter Notebook. So this is the Jupyter dashboard, and this is actually a view on our users folder. And one subfolder of the users folder is the desktop. And we know that we have the downloaded file on our desktop. So Oanda first steps. And now let's open the file. So here we are in the Jupyter Notebook. And first of all, we have to import some packages and libraries that are not included in the Python standard library. It's pandas, and we import pandas as PD, so that's by convention. And also we import our wrapper package tpqoa. Now let's create a connection, and we have to pass our login credentials to Oanda. And our login credentials are actually in our config file, and we can actually pass our config file to tpqoa.tpqoa. And by doing so, we authenticate ourselves and we get access to the Oanda server. So by running this code here, we create an API object, and we should store the object in a variable, for example, API. So we are now connected to the Randa server, and the API object has a couple of very useful methods and attributes that allow us to pull historical data and real-time data from the Randa server. And also it allows us to send orders and execute trades. And finally, we can also get information on our account. So for instance, the balance or the profit and loss and more. And we will see this in the next couple of lectures. But first of all, let's have a look at the available methods and attributes by having here API dot, and then we can press the tab key to get all available methods and attributes. So with get history, for example, we can get historical price data. Then we can stream real-time data. And also we can create orders and more. And first of all, let's get a summary on our account. And here we have quite a few information. So we have the account ID, then the name, it's Alex US dollar, and this is actually a US dollar account. And the current balance is 100,013. And we have many more information here. So actually, this information is extracted here from our account, my US dollar account. Next, we can also get single pieces of information. So for example, the account type, and this is a practice account, or the account ID. And then with the method to get instruments, we can actually show the available instruments for our account. And here we have a list with all instruments. So each and every instrument is in a tuple, and the first element of the tuple is actually the display name of the instrument. For instance, here gold Australian dollar. And the second element here is the technical name. And actually, when working here with the API, we always have to use the technical name to get, for example, historical data, or to stream real-time data, or to set orders and more. So in this case here, we always have to use the technical name. And actually, we have learned before that the available instruments can differ depending on your country. So for example, in the US, I think you can only see Forex. But here in Europe, we can also see commodities and stock indices like the Wall Street 30. So this is actually nothing else than the Dow Jones Index. Then here we have platinum, corn, gold, and more. And of course, you can also save the list here in a variable, for example, instrument. And I can determine the number of instruments with the length function. So in total, there are 124 instruments. And then we can also index the list and, for instance, get the very first instrument at index position 0. It's the instrument gold Australian dollar. So these are the available instruments. And again, here in the API, we have to use the technical names on the right-hand side. And actually here on the trading platform, we can see the display names. So for example, Brent crude oil, copper, corn, and more. Now there's one final thing that I want to highlight here. So we were able to create the connection by simply passing the file name of our config file, oanda.cfg. And this is only the case because our Jupyter Notebook, where we are coding in, and the config file are located in the very same folder, so in the folder Oanda First Steps. And if this is not the case, so let's assume that our config file is on the desktop, so it's not in the very same folder as our Jupyter notebook. Then let's go back here to our Jupyter notebook. Let's restart the kernel. And let's try to rerun the code and try to get a connection. Then we get here a key error. So actually Python is not able to find the config file Oanda. So you should make sure that the config file and the Jupyter notebook are located in the very same folder, and then it should definitely work. All right, thanks for watching, and see you also in the next lecture. Bye. In order to create trading strategies and in order to test the strategies, we require lots of historical price data. And once we have the data, we can search for and discover patterns in historical prices and create strategies. And then once we have a promising strategy, we should use historical prices to test the strategy. And actually, it's best to perform in-sample and also out-sample tests, so to say backtesting and forward testing. And good news is that we can pull tons of historical prices from Oanda with the method getHistory. So first of all, let's import pandas and our wrapper package, and let's create a connection here. And then with the function help, we can get more information on the method getHistory. And with getHistory, we can retrieve historical data for an instrument. So we have in total 5 parameters. We have the instrument where we have to pass the technical name of the instrument. So that's important, the technical name. And then we have the parameters start date and end date. And here we can either pass a Python datetime object or a string object. Then we have the granularity. And for instance, the granularity can be daily or 1 minute or 5 seconds. And finally, we also have the price parameter. And actually, we can get either ask prices or bid prices. And getHistory actually returns a pandas data frame with the price data. So let's have an example here. And let's get for the instrument euro, US dollar, bid prices. So we pass here B from the 1st of July 2020 until the very last day of July 2020. And we want to have daily data. So here we have the data frame, and on the left-hand side, we have a datetime index with datetime information. And we are starting at the 30th of June 2020 at 9 p.m. UTC time. So UTC stands for Coordinated Universal Time, and this is essentially the same as GMT, the GMT time zone. And actually, by default, Oanda gives us here the prices from 5 p.m. to 5 p.m. New York time. So there's actually a 4 hours difference between New York time and the UTC time in summer times. And then in the second row, the second timestamp is 9 p.m. UTC or 5 p.m. New York time at the 1st of July 2020. And actually each and every row is, so to say, a candlestick with open, high, low, close prices. And the time information here is actually the starting time. So we have here the first candle, and it starts at 9 p.m. UTC time on the 30th of June 2020, and it ends at the 1st of July, also 9 p.m. And then we can find here the open bid price at the 30th of June, 9 p.m. And then we have the high price and the low price for the daily bin here, and also the close price at the 1st of July, 9 p.m. And actually, as a cross-check, it's good to see that the close price of one bin is equal to the open price of the next bin. And this holds true for weekdays. And then we have here the third bin from the 2nd of July, so that's a Thursday, until Friday, the 3rd of July, 9 p.m. And then here we have a jump, And then the next bin starts at Sunday, 9 p.m. or to say 5 p.m. New York time, and so on. So each and every row in our data frame here is one candlestick with daily data. So we can also have a look here at our trading platform. And here we can actually set the granularity. So here we have 1 minute bins, but we can also change this to 1 hour bins or daily bins. So here we have daily bins. And again, it's important to notice that the daily bins here by default are not from midnight to midnight, but from 5 p.m. New York time to 5 p.m. New York time. Finally, we also have 2 more columns here in our data frame, volume and complete. And actually volume indicates the trading volume in that period or for that bin. And it's actually not a US dollar volume or whatever, but it's a good indicator for the trading volume. And finally, we also have the complete column, which indicates whether the bin is complete. So here, for each and every row, we have here the complete 24 hours bin. And actually, the last bin in our data frame is from the 30th of July, 9 p.m. till the 31st of July, 9 p.m. or 5 p.m. New York time. And then we can also save the data frame, so we can assign it to a variable df. And then we can further analyze the data frame and get some meta information with the info method. So let's press here Shift tab inside the parentheses. And here we get some summary information. So in total, we have 23 entries, and this stands for 23 trading days in the month July. And we have 6 columns, so volume, complete, open, high, low, close. And we don't have any missing values, so we have in each and every column 23 non-missing values. And the data types are also reasonable, so we have integers in the volume column, then we have booleans in the complete column and floats in the price columns. Now we have seen that we can either get bid or ask prices, so there's the price parameter, and we can also compare this. So we select only one day, it's the 1st of July, and first of all we get the ask price, and then the bid price. And we have learned before that the ask price is always higher than the bid price, and the difference is actually the spread. And let's check this here. So for instance, for the open price, then we can see that the ask price is actually 10 pips higher than the bid price. And also for the close price, we can see a difference of 2.6 pips. So even if we don't have the spread here explicitly in our data frame, we could calculate it by simply subtracting the bid price from the ask price. And with this, we have reached the end of this video, and hope to seeing you also in the second part. Bye. In the last lecture, we have seen that we can get daily price data from Oanda. However, for day trading, we typically require intraday data with a granularity of 1 hour, 1 minute, or even less. And loading intraday data from Oanda is exactly what I'm going to show you here in this lecture. So let's focus on ask prices and on the time period from the 3rd of August 2020 till the 5th. And first of all, let's get hourly data, and we have to pass here H1 for 1 hour to the parameter granularity. And let's have a look here. And here we are starting on the 3rd of August at midnight, and the first bin or candlestick is from midnight to 1 a.m. So we open at midnight at 1.17821, and actually we close at 1.17543. And actually, as trading takes place 24 hours during the week, we have 24 candlesticks per day. So for each and every hour here. However, 9 p.m. UTC time, or to say 5 p.m. New York time, is the end of the official trading day. And this is here the last bin. And then you can see here a drop after the end of the trading day in the trading volume. So this is important to notice here. And finally, the last 1 hour bar is from 11 p.m. till midnight on the 4th of August. So here we have actually a granularity of 1 hour, but we can also customize this and get 12 hours, so half day. And here we are starting again at 9 p.m. UTC or 5 p.m. New York time, and we end at 9 a.m. And now we can also get minutely data, so with a granularity of 1 minute. And in total we get here 2,800 bars, so that's quite a lot. And for example, the first bar is from midnight till 1 minute after midnight on the 3rd of August. And finally, the smallest granularity or the smallest interval is a 5 seconds interval, S5. And here we get over 13,000 timestamps. Now let's also change the instrument, and let's assume that we want to get historical price data for the S&P 500 index. Then we can check this here with get instruments and scroll here through the list. And here we can find the S&P 500 index. So the display name is the US S&P 500, and that's the technical name. And we have to use the technical name. And there's one more thing that I want to show you. So if we select here intraday data, for example, hourly data, and we only want to have 1 day, so for instance, the 3rd of August, then we cannot do the following. So from the 3rd till the 3rd, doesn't work. We get here an empty data frame, and in this case we have to select the very next day as end day. And here we get hourly data for the 3rd of August for the S&P 500 index. Alright, thanks for watching, and see you also in the next lecture. Bye. Alright, we know how to retrieve historical prices to create and test strategies, but also we need to feed our Python trading algorithm with real-time data to analyze and immediately decide whether there are any signals to buy or sell an instrument. So let's have a look at the trading platform. And the setting is that we get candlesticks with a granularity of 5 seconds. So this is here real-time data. And we get one candlestick after another. Now the good news is that the Uanda API and the wrapper package allows us to stream real-time price data with the method stream data. And again, first of all, we have to import pandas, SPD, and also the wrapper package, and then we create a connection. And now let's have a look inside the method stream data. So essentially we have here 2 parameters. It's the instrument parameter, and also here we have to pass the technical name, for instance, euro, US dollar. And there's a second important parameter, the stop parameter. And here we can define the maximum number of ticks. And let's set this to 10. And let's simply run the cell here. So here we get real-time data. And then our live stream automatically stops after 10 ticks. So that's the setting here. And actually we get here ticks in irregular time intervals. So we have here 12 o'clock, 37 minutes and 2.02 seconds. Then next we are at 5.9 seconds. 6.15 seconds, 6.53 seconds. So typically the ticks are in less than 1 second. And for each and every tick, we get actually 2 prices, and it's no surprise that the first price is the bid price, and the second price is the ask price, and the ask price is of course higher. Now we have set here a limit of 10 ticks, but of course we can also remove this and actually don't limit the ticks. And it actually goes on indefinite. And there are actually 2 ways how to stop the live stream. So we can either use the method stop stream. And as you can see, it takes a little while or more. So it seems to be not really reliable here. And therefore, there's also a second and maybe better way to stop the live stream. And we can simply stop or interrupt the kernel here by clicking on interrupt. And now we have successfully stopped the live stream, and we can see this here. We interrupted the kernel. So later on when we trade with Python, the live stream is a very important tool as it feeds our algorithm. And this was here a very first introduction. Thanks for watching, and see you also in the next lecture. Bye. We have already learned how to pull historical price data and also real-time data from the Oanda API. But in the end, our goal is algorithmic trading, and we have to be able to create orders and execute trades with the Oanda API and the wrapper package. And this is actually pretty simple. We have to call the method create order, but first of all, let's import pandas, SPD, and also the wrapper package. And let's create a connection. And first of all, let's have a look at our trading platform and our account. So let's go to open positions, and we have no open positions or open trades or orders. And let's again assume that we want to buy 100,000 euros with US dollars. So in other words, we take a long position in euro and a short position in US dollar. Then let's have a look here inside the create order. So essentially we have 3 parameters, instrument, and again here we have to pass the technical name, and our instrument is euro US dollar. Then second, we have to determine the number of units, and this can either be positive or negative. So positive means buying, and negative selling. So we want to buy 100,000 units plus 100,000. And in addition to that, we also have here the parameter stop loss distance. And this is actually mandatory in many countries, for instance, in Germany. And here we have to define the stop loss distance price. And the default price is here 0.01. So in our example here, if we buy euro for 1.18, then the stop loss price is 1.17, so actually pretty close. So if we want to minimize the probability that the stop loss order gets executed, then we should actually increase here the distance to, for example, 0.1. And again, let's assume that we buy euro for 1.18. Then the stop loss order is getting executed at a price of 1.08. And this is actually all. So in one line of code, we create our order here, and let's run the cell. And here immediately we get an output. So we have a transaction ID of 26, then the transaction time, and the user ID, account ID. Then here we have an order for the instrument euro US dollar for 100,000 units. And actually the price was 1.18721. So the stop loss price is actually here 1.08721. And actually, this is here a market order, and the profit and loss of a trade that opens a position by definition is 0. Then our account balance is 100,030 in dollars. And also we can see here half spread costs, so $6.5. And now we can also go to our trading platform. And here we can see now that we have a long position, 100,000. And here we can see the margin. And also we can see that we have a stop loss order at a price of 1.08. And currently we have a profit of $28. And let's go here to orders. So we have a stop loss order over 100,000 units at a price of 1.08. And here we have the open position. And now let's go back. So this is our initial trade here, and we have a open position. And now let's close the position. And there's actually no method to close position, but we can do the following. So let's copy and paste. And again, we have to use create order, and we simply have to pass minus 100,000 here. So we sell 100,000 euro, and by doing so, we close the position, and let's do this here. And immediately we can see the output of our transaction or our trade. So it's ID 29. And we trade the instrument euro US dollar, and we have minus 100,000 units, and the price is 1.18746. And again, it's a market order, and the total profit and loss of the trade here is plus 25. And now our new account balance is 100,038. And for the second trade, the half spread cost is 7. Now let's also have a look at our trading platform. So we have no open positions now and no open orders. And here we have the activity. And for the total transaction, we have 1, 2, 3, 4, 5, 6. We have actually 6 entries. So we have the market order to buy 100,000 units. Then we actually buy 100,000 units at the very same time. And also we place a stop loss order. And then we have the reverse order to close the position. And we do that immediately. And we also cancel the stop loss order. And again, we can see here the total profit of 25, and we have in total trading costs of $13.5. So we have here the transaction IDs from 25 till 30. And first of all, we can also get an updated account summary for the US dollar account. And here it says the last transaction ID is number 30. And with the method get transactions, we can also get all transactions. Starting here at the very first transaction with ID 1, ID 2, and so on. Now we can also get the most recent transactions, and there's the parameter transaction ID. And if we set here 24, so 24 is excluding, and we get all transactions starting with transaction 25. So here we are starting with transaction 25. It's a market order to buy 100,000 units of euro US dollar. Then next we have 26, transaction 26. And here we buy the 100,000 euros for a price of 1.18. And finally we have the transaction with ID 30. So this actually cancels our stop loss order. So we can get a lot of detailed information on our trades here. And there's also another method, print transactions. And here we get a summary And each and every line is here just a trade, so we don't have orders here. And here we can see the most recent 2 trades. So we buy 100,000 euros and the realized profit and loss is 0. And then we close the position and we realize 25. And also here we can define that we want to start with transaction 26. So we can say transaction ID is 26 minus 1 excluding, so 25 excluding, starting with the transaction 26. And typically this information here is sufficient to analyze a trade. So we have the timestamps and the instruments and the number of units and the realized profit and loss. Finally, for the sake of completeness, let me show you how to create a short position. And it's actually no surprise that we simply have to run the order with minus 100,000 units first. And here we have the summary of the trade. So with idea 32. And here we have an open short position. And now we can close the position here by running the reverse order, so buying 100,000 units. And this works. So we have a realized profit and loss of minus $50. And we can see this here. All right, this was an introduction to trading with the Oanda API. So it's actually pretty simple and straightforward. And the challenge is to create more advanced algorithms and strategies with Python. So thanks for watching and see you also in the next lecture. Bye. All right, so far we have created orders and executed trades manually here in the trader working station. But it would be great to submit orders directly in and with Python. So that's a must-have for automated or algorithmic trading and investing, where Python algorithms determine when and which stocks to buy and sell, and then Python submits the orders and executes the trades automatically. So that's the plan. But now before we can start, we need a couple of preparations. And first of all, we will not directly work with the native Interactive Brokers Python API, as this is really a bit messy and overwhelming for beginners. So it's better to use a Python wrapper package that makes it a lot easier and more comfortable. And one good package is the IB InSync wrapper package. And you can install it with the following command. So you can simply copy and paste it here into Anaconda prompt or a terminal window and then press the Enter key. And I've already done this. And then you can also go to the documentation page. So here you can find a lot more information and also coding examples. And finally, before you can make API calls, there are a couple of required changes in the Trader Working Station API settings. So you have to enable ActiveX and socket clients and disable read-only API. So let's have a look here. And we can go to configuration and then to API. And then finally to settings. And here you have to enable ActiveX and socket clients and disable read-only API. So that's the first change. And the second, so you should go here to precautions and enable the bypass of order precautions for API orders. So you have to check here the box. So this is here the second change. And now once you have installed the Python wrapper package and once you have made these few changes here, then you are best prepared for the first steps with the Interactive Brokers API. And we will continue in the next lecture. Thanks for watching and see you there. Bye. All right, let's connect to Interactive Brokers via the API and the wrapper package. And first of all, we need to import everything from the wrapper package. And also, so if you are working on an interactive environment like Jupyter Notebook, then you need also here the following line, but you have to actually comment or cross out this line if you code in scripts. So only in interactive environments you need this here. So let's run the cell here, and then we can, so to say, create an interactive brokers object here. So here's a more technical definition. So with IB, and we can save the object in IB, and then we can connect with the method connect. But first of all, you have to make sure that you are logged in your trader working station. So I'm here logged in, and it only works if you have a connection to your trader working station. So you need to be logged in, and then you can simply connect with connect. And here you can see that I've successfully created a connection. And now with the connection, we can do a lot of things. So there are many possible calls, and you can just check this here. So there are various methods and attributes. And for example, you could check your current positions. So currently I have one position in my account, so that's the account number. And then the position is a stock position, and here's the contract ID. So it's the Microsoft stock on the NASDAQ exchange. And the currency is US dollar, and the position is one stock. And the average price was 250.86. So let's make a double check here. So now here, this is my current position. So I have one Microsoft stock, and then I have cash. And finally, at the end of the coding session, you should disconnect with disconnect. So this is how it works. And now let me demonstrate probably the most frequently made mistake. So once again, you have to be logged in. And if this is not the case, so I close here the connection. So if you are not logged in, then it won't work. And let me demonstrate this here. So here the connection failed. And you get the following message, so API connection failed. And it says here, make sure that the API port on the trader working station is open. So in other words, you need to be logged in your trading working station. And we will continue with the API in the next lectures. Thanks for watching and see you there. Bye. Again, let's import here the wrapper package, and let's create a connection to interactive brokers. Now, whenever we want to do something with an instrument like the Apple stock, so for example, trading or creating orders or whatever, then we have to define and also find the respective contract here on interactive brokers. And this means that knowing the ticker symbol is not sufficient. So we need to find the contract. So that's an important aspect here when working with the interactive brokers API. And now let's start with a simple example. So for example, the currency pair Euro US dollar. And we can create and find a contract object with Forex. And here we have to pass the currency pair, and we also have here a default exchange. So we don't have to specify here the exchange. And if we run here, then we have a Forex contract object. And actually here we can see the currency pair and also the exchange. And then the method qualify contracts allows us to get some more information on the contract. So let's have a look inside. And the method will fill in the missing fields in the contract. So for example, the very important contract ID. So the contract ID is unique. So each and every contract has a unique contract ID. And knowing the contract ID is pretty important. So let's get some more information on the contract. So here we have the unique contract ID. and some more information. And this is actually a list with one contract here. And therefore, one more time, we can get here the contract object. So with some more detailed information. And now we can access here the information in the contract object. So for example, with the attribute contract ID, we can get the contract ID, or with the attribute exchange, we can get the exchange, and so on. So now here we have the contract ID. So this was here the very first example. And depending on the asset class, so there are various ways how we can get a contract. So first of all, we can simply pass the contract ID to contract. So this works for all asset classes. But then again, so for Forex, we can use Forex, or for stocks, we can use stock, and then we can pass the ticker symbol, then the exchange, and typically we should use here smart for smart routing here on interactive brokers. And then we can also define the denominated currency. So for example, US dollar. So some stocks can be traded with different currencies. So for example, US dollar and euro or whatever. And actually smart routing means that interactive brokers searches different exchanges and looks for the best execution price. But we can also further specify the primary exchange. So for example, NASDAQ, but typically, so this should be sufficient for stocks. So smart routing, where interactive brokers automatically find the best and most favorable exchange and price. Then we have Forex, the CFDs, future instruments, and also options and bonds. And now let's have a look at an example here. So we can create the contract object for a stock, for example, Apple, with smart routing and US dollar. And also here we can get some more information with qualify contracts. And in this example, we have exactly one contract. So for the settings Apple, smart routing, and the US dollar. However, if we only pass here the ticker symbol Apple and not the exchange, and also not the currency, then this setting is ambiguous. So this means there are a couple of contracts for the symbol Apple. And now if we run here, then we get here the message ambiguous contract. So there do exist several contracts. And we will go here further into the details in one of the next lectures. But for the time being, now let's disconnect. And I see you in the next video. Thanks for watching, and bye. In the last lecture, we have learned that in the Interactive Brokers API, it's important to identify the right contract for your instrument. And having the right contract in place allows you to get, for example, current market data for the contract. And actually, market data is a pretty special and a bit more complex topic here on Interactive Brokers. So we have seen before that in our paper trading account that the market data is delayed. So let's go here to the trader working station. And here we can see that this is not a brokerage account. This is a paper trading account, and the market data is delayed. And we can click here, and then we can see, for example, for US stocks, so the delay is 15 minutes. Now, the good news is that the live account gives you access to live data for many exchanges and for many instruments, but not for all. So for some market data, you need a paid subscription, and you can find more information here when you go to pricing and market data fees. And actually, for example, market data for currencies is included. So the fees are waived here actually. And also for US equities and ETFs. So for streaming non-consolidated data purposes. So this is already included. However, there are a couple of different bundles and service levels here. and probably you won't need them. But in case you need one of them, then you know that you can get it with the right subscription here. So let's go back to the Jupyter Notebook and let's get some market data. So let's create a connection. And as I said before, so for currencies, we always get live data. So no matter if we have a paper trading account or a live account. And first of all, we need to create a contract. So for example, for the currency pair euro US dollar, and then we can actually request market data for a specific contract with ib.request market data. So we need to pass here the contract, and then we save the market data object, for example, in data1. And actually this takes a couple of seconds to actually fill here the data. So now if you rerun data1, then we can get some more information. So we have here the current date time. So here we have year, then month, day, hour, and minutes. And then, for example, we can see the current bid price, the current bid size, the ask price, and the ask size, and the daily high, low, close. And it's important to understand here that in the background, the connection is still there and it's getting updated. So if you rerun here data1, then we get updated data. So now we have here 46 minutes and 50 seconds. And if you rerun, we have 46 minutes and 57 seconds and so on. And also the data here, the prices are getting updated. And actually we can now go here into the data and get some of the data. So for example, the current ask price. So that's the most favorable price to actually buy the instrument. And also here, if you rerun, then it's getting updated in real time. And also we can, for example, get the ask size. So these are just two examples. And then we can also get the current market price, which is actually here either the last price if within the current bid ask, or if no bid ask is available, then it's the midpoint. And also this is getting updated in real time. And then, for example, we can also get the time. So this is a datetime object. And we could also convert this into a pandas to datetime object. So a pandas timestamp. And we can see that the localization is UTC time. So whenever we retrieve datetime information from the API, then typically it's in UTC time. So you have to take this into account. So this was Forex, and now let's move on with a stock, for example, Apple. And let's create here the market data object data2. And then we can also get here the data for data2. So for example, the current price, so the ask price or the ask size. And also here we can go inside to get the current ask price that changes in real time. And now let's move on with another example. For example, the Lufthansa stock. And let's create data3. And here we get an error, and it says that the requested market data is not subscribed. So we could get delayed market data, but this is not enabled. But we can enable here delayed data with the method request market data type. And here we have the choice between live and frozen delayed and delayed frozen. And essentially, we should select delayed if we can't get live data. So typically delayed by 15 minutes. And you can get more information on the market data types here by clicking on this link. But now let's change here the market data type to 3. So typically by default it's set to a 1 live, but now let's set it to a 3 delayed. And now we should be able to get some delayed market data for Lufthansa. And that's the case here. And we can get the market price, for example. But once again, this is delayed data. And with this, we have reached the end of this lecture. So let's disconnect and see you again in the next lecture. Thanks for watching and see you there. Bye. Now, there's one more thing that I want to highlight here. So in the last lecture, we have created 3 data requests in parallel for 3 different instruments. So for Euro, US dollar, and we have saved the data request in data 1. And once again, so it's still running in the background, and we can update it. And same we can also do with data 2. So for the Apple stock, so it's still running in the background. And also the data request for data 3. And this means that we can actually request market data and stream data for multiple tickers, and just for illustration purposes, so we can simply print the current market price for 3 instruments here in a 1 second frequency. So in total 10 times we could print the market price for the 3 instruments, and we actually sleep here 1 second. And once again, we have to use here ib.sleep. And actually, we can't use here time.sleep, so we have to use ib.sleep. And we could sleep here 1 second between the printouts. So let's simply run the cell. And here we have, so to say, data streaming for multiple tickers. And the prices are getting updated on a per second, so every second. And this was just a little example here. So printing out the current market price for 3 instruments. But of course, we could also do other things with the prices for multiple tickers. So we could create technical indicators and then verify whether there is a signal to buy or sell or whatever. And we might see more examples in the next lectures, sections, and parts of this course. Thanks for watching, and see you there. Bye. We have learned before that it is important to get the right contract for our instrument that we want to trade. And there is a more advanced way how we can find the right contract. But first of all, let's import the wrapper one more time, and let's create here a connection. And then when searching for a contract, there are 3 possible outcomes. So case 1, so our search is unambiguous, so only 1 contract exists. Then second, the contract is unknown, so there doesn't exist any contract with the details. Or third, we have multiple contracts, so the result or the search is ambiguous here. And now let's start here with case 1, so that's the desired outcome. And if we pass here the Apple symbol, then smart and US dollar, then this is clearly defined and only 1 contract exists. And we can check this and even get more details on the contract with the method request contract details. So we have to pass here the contract, and then we get the contract details, and we save it here in CDS contract details. And this is obviously a list, and we have here only 1 element. So we can check this here with the length function. So we have 1 contract, and then we can get actually the contract. And then we can select the contract details here. So for example, the contract ID or the symbol, and we can further go here inside and get, for example, the contract ID, or we can get other information here. So the contract is this here, and then we can, for example, also get other information like market name or price magnifier or whatever. So for example, also the order types. So this is rather technical here. So this was case 1, the simple case. But now let's continue with a symbol that is actually not defined. So there doesn't exist a stock with the following ticker symbol. However, if we create here the contract object, then we don't get an error here, and we only get an error if we pass here the contract to a request contract details. And here we get the error warning or message. So it's an error 200, no security definition has been found for the request. And we can see here that we have an empty list. So here we have 0 contracts. And finally, we have case 3. So we have multiple possible contracts. And this will happen whenever we only pass, for example, the ticker symbol to stock. And then if we pass the contract to request contract details, then we get a list of contracts, of possible contracts. And we can check the number of contracts. And in total, in this case here, we have 30 contracts. And now we can actually only get here the contract details. So we can iterate over the list and get the contract details. And for example, we can do this with the list comprehension. And then we save the contracts and contracts. So here we have a list with the 30 contracts. And for example, we can select the very first contract. And this is the contract Apple, Smart Exchange, and US dollar. And as always, it's just best to actually visualize this in a pandas data frame. So this enhances readability. And actually the wrapper package provides here a little shortcut or helper function. So util.df. And if we pass here contracts, then the wrapper converts here the list into a pandas data frame. So this is, so to say, the shortcut for pd.dataframe. So let's have a look here. And here we have the data frame with the 30 contracts. And we can see the security types, so stock, and the contract IDs, and the symbol, and the exchange. And also here the currency, and we have a US dollar, but theoretically we can also buy the Apple stock denominated in British pound or Canadian dollar. And finally, let's have another example for a European stock, Lufthansa. And here intuitively, we should pass the ticker symbol, then smart, and the euro as currency. And let's check here. So I would expect that we have only one contract, and that's the case here. And we will continue with a little case study here in the next lecture. Thanks for watching and see you there. Bye. We are coming now to Forex contracts and the corresponding CFD contracts. So let's recall that when dealing with the Forex contract Euro US dollar, we are dealing with the spot or the cash contract. So we really convert the euro into US dollar or US dollar into euro. And in contrast to that, a CFD with the underlying instrument Euro US dollar is a derivative contract. And generally, derivatives have the advantage that they allow margin trading with leverage and also short selling. So in most countries and regions, the CFD contract is more appropriate for Forex algo trading than the spot or the cash contract. But please keep in mind that CFDs are prohibited in some countries like the US. And now let's start coding. And we can create the Forex contract for the currency pair Euro US dollar. And then we can also qualify the contract. And then we can request market data. And for example, we could get the current ask price, which is 1.06. And likewise, we can do the same for the corresponding CFD contract. So we can create here a CFD contract with CFD. And first of all, we need to pass here the base currency, so euro. And then under currency, we have to pass the quote currency, US dollar. And now let's check whether this is ambiguous or not. So here we have the CFD contract for euro US dollar. And also here the exchange is the smart exchange. And then the next step, also here we can request market data for the CFD contract. And if we try to get here the ask price, then we get here an error. Now, data subscriptions for CFD contracts typically doesn't really work well, but we don't really care here because on interactive brokers, prices and spreads are the very same. So the very same for the spot, the underlying spot contract, and for the derivative contract. And later in the section, we will see that when trading Forex CFDs, we need two contracts. So we need the Forex contract for market data and the CFD contract for creating orders and executing trades. So we will see this later in the course, but for now we have reached the end of this lecture. Thanks for watching and see you in the next one. Bye. All right, finally let's buy and sell some stocks with the Interactive Brokers API. And first of all, I need to add here the following two disclaimers. So in this video, we will make a few random trades, and therefore you should not run the following code with your live account. So just with your paper trading account. And second, please remind that you can't trade outside the trading hours. So I know that many students learn on weekends or in the late evening, but you should be aware of the trading hours. So if your trades doesn't work, then it's pretty likely that it is due to the trading hours problem. So now let's start and let's import pandas and also the wrapper, and let's create a connection. And now let's assume that we want to buy one Apple stock. Then we can create here the contract object. And before we submit an order, we should actually check whether the contract is unambiguous. And this is here the case. And before we trade, first of all, let's go here to the working station. And currently I have one Microsoft stock, two Apple stocks, and one Lufthansa stock here sitting on my portfolio or account. And now let's buy a third Apple stock with a market buy order. And we can create an order object with market order, so a market order object. And the action is buy, so we want to buy. And then we have to specify the total quantity in number of shares. So we want to buy one share. So this is the market order object. And then we can place an order with IB place order. And we have to pass here the contract and the order. And we save then the trade object in, for example, the variable trade. So let's simply run here the code. And here, if we immediately print the trade object, then the order status is pending submit or not filled. So at this time here, our order was still not filled. And there's typically a time lag between submitting the order and until the order is filled. And this lag can be 1 second or a fraction of a second. But maybe for other instruments with lower liquidity, it also can be a couple of seconds or even more. And therefore, before we check the trade, we could sleep. And we shouldn't use here time.sleep. So it's important to use here ib.sleep. And for example, we could sleep 5 seconds. And then we can check the process of the order and trade with trade.log. And the process started here. So pending submit at 49 minutes and 25 seconds. And then a couple of microseconds later, we have submitted the order. And then after this, the order is getting filled. And then finally, the status is filled. So we really have traded and we have bought one stock. And in this example, it took less than 1 second. So 0.3 seconds. And then we can check again the trade object. And here we can see now that the status is filled. So this is here the quantity. So we have bought one stock and there's 0 shares remaining. And here we can then see the average fill price 142.89. And we can further go here inside and extract data. So for example, we can go here to order status, and this is filled, or order status and average fill price 142.89. And then we can also check all trades of the current trading session. So this session is typically the current trading day, and there are a couple of trades here. So this is a list with the trades objects for all trades, and the same we can also do for the orders. So we can check here all orders of the current trading session. And obviously there's a lot of information then we can extract here from a trade object or an order object. And now let's also cover here the market sell order. So let's check here in the working station. So now I have 3 Apple shares in my account. And now let's reduce the position to 2 shares. So let's sell 1 share. And we can do this with a market sell order, and the total quantity is 1. And now, as I said before, between placing the order and checking the trade object, we could, for example, sleep 1 second. And then also here in this case, the status is filled. So we have sold 1 share at the average fill price of 142.97. And one more time, we can check all trades. So now we should have 1 additional trade. So there is a time lag between submitting the order and until the order is filled. And the time lag is unknown in advance. So it can be fractions of a second, but it can be longer. And there's a way how we can actually wait until the order is either filled or cancelled. So we can do this here with a while loop. So while the trade is not done, we wait until the trade is done. So this is a while loop. And we can also measure the time until the order is actually filled and executed. So we can do this here with the magic function time. And let's do this here one more time for a market buy order for 1 Apple share. And now again we should have here 2 shares. And now we can buy 1 share here. And this was pretty quick here. So 151 milliseconds. And then we can get the trade details. And finally, we can also check all filled all fills in this session with the fills method. And here we have a list with all fills. And now we could actually convert this into a data frame where each row is actually 1 fill trade. So we can pass to util.df the execution part of the fill objects. So here we have the execution part, and if we first of all save the execution part in a list, and then we can pass it to util.df. And then, for example, here, so I have 8 or 9 trades in this session, and here we can see the ID, the time, then the account number, the exchange, the site, so either buy, bought, or sold, the number of shares, the price, and some more information. So this is how we can submit market buy and market sell orders, and how we can extract data and information on the fill trades. Pretty simple actually. And with this we have reached here the end of this lecture. Let's disconnect and see you in the next video. Bye. Now let me demonstrate a full CFD trade for the contract Euro-US dollar. But first of all, let's create a connection, and then we create the CFD contract Euro-US dollar. And first of all, we go long a CFD contract over 10,000 euro. So in simple words, we buy 10,000 euro with US dollar. And first of all, we create here the order object, and then we place the order and execute the trade. So let's check here in my trader working station, and here I have the long position for 10,000 euro. So for the CFD contract euro US dollar. And now let's wait a couple of minutes to actually see some effect of our full trade. All right, let's close the position with a market sell order for 10,000 euro, and let's execute the trade. And now, once again, let's have a look here. And now I have successfully closed the long position in the CFD contract euro US dollar. And we will analyze the outcomes of the full trade in more detail in the next lecture. Thanks for watching and see you there. Bye. All right, let's analyze the full trade, and we can find some fill information on the most recent trades in the current trading session with ib.fills. So here we should find 2 fill transactions. So this is the first one, and here's the second one. And then we can select the execution data for all trades. So starting here, so we have here kind of a list comprehension over all trades, and then we convert to a data frame. And then, for example, we have the execution ID, which is unique for each and every transaction. Then we have the time, the account number, the exchange, then the site. So first of all, we go long. So we bought and then we sold 10,000 shares. So in this case, 10,000 euro. And then here we can see the average price. And it's clearly a coincidence that the buy price and the sell price are identical. So 1.06165. And then we have some more information here. And typically we are only interested in the execution ID, the time, the site, the cumulative quantity, and the average price. So let's create the data frame fill.df, and then having the cumulative quantity and the average price. We can also calculate the trade value for each and every trade. And the calculation and the rule is here pretty simple. So if we sold the asset, then the trade value is positive. So if we sell something, then we receive money. And if we buy something, we have to pay money, so minus. So what we actually do here is we multiply the cumulative quantity with the average price. And if the site is equal to sold, then we multiply with +1, so we receive money. And else if the site is bought, then we multiply with -1. So let's see this here live in action. So here for the buy transaction, the trade value is negative. And then for the sell transaction, the trade value is positive. And once again, it's a pure coincidence that the average price and the trade values are equal. So typically they are not equal. And then we can calculate the profit and loss of the full trade before paid commissions. So we can sum up the trade values. And in this case, so the profit and loss before commissions is just the 0. But of course, we should also include paid commissions. And we can get commission data and profit and loss data in the commission report. So also here we have list comprehension, and then we convert into a data frame. And here, once again, we have the execution ID, the paid commission, and here with CFDs, the minimum commission is $2 per trade, or here in terms of euro, it's 1.88. So this is the paid commission 2 times $2, and then we can see the realized profit and loss. And by default, when we enter or open a position, the realized profit and loss is 0. And then when we close the position, then the realized profit and loss includes the change in the trade value and also the paid commissions for both transactions. And as the change in the trade value is 0 and the 2 commissions are $4, the total realized profit and loss, including commissions, is minus $4. So you should keep here in mind that the realized profit and loss is in the currency of the quote currency. So in our case, it's US dollar, and it already includes paid commissions. So let's also convert here the most important columns in the commission report to a data frame. So the profit data frame with the currency of the commissions and the realized profit and loss. And then in a trading session, if we have multiple trades, then to get the total profit and loss, we can simply sum up here the realized profit and loss column. And in our case, it's minus 4. And actually, we can also calculate the total profit and loss manually, so separated by total commissions and the trade values. So we can convert the total commissions into US dollar and give a negative sign and then add the sum of the trade values. And also here we get a total loss of minus 4 US dollar. So this is how we can analyze and report a full CFD trade. And we will see this in some more detail in one of the next sections. Thanks for watching and see you in the next lecture. Bye. Now, the Interactive Brokers API allows us to pull information and data on our current portfolio positions and account values. So let's go to the Trader Workstation. And currently I have a couple of long and also short positions here in my portfolio. So for example, I'm short one stock in the Nike stock, and then I have one share in Lufthansa, and I'm short one share in Boeing and so on. And I do have 100,000 euro cash, and a slightly negative US dollar cash balance. And of course, I could offset the negative US dollar balance with my euro account at any time. And now let me demonstrate how we can get this information here and these positions into Python. So let's create a connection, and with the method positions, we can get the current positions. And also here we can convert this into a data frame with the util df. And for example, here's the long position in Lufthansa, the short position in Boeing. And it would be better to actually have a separate column for the symbol and maybe also a separate column for the contract ID. And therefore, we can actually extract here the information from the contract column. And we use here a lambda function to extract the symbol and also the contract ID. And then by doing so, we create the additional columns symbol and contract ID. So here on the right. So we do have the column contract with some more information on the contract. Then we have the position, so the number of shares and whether it's a long position, so positive, or a short position, negative. Then we also have the average cost of the trades and the symbol and also the contract ID. And now we can also get the account values. So for example, the cash balance with the method account values. And here we can find a lot of information. So accrued cash. So a lot of things related to the margin, cash balance, currency, exchange rate, fund value, and many more things. So feel free to go here more into the detail. But for now, let's actually also convert this into a data frame. And then, so here we have the tag and the value and the currency. And then, for example, if we are interested in our cash balance, we can actually filter df2 for the tag, and it should be cash balance. And then we can see the euro cash balance, the US dollar cash balance, and actually the aggregated cash balance in euro. So it's here the positive euro amount minus the negative US dollar amount in euro. So that's the cash that we actually have. So the net cash sitting on our account. So these were just a few examples how you can pull data and information on your positions and account values into Python. Thanks for watching and see you in the next lecture. Bye. Now we can also load historical open high, low, close data via the Interactive Brokers API. And also here the problem is that for some exchanges and instruments, you need an extra subscription. So historical data for Forex is free, but for stocks, you either need a live account or in addition a data subscription. And that's why, in my opinion, for historical data, Interactive Brokers is only the second choice. And the first choice is Yahoo Finance. But now let me just demonstrate how you can load historical bars from Interactive Brokers. And we start here with a connection. And then, for example, we could create a contract object for the currency pair euro US dollar. And then the method request head timestamp allows us to request the earliest timestamp where data is available. So we can pass here, or we have to pass here the contract, and then we can request it, for example, for the midpoint, or alternatively, we could also request it for ask or for the bid price. And then we should set the use regular trading hours to true. So by doing this, we only take into account the regular trading hours and not extended trading hours. And we save the result in the variable start. So the earliest timestamp for historical data for euro US dollar is the 9th of March at 4:30. And this is just to know how long we can go into the past here. And now we can load historical data with the method request historical data. And we have to pass here the contract. And then we could specify the end date time. And if we don't specify this, then we can also set here the duration string. So for example, we could get the last 60 days. And then with the bar size setting, we can determine the bar size or the frequency. So for example, daily data. And then also here we should set use regular trading hours to true. And now let's save here the data in data. And also here we load the midpoint prices. But alternatively, we could also select bid, ask, and some more other prices here. Now data is actually now a list with bar data objects. So for each and every day we have here one bar data object. And it definitely makes sense to convert this into a data frame. And also here we can use util.df and pass data. And by doing so, we create here a pandas data frame with the column state. So we have here daily data for the last 60 days. Then we have open prices, high prices, low prices, and also close prices. Now we have seen that one important parameter is the duration string parameter. And here we can define the time period or the time span of all the bars. And for example, we could select 10 years, 6 months, 30 days, 13 weeks, 60 seconds, and many more. So for example, 4 months or whatever. So this means that we are completely flexible here. And second, we have the parameter bar size setting. So this is the frequency of the bars. And here's the set of possible settings here. So from 1 second to 5 minutes, 1 hour, 4 hours, 1 day, 1 week, 1 month. So this is pretty flexible here. And for example, we could request the following intraday data. So for the last day, 5-minute bars. And here it's important to set the format date to true. And this actually returns the time in UTC time. So here we have UTC time, so relative to UTC time, plus 0 hours and 0 minutes relative to UTC time. So we have here 201 bars. And we could also specify here local time. So for Euro, US dollar, local time would be US Eastern New York time. And for local time, we could pass here 1, but there seems to be a bug here. So if we do this, then we get here an attribute error. And this might getting fixed in one of the next updates. So for the time being, we can only request the UTC time by passing here 2. And then if you want to convert to local time, we could do the following. So first of all, we can set the date as the index, and then we can convert the time zone with TZ convert, and we could specify here US Eastern time. So now we have here New York time, which is obviously 5 hours behind the UTC time. So this was requesting historical bars for Forex data. And now let's try to do the same also for US stocks like Apple. So we create the contract here. And then if we request the daily data for the last 60 days midpoint, then we get here the error that we have no data permissions. And once again, for some markets, it is sufficient to have a live account. And for some markets, in addition, we need a data subscription. But again, I want to highlight here that Yahoo Finance is the #1 data source for historical bars or historical price and volume data. Thanks for watching and see you in the next lecture. Bye. We are here on the FXCM website, and let's go to trading and then algo trading. And then here to API trading. So API stands for Application Programming Interface. And actually the FXCM REST API provides programmatic access to the FXCM trading engine. And that means that we can pull historical prices and also real-time data from FXCM directly into our Python environment. And we can also place orders and execute trades from our own web app or from our Python environment without the need to log in to the browser-based trading platform. And actually FXCM provides a very useful and powerful Python wrapper package. And the wrapper package FXCM makes it really easy and comfortable to communicate with the FXCM API. So with the wrapper package, there's no need to go here inside the details of the FXCM API. But of course, feel free to do that if you are interested in that. So let's go back here and let's go to FXCM wrapper package. And here you can find some more details and documentation and examples. But we will cover everything and more in the next lectures and also in some of the next sections. Now in the next step, we have to download and install the wrapper package FXCM. And therefore we have to open Anaconda prompt or a terminal window if you are working on a Mac. And I've provided all required commands in the immediately preceding lecture. So it's just an article with the commands that you can actually copy and paste. So let's have a look here. So that's the lecture FXCM commands to install required packages. And as always, you should make sure that you have a stable Anaconda installation with the latest versions. And therefore, I highly recommend to start with the command conda update Anaconda. And you should do that anyway as a regular housekeeping. And actually, I've recently updated my Anaconda installation, so I skipped this here. Then next, we have to install the package Python socket.io. So let's copy here the command. And let's paste it here. And let's press enter. And we have successfully installed Python Engine IO 3.13 and also Python Socket.io 4.6. And finally, we have to install the wrapper package itself with the command pip install fxcm. And this was a quick one, so we have successfully installed FXCMPy version 1.26. Alright, this was the first part on the required preparations, and see you also in the second part. Bye. Before we can connect to the FXCM API and start coding, there are a few more preparations, and first of all you have to download the resources for this and the next lectures, and the download file is attached to this lecture here. So we have here the zip file FXCM first steps, and let's download it to the desktop. And let's have a look at the desktop. So here we have the file, and first of all we have to extract or unzip the file. And let's unzip the file here to the desktop. So here we have the unzipped file, and let's have a look inside. And here we have two files, one config file or CFG file, and a Jupyter notebook with the full code that we will use and develop in the next lectures. And actually we need the config file for authentication. So when connecting to the FXCM API, then we need to pass our login credentials, and therefore we need an access token. So let's go here inside, and actually we can open a config file with an ordinary text editor like the notepad here. And here we have in square brackets FXCM in uppercase letters. So you shouldn't change this here. And also you shouldn't change log level equals error and log file equals FXCM cfg.log. So I don't want to go into the details here. And finally, and most important, we have access token. And here you have to copy and paste your personal access token. And now let me show you how to get your personal token. So you have to log in into your practice account. And I've already done this. So this is my practice account. And then you can go here to the right and click on token management. And here it says that a token already exists for my username. So I've already created a token, but I could also create a new token by clicking here on revoke token. So typically I think you can read here, create my personal access token or whatever. And you should click here. And then immediately you can see your personal token. And then you should actually copy your token and paste it here into the config file. So let's assume that your personal token is something like this here. And then you shouldn't forget to save the file. And with this we have all required preparations, and in the next lecture we start coding. So thanks for watching and see you there. Bye. In this lecture I will show you how to create a connection to the FXCM API and to the FXCM server with Python and the wrapper package FXCMPy. And we will create and run our very first lines of Python code. And we still have the download file FXCM first steps on the desktop. And we have a Jupyter notebook and the config file. And let's go inside the Jupyter notebook. And I've already opened here the Jupyter dashboard. And let's go to desktop. And here we can find the folder FXCM first steps and the Jupyter notebook here. And first of all, we have to import two packages or libraries that are not part of the Python standard library. So we import pandas, SPD, and also the wrapper package FXCMPy. And now let's create a connection, and we somehow have to pass our access token to FXCM. And actually we can do this by passing our config file, so fxcm.config, to the method fxcmpy.fxcmpy. So let's have a look here inside the parentheses with the shift tab. And here we can either directly pass the access token, or we can do this via the config file, and in my opinion, that's the better solution. So we pass here our config file, fxcm.config, to the method here. And by doing so, we create the connection to the fxcm server. And so to say, we create an API object, and we save the object in the variable API. And this can take a few seconds here. So now we have created a connection to fxcm, and this is actually an API object. And we can also check the available methods and attributes by having here API dot, and then we can press the tab key. And here we can see the available methods and attributes. So we can change an order here, or close the order for all symbols, and many more things. So the fxcm PI wrapper package allows us to pull historical data and also real-time data from the server, and it also allows us to send orders and execute trades. And finally, we can also get some information on our account. So let's run here the very first method, get accounts, and here we get some more information on our accounts. So I have one account, and the account ID is here. So this is a data frame with only one row. So one row for one account, and I can see here the current balance in euro and the usable margin and today's profit and loss. And we can also get the account IDs separately. Now we have already seen that fxcm provides a couple of products and instruments. So we have Forex, then we have stock indices, we have single stocks, cryptocurrencies, commodities, and more. And we can get a list with all available instruments with the method getInstruments. So here we have a list, and the list contains the instruments, for example, euro, US dollar. And unlike the Render API, we do not have here a differentiation between a display name and technical name. So to say, we only have here the technical name. So we have many currency pairs. Then we have here stock indices, for instance, France 40. Then we have commodities like copper or US and UK oil. And also we have cryptocurrencies like the Bitcoin and currency baskets, for example, the Japanese basket and more. And let's also have a look into our trading station. And here we have the very same names. So these are actually the technical names. There are no display names. And finally, we can also save the list here in a variable like instruments. And we can index the list and, for example, get the very first element. It's euro, US dollar. And we can also determine the number of instruments with the length function. And in total, we have here 84 instruments. So this was the very first introduction to the fxcm API and to the wrapper package. And finally, once we have finished our session, we should close the connection, and we can do this with the method close. And with this, we have successfully closed the connection, and we can check this. So now I think we are not able to get the list of instruments. And this is the case here. Now there's one last thing that I want to highlight here. So first of all, let's restart the kernel and clear the output. And actually we were able to authenticate ourselves by passing the config file here to fxcm.py. And this is only possible as long as the Jupyter notebook where we are coding in And the config file are located in the very same folder. So we have the folder fxcm first steps, and they must be located in the very same folder. And if this is not the case, so let's move here the config file to the desktop. And now the Jupyter Notebook where we are coding in and the config file are not located in the very same folder. And now if we try to authenticate ourselves by passing the config file to fxcmpy, then this shouldn't work. So first of all, let's import pandas and fxcmpy. And now let's run the following code. And here we get an error. So cannot open the config file fxcm.cfg. And the reason is, again, that the config file and the Jupyter Notebook where we are coding in are not located in the very same file or folder. So this is important here. Thanks for watching and see you also in the next lecture. Bye. To create trading strategies and in order to test the strategies, we require lots of historical price data. And once we have the data, we can search for and discover patterns in historical prices, and then we can create strategies. And once we have found a promising strategy, we should use historical prices to test the strategy. And it's best to perform in-sample and also out-sample testing, so to say back testing and forward testing. And good news is that we can pull tons of historical price data from fxcm with the method getCandles. But first of all, we have to import pandas and also the wrapper package fxcmpy. And then we pass our config file and create a connection to the server. So now we have a connection, and with getCandles we can get, for instance, historical prices for the instrument euro US dollar. So let's simply run the cell here. And here we get a data frame with in total 10 rows and a couple of columns. And actually here in the index, we have a daytime index. And actually each and every row is a candlestick. So we have here candles with a granularity of 1 hour. And the first candle is from 5 a.m. to 6 a.m. on the 19th of August 2020. And here we have for the bid prices and also for the ask prices, open, close, high and low prices. So here in the first row we have the candle from 5 p.m. to 6 p.m. and the bid price on 5 p.m. is 1.19305 and the bid close price at 6 p.m. is 1.19368. And to make a cross check here, so the close price of one candle is equal to the open price of the next candle, 1.19368. So we have here hourly candles for bid and ask prices. And also here on the very right hand side we have ticks quantity, and this indicates the trading volume. So the higher the tick quantity, the higher the trading volume. Now let's have a closer look inside the method getCandles, and we can do this here with help. And we have a couple of parameters. So first of all, we have the parameter instrument, and here we can pass actually the string of the instrument, so euro, US dollar, for example. Then next we have the granularity or the period, and here we have the choice between 1 minute, 5 minutes, 30 minutes, 1 hour, 6 hours, 1 day, 1 week, and also 1 month. Then next we have the parameter number, and here we can define the number of candles to receive, and the default value is 10. So by default we get the most recent 10 candles, and this is the case here. So the most recent 1 hour candle is here the 2 p.m. candle today, so that's today here. So the default setting is that we get the latest 10 candles, but we can also change this, and the maximum value that we can pass to the number parameter is 10,000. So let's get here the most recent 10,000 hourly candles for the instrument Euro US dollar. And it ends actually at the most recent candle. And it starts here at 3 a.m. on the 22nd of January 2019. And here below we can see we have 10,000 rows and 9 columns. And finally we can also save the data frame in a variable, for instance df. And then we can get some more information with the info method. And here we can see that we have a datetime index with 10,000 entries. So starting from 3 a.m. on the 22nd of January 2019 until today. And we have 9 columns. And here we have the column headers. And also here we can see that we have in each and every column 10,000 non-null values. So this means that we have no missing values. And also the data types in the columns seem to be reasonable. So we have floats. And in the tick quantity, we have an integer. Now, by default, we have here bid and ask prices. But we can also customize this. And there's the parameter columns. And here we can pass a list of column labels that we want to have in our data frame. And by default, we get all columns. But we can also select specific columns. And we can also only select ask prices or bid prices by passing here asks or bids. And that's exactly what we will do here next. So for the 5 most recent 1 hour candles, we can only get the bid prices. And the same we can also do for the ask prices. And let's focus here on the very first candle at 10 a.m. And actually we have learned before that the ask price is always higher than the bid price. And the difference is the spread. And let's have a look here at the open price. So we have here a spread of 1.3 pips. And here at the close price, we have a spread of 1.2 pips. All right, this was the first part, and looking forward to seeing you also in the second part. Bye. All right, now let's continue with part 2. And we have seen in the last lecture that we can get the 10,000 most recent 1 hour candles for the instrument Euro US dollar with the following code. And we can also determine that we only want to have ask prices. And this works here. Now, instead of using the parameter number to get the n most recent candles, we can also define a specific time period with the parameters start and end. And here we can pass either Python datetime objects or strings in the following format. So we have here the period from the 1st of July 2020 until the 31st of July 2020. And again for the instrument Euro US dollar and only ask prices. And this works as well. So we are starting here at the 1st of July 2020 at midnight. And the first candle is from midnight to 1 a.m. and so on. And again, by default, getCandles returns candles with a granularity of 1 hour. And we can see this here. So the default argument for period is h1 for 1 hour. But we can also select other granularities. So we have M1 for 1 minute, M5 for 5 minutes. Or we could also select 4 hours, or 1 day, 1 week, or 1 month. So 1 hour is the default setting, and we can also explicitly pass h1 to the period parameter. And we should get the very same data frame as above. And now we can also change the granularity, and we can also get daily data with D1. And actually with daily data here, this is an exception that this is actually here the end date of the candle. So this is the candle from 9 p.m. on the 1st of July till the 2nd of July, 9 p.m. And finally, the last candle is until 9 p.m. on the 31st of July 2020. And actually the time here is UTC time, and UTC stands for Coordinated Universal Time, and this is equivalent to GMT. And there's one reason why we have here 9 p.m. for daily granularity. So 9 p.m. UTC time is equivalent to 5 p.m. New York time. And actually 5 p.m. New York time is the end of the trading day. So trading is typically available from Sunday 5 p.m. till Friday 5 p.m. And with daily granularity, we have here 5 p.m. New York time. But typically for our purposes, we are not interested in daily data. And for day trading, we require a granularity of maybe 1 minute, 5 minutes. So to get 1 minute candles, we have to pass here M1, so a lowercase m. So here we get an empty data frame, and the problem is that we can only pull 10,000 rows in one request from FXCM, and there are actually more than just 10,000 candles in that time period here. And therefore we have to shorten the time period here, so from the 1st of July till the 10th. And this should work. And here we get 10,039 rows. So it's actually limited to 10,000 rows, but sometimes we can get slightly more. And last but not least, we can also get candles for other instruments like US 30, which is actually the Dow Jones Index. And here we get the prices for the Dow Jones Index. So with get candles, we get historical price data organized in candles, and we can actually define the period and also the granularity. And the same we can also do here in the trading station. So here, for example, we can determine the granularity. And currently we have 30 minutes, but we can also change this to 1 minute. So now here we have 1 minute candles. And finally, we shouldn't forget to close the connection with close. Thanks for watching, and see you also in the next lecture. Bye. Alright, we know how to retrieve historical prices to create and test strategies. But we also need to feed our Python trading algorithms with real-time data to analyze and immediately decide whether there are any signals to buy or sell an instrument. And there's actually good news. So the FXCM API allows us to stream real-time data. And first of all, let's import pandas and also the wrapper package. And let's create a connection with the config file. Now, to stream real-time data for an instrument, we have to subscribe to the instrument. And we can do this with the method subscribe market data. And we pass the instrument euro US dollar. And with get subscribed symbols, we can also get a list with all symbols that we have subscribed. So it's no surprise that we have here euro US dollar. But of course, we can also subscribe to 2 or many symbols or instruments. Now let's get some real-time data, and the method to get last price actually returns the very last tick. So here we have the most recent tick at 8 o'clock a.m., 9 minutes and 21.27 seconds. And we have here bid ask, high and low prices. And now to get the latest tick, we can rerun the cell here. And now we get the latest tick at 8 a.m., 10 minutes and 1.25 seconds. And actually there's a second method, get prices. And here we get a data frame with all ticks, starting from the tick that we had when we subscribed to the instrument. So at 8 a.m., 8 minutes and 39.8 seconds. And then actually FXCM adds here each and every tick. So here in the third line, we have the next tick only about 0.2 seconds later. So we get here ticks in irregular time intervals, and typically it's less than 1 second. And since we have subscribed to the instrument, there have been 174 ticks, and now if we rerun here, we have 262 ticks. Now rerunning cells isn't really comfortable, so that's not really a live stream, but there are actually two alternatives how to create a live stream. And the first one is with the time module. So we can create here a while loop, and with time.sleep, we can do the following. So it delays the execution of a code for a given number of seconds, and here we can pass 1. So we can print the latest prices in intervals of 1 second. And let's have a look inside the print function here. So here, first of all, we print name. And name is actually here the datetime information of the output here. Then second, we print the bit price. And third, the ask price. So this must be ask. And as a separator, we define a pipe. So let's run the cell here. And here we get in 1 second intervals the latest prices. So here we have the datetime information, then we have the bit price, and then the ask price. And of course we can also stop the live stream by clicking here on kernel and interrupt. So now we have interrupted the live stream, and we shouldn't forget to unsubscribe our symbols with the method unsubscribe market data. And then we can check and get the subscribed symbols. So now we haven't subscribed to any symbol. And I said before, there's a second option how to create a live stream. And at a first glance, that second option seems to be awkward, but in later sections, it will help us to feed our algorithm with real-time data and place orders and execute trades in real time. So we can do the following actually. We can create a so-called callback function, print data, and then we can pass the callback function here to subscribe market data. So let's have a look again. And we have here two parameters, symbol and add callbacks. And here we define the simple function print data. And this simply prints the data in real time. But we can also create much more advanced callback functions here. So for instance, we can feed a machine learning algorithm with real-time data and place orders. Now let's simply run the cells here, and I don't want to go into the details here of the function print data. So we will go more into the details in one of the next sections. And let's subscribe to Euro US dollar and use the callback function print data. And here we have an ordinary live stream. So here we have actually the numbers from starting from 1. Then we have the instrument. Then we have datetime information. Then first of all here the bit price and also the ask price. And now there are two options how to stop the stream. So again, either we click here on interrupt or we simply unsubscribe. And let's do this here. And again, we have successfully stopped the stream. So this is the live stream. And finally, we shouldn't forget to close the connection. And with this, we have reached the end of this video. Thanks for watching and see you in the next lecture. Bye. We have already learned how to pull historical price data and also real-time data from FXCM, but in the end our goal is algorithmic trading, And we have to be able to create orders and also execute trades with the FXCM API and the wrapper package. And this is actually pretty simple. So we have to use the methods create market buy order and create market sell order. And first of all, let's import pandas and also FXCMPy. And let's create a connection. And then let's check whether we have any open positions. And we can do this with the method getOpenPositions. And here we get an empty data frame, so we do not have any open positions. And we can also check this here in our trading station. Open positions, and we have no open positions. Now let's again assume that we want to buy 100,000 euros with US dollars. And in other words, we want to take a long position in the euro and a short position in the US dollar. Then we can use the method create market buy order. And let's have a look inside here. So essentially we have 2 or 3 parameters. And the most important parameter is the symbol parameter. And here we have to pass the symbol or the instrument, in our example, euro US dollar. And second, we have the amount parameter. And here we have to determine the trades amount in lots. And again, we have to be careful here. So on FXCM, one lot is already 1,000 euros. And therefore, we have to pass here 100 for 100,000 euros. And finally, we have a third parameter, account ID. So in case we have more than just one account, then we have to determine here the account ID. And actually, if we don't specify here an account ID, then the default account is used. So let's run the cell here and let's create the order and let's buy 100,000 euros. And let's have a look here into our trading station. And here we can see now one open position. So we have actually a buy or long position. And with 100 lots or 100,000 euros. And actually the buy price was 1.18159. And here we can see the current price and the current profit and loss in euro. Now we can also check open positions here in Python. And there's the method getOpenPositions. And here we get all open positions. And as we have one open position, we have here a data frame with one row and many columns. So actually we are only interested in the columns trade ID, amount in 1,000 units, currency, then the profit and loss, and whether it's a buy or sell trade. So let's save here the list with these 5 column labels in the variable col. And now let's index getOpenPositions and get only those 5 columns. So here we have the trade ID, then the amount, it's 100 lots or 100,000 euros, then the instrument, then the current profit and loss in euro. And actually this is a buy trade, so a long position. And we can also update here and get the latest cross P&L. And still it's negative minus 8.46. Next, let's create the reverse position and let's sell 100,000 euro. And we can do this here with the method create market sell order. And we have the same instrument and also the same amount. And let's have a look here into our trading station. And now here we have 2 open positions, 1 long position and 1 short position. So again, the behavior on an FXCM practice account is that we have hedging and not netting. So we have a perfect hedge and we have no risk here of losing further money. But actually we haven't closed the long position. So we have 2 open positions here. And now we can also get again the open positions. And here we have now 2 rows, 2 open positions, 1 long position and 1 short position, and the profit and losses. Now to close the positions, we can use the following method, close all positions for one symbol. And here we can pass a symbol, and by doing so, we close all positions for that symbol and or for that instrument. So let's run the cell here. And let's have a look here. So we have no open positions, but we have 2 closed positions. And in total, we realized a loss of 7.61 euro. And actually, we have a small profit in our long position, 2.54, and a loss of 10.15 in the short position. And we can also get an overview and a summary for the closed positions with the method get closed positions. And also here we are only interested in those 5 columns here. So we have the 2 trades here and the profit and loss for both trades. And finally, we can also get a combined summary over all positions in this particular trading day with the method get closed position summary. So this is a combined or blended summary for today's trades. So the total amount is 200,000. And the total profit and loss is minus 7.61. And finally, we can also have a look at our account. So we actually transpose here the data frame to have a couple of rows instead of having many columns. And here we can see the new balance. And also today's profit and loss minus 7.61. And finally, we shouldn't forget to close our connection. So this was an introduction into trading with the FX CM API. And we will go much more into detail in one of the next sections. So thanks for watching and see you there. Bye.